Good morning, everyone. So we are left with the remaining topics in GST. Quickly we will complete that, and then we will proceed to customs. And I have already updated this mighty 50 questions in my website. So you can visit my website and you can download it from there. So under downloads, so whatever notes from now on I will be giving, so it will be available in the downloads only. So this downloads, you can see here, CA Final IDT Mighty 50 question and answers November 22. So you can download from this, and in this I have given what are all the 50 questions. So must, that is these 50 questions, and I have given the reference to the solved workbook also. So suppose if you have the solved workbook latest edition, so in that I have given the page number references, so you can solve these questions, and this is must. And thereafter in the solved workbook also, at the end I have given 200 questions. So first priority is this 50. These 50 are there in the 200 questions again. So therefore that remaining 150 questions will be second priority. If you have time, then with respect to the A category input tax credit exemptions, we have seen A category. So that A category questions you can solve from the solved workbook. So this is the three priorities. First you should complete these 50 questions at any cost. Then that 200 questions. So those 200 questions I have already given in the solved workbook at the end. So then thereafter if you have time, so then category A, all the category A chapters fully you can solve. If you have time, so you can solve full book also, there is no problem. And then, so see this segment number 2. So when this will be applicable? Segment TDS and TCS is applicable in case of supply through an e-commerce operator where liability to pay GST is on e-commerce operator, TCS is not applicable. So TCS under section 52 is applicable only when e-commerce operator is not liable to pay GST on the transaction, which means that there is supply of goods through e-commerce operator or supply of notified services other than notified services through e-commerce operator where liability to pay GST is on the supplier. So then e-commerce operator, when he is collecting money from the recipient, he will be deducting so that TCS and he will be paying it to the supplier. So much of the TCS that is deducted by the e-commerce operator will be remitted to the government on behalf of the supplier. So the supplier can take this TCS in their electronic cash ledger and the supplier can use it for payment of their liability. So this is the background of the TCS. You can see one illustration over there so that you will get a clarity, which is in page number 30. That is, MI Mobiles is a supplier and who will be selling their mobiles through Flipkart, and there is a buyer. First, MI Mobiles will enter into contract with Flipkart wherein they will be giving a commission of 1000 rupees plus GST with respect to every mobile sold through Flipkart. Now there is a buyer who places an order for the mobile, and the supplier will be delivering the mobile along with the invoice to the e-commerce operator. So therefore the value of the mobile is 10,000 and the GST 28%, so 12,800 rupees. Now the mobile will be delivered to the buyer and the buyer will make payment of 12,800. Remember, TCS will be applicable under section 52. There are two sections, TDS section 51 and TCS section 52. TCS will be applicable only if the money is collected by the e-commerce operator. If the money is not collected by e-commerce operator, TCS is not applicable. So here money is collected by e-commerce operator. So now on that amount, the TCS will be computed. While computing TCS, we need to exclude the GST component. So TCS is not computed on GST component. Like how GST is computed excluding TCS, because TCS will not be included in the value of supply for computing GST. The same way, while computing TCS, GST should be excluded. So therefore here what is the value? 10,000 rupees. On the 10,000 only TCS will be computed. That will be 1%. The rate of TCS is 1%, 0.5% CGST, 0.5% SGST and 1% IGST. So this 1% will be payable by e-commerce operator. So 10,000 into 1%, 100 rupees will be paid to government, and this 100 rupees will be taken as credit by in the electronic cash ledger of the supplier, and that money which is there in the electronic cash ledger, as it can be used for payment of any liability. So can this TCS be used for payment of interest, penalty, etc.? Yes, it can be used, because it will not go to the credit ledger, it will go to the cash ledger. And then again, e-commerce operator will be required to pay GST on the commission. So e-commerce operator, for every mobile sold through their platform, they will be getting a commission of that is 1000 rupees. On the 1000 rupees, GST will be payable at the rate of 18%. So this 180 also e-commerce operator will pay. Now how much they will be remitting it to the supplier, that is very important. So they will be taking 12,800. From this 12,800, they will deduct their commission, that is 1000 plus GST on the commission, that is 180. So 1180 will be deducted. So after deducting 1180, so the balance will be given to the supplier, and after deducting TCS also. Therefore here it is 12,800 minus 1180 and minus 100, so 11,520. So this will be paid to the supplier, and supplier will not pay GST on 11,520. Supplier will be paying GST on this 10,000 only, not on 11,520. On this 10,000 means the GST of the supplier will not change, 2,800. But for payment of this 2,800, this 180 rupees is available as credit and this 100 rupees is available as credit. That is, one is in the electronic cash ledger, one is in the electronic credit ledger, and after deducting this, so 2,520 is the net liability payable by the supplier. The objective of TCS is only to identify the supplier who is making supply through e-commerce operator, so that they can collect the GST from that supplier. So that is the objective of this TCS, and this TCS should be learnt in reference to TDS. So TDS is section 51 and TCS is section 52. TDS is applicable whenever the supplies are made to a notified recipient, but TCS is applicable whenever supplies are made to an e-commerce operator. So who are those notified recipients? Government, central government, state government, local authority. Then government agency. So government agency means, already I told you, whenever they will be outsourcing some work to the agents, so they will be called as government agency. Then public sector undertaking, or any government body where the equity participation of the government is greater than or equal to 51%, or greater than 51%. So then they will be called as notified recipients. So whenever you are making supply of goods or services to them, they will be deducting the TDS whenever they are making the payments. Whereas TCS is applicable in case of supplies through e-commerce operator, and here supplier should be different from the e-commerce operator, and the e-commerce operator should not be a mere agent, that is a payment gateway. So they should be really undertaking the responsibility of delivery of goods or services. And who is liable to deduct TDS and at what rate, or TCS at what rate? So TDS will be deducted at the rate of 2%. TCS is 1%, whereas TDS is 2%. And in case of IGST, it will be 2%. In case of CGST, SGST 1% and 1%, whereas TCS will be IGST 1%, CGST 0.5, SGST 0.5. Non-applicability is very, very important when TDS is not applicable. Suppose if the supplier is unregistered, TDS is not applicable because the payment cannot be made to that person. So supplier if unregistered, then how he will be able to take the credit? So that's why. So supplier is unregistered, TDS not applicable. Even TCS also not applicable when the supplier is unregistered. Then suppose if the suppliers are exempted or non-taxable, only on taxable supplies both TDS and TCS will be applicable. So these 2 points are also same. So supplies should not be exempted or should not be non-taxable, means it should be taxable. And whereas in case of TDS, there is a threshold limit of 2,50,000. Only when the value of supplies under the contract exceed 2,50,000, TDS is applicable. What is the meaning of value of supplies under the contract? The contract is for say 10 months or 12 months or whatever may be the period. Under that period, how much supplier has to provide it to the recipient, that is known as a contract value. Contract value is different from the invoice value. Contract value means what is the total value of supplies under the contract, but need not be delivered at a time. That will be delivered at frequent intervals. So whenever it is delivered, the invoice will be raised. So we need to see the total contract value. If the total contract value exceeds 2,50,000, then also TDS applicable. But in case of TDS, we don't have that. So TDS, like TCS, will be applicable irrespective of the contract value, but TDS is applicable only when the contract value exceeds 2,50,000, and when we are taking the contract value, we should exclude the GST component. So the value of supplies under the contract, that should be taken. Then next, supplies between notified recipients means, already we saw who are all the notified recipients. So between them, if there is any transaction, the TDS will not be applicable. For example, interdepartmental services, or government provided any services to PSU, public sector undertaking. So in that case, so TDS is not applicable, that is this. And recipient has to pay GST under RCM. So when liability to pay GST is on recipient only, so then in that case the TDS is not applicable, because mainly to catch the supplier to pay the GST only TDS and TCS is created. So whenever the liability to pay GST is on e-commerce operator 9.5 or whenever the liability to pay GST is on recipient only 9(3), so then the concept of TDS and TCS is not applicable. So TDS is not applicable if the liability to pay GST is on recipient, whereas TCS is not applicable if the liability to pay GST is on e-commerce operator. Then location of recipient and place of supply not in the same state. This is a very important condition for TDS. That is, recipient is located in one state, but the place of supply is not that state. Place of supply is a different state. For example, location of supplier will be Tamil Nadu, and place of supply is also Tamil Nadu, and it is a intra-state supply. Intra-state supply means chargeable to CGST and Tamil Nadu SGST, but the location of recipient is Andhra Pradesh. When location of recipient is in Andhra Pradesh, how Andhra Pradesh government can deduct? So 1% towards T and SGST, so they cannot do that deduction. So due to that reason, TDS is not applicable. So when TDS is not applicable, location of recipient is different from the place of supply. That is what you need to remember. Location of recipient is different from the place of supply. When the situation will arise, suppose if the supplier is an architect service provider and it is in relation to construction of a building, so in that case, so location of immobile property will be taken as a place of supply. So the immobile property is in Tamil Nadu, architect is also in Tamil Nadu, but that building was owned by the Andhra Pradesh government. So Andhra Pradesh government wanted a building to be constructed in Chennai. So for the purpose of, like whenever they are visiting Chennai, so they should be having one guest house. So for that purpose, so definitely in this case, the place of supply will be location of place of supply will be location of immobile property. So location of supplier Tamil Nadu, location of immobile property Tamil Nadu, but the recipient is Andhra Pradesh. So they cannot do the deduction of TDS. So TDS is not applicable in that case. What if AP government is having a registration in Tamil Nadu? So then TDS will be applicable. Then in case of TCS, already these 3 points we have seen, and one more point is that payment is not collected by e-commerce operator. So then TCS is not applicable. And very important point is that TDS should always be computed on the amount remitted to the TDS should be computed always on the amount remitted to the supplier. It is not on the contract value. So which means that it is neither on contract value nor on invoice value. TDS is computed on the money remitted. So TDS computed on the amount remitted to the supplier by the recipient. And TDS not applicable if it is intrastate supply and recipient in other state. Already we discussed that point. Then computation and compliance. TDS what is computed on what? I told you already, value of supply excluding GST. And so whatever TDS that is deducted should be remitted and to the government by 10th of the month following every month, because the TDS return is GSTR 7. GSTR 7 filing due date is 10th of the month following every month. So therefore they have to remit it by 10th of the month following every month, and they should also file a return GSTR 7. Whereas in case of TDS, there is a certificate that is GSTR 7A. Previously, we had a time limit for that certificate, but there is no certificate time limit now. So, but a certificate should be given about whatever TDS that is deducted. In case of TCS, the return is GSTR 8 and the time limit is same time limit. And while computing TCS, remember, we need to take the total value of supplies minus sales returns. So, the supply might have happened, so some 3 months before, but the sales have been returned during this month. So, that needs to be reduced. So, payment towards the contract value excluding GST minus returns during the month. And is there any requirement that the TCS deducted certificate should be given? No such requirement. Then TDS, what is the late fee? The late fee for delay in filing TDS return GSTR 7 is 25 rupees per day subject to maximum 1000. But in case of TCS, the late fee will be 100 rupees per day subject to maximum 5000. And in case of TDS, no need to file any annual return. But in case of TCS, yes, an annual return needs to be filed GSTR 9B by an e-commerce operator by 31st December of the succeeding financial year. And in both cases, TDS as well as TCS, suppose if they are not making the payment on time, they need to pay interest at the rate of 18% per annum from the first date after due date, that is 11th, till the actual date of payment, because the due date of payment of TDS and TCS is 10th of the month following every month. And the general penalty is also applicable. So general penalty will be applicable, that can be levied, but it is at the discretion of the officer whether to levy that general penalty or not. And that general penalty will be payable up to 25,000 under CGST, up to 25,000 under SGST. Whereas If it is section 122 subsection 1 invoked, in 122 subsection 1 also TDS TCS default is there, and in that case the penalty will be 100% of TDS TCS or 10,000 whichever is higher. So that will be applicable. Then whatever TDS TCS deducted will be reflected in which place? It will be reflected in GSTR 2A of the supplier, not 2B of the supplier. It will be reflected in the 2A of the supplier. And can that be taken as credit? Yes, but in which ledger? Electronic cash ledger. And now they gave a clarification, but this clarification is not necessary because from quite a long time we are following the same. So that money of TCS and TDS can be used for payment of interest, penalty, fee and others, because it will be credited to the electronic cash ledger. So that is about TDS and TCS. Then look into segment 31, that is invoice and time of supply. Invoice and time of supply. So invoice and time of supply, here there are two aspects. First, invoice, when the invoice should be given. What is the due date of invoice? Total 6 situations are there. In case of goods, 3 situations. In case of services, 3 situations. In case of goods, section 31 subsection 1, 4, 7. 1 will be applicable in normal cases, 4 will be applicable in case of continuous supply of goods, and 7 will be applicable in case of sale on approval or on return basis. Continuous supply of goods means there will be successive supply of goods for which the payments are settled on a periodical basis. That is continuous supply of goods. Whereas sale on approval or on return basis means first I will be making a supply, that is delivery, and that will be under the cover of a delivery challan. I will hand over the goods, and if you are confirming, the sale will take place. If you are not confirming, then you have to return the goods. Suppose if you are neither confirming nor return the goods within 6 months, it is deemed that on expiry of 6 months the supply is deemed to have taken place. So therefore, due to that reason, the date of invoice, the due date of invoice in case of 31 subsection 7 is the date of supply. Date of supply means the date of acceptance by the buyer, or 6 months from the date of removal, whichever is earlier will be taken as the due date of invoice. Whereas in case of continuous supply of goods, so there will be successive supply of goods. Due to that reason, we need to check whether the payments are receivable irrespective of the account statement. Yes, the payments are receivable irrespective of the account statement, and the payment received date should be taken. Suppose if the payment is receivable based on account statement which is given by the supplier, so then we need to take the account statement date. It is not account statement date or payment date, whichever is earlier. So as the case may be. So that is this date on which account statement is issued or the payments are received, as the case may be. Then normal cases, supply involves movement of goods, supply does not involve movement of goods. So this is the same distinction that we have in 10(1)A and versus 10(1)C. So under the contract of supply, if goods are starting from one place to another place, that is known as supply involving movement of goods. In case of supply involving movement of goods, we need to take due date of invoice as at the time of removal. If supply does not involve movement of goods, then the due date of invoice will be at the time of delivery or making it available to the recipient. So that should be taken. Then in case of 31 subsection 2, 5, 6, it will be due date of invoice in case of services. So 31 subsection 2 says that if it is banking services or insurance services, so invoice should be given within 45 days from the date of completion. Whereas if it is other services, invoice should be given within 30 days from the date of completion. When I say due date of invoice, that is the final date, which does not mean that should only be written in the exam. You need to write on or before that date, because invoice can be given even before that date also, but that is the due date for giving the invoice. Either you write due date is that date, or you write invoice can be issued on or before that date, but don't write invoice can be issued by that date. That is wrong answer, because invoice cannot be issued by that date. So invoice can be issued on or before that date. That is the correct wording that should be used in the exam. And then, so on or before 30 days from the date of completion, on or before 45 days from the date of completion, like that you can write. And then in case of continuous supply of service, what is a continuous supply of service? Very important, that many people will be making mistake in this. That is 3 months it should take. It should take more than 3 months to complete the service, and there should be periodical payment obligations. If it takes more than 3 months to complete the service, just because of that it will not become continuous supply of service. It should take more than 3 months to complete, and there should be periodic payment obligations, which means that the payments will be made in installments. Then only it will be called as a continuous supply of service. Now we need to refer to 3 situations. Whether the due date of installment is ascertainable from the contract, yes, then the due date of installment will be taken as the due date of invoice. If due date of installment is not ascertainable from the contract, but the payment is linked to completion of an event, as and when that event, milestone event is completed. For example, percentage completion means whenever that percentage is completed. And suppose if nothing is there, installment due date also not there, but payment is not linked to completion of an event, then as and when the payments are received, that will be taken taken as the due date of invoice, that is in case of continuous supply of services. Then cessation of service, that is we entered into contract to provide the services, but immediately or abruptly we stopped the services, but we are retaining some proportionate amount. For example, an actor entered into contract to act in a movie and he gave 100 days, and after 10 days he is quitting that movie. So when he is quitting that movie, but for 10 days, after 10 days he is quitting, so for the 10 days he is required to get the money. So for that, immediately upon quitting the movie, so he need to give the invoice for that proportionate amount that he wanted to collect. So cessation, immediately upon cessation with respect to the proportion of the amount retained. So these are the 6 provisions that we need to remember. 147 for goods, 256 for services. This is the due date of invoice. This due date of invoice is connected to time of supply. So time of supply for a transaction depends upon the due date of invoice. Why time of supply is required? Time of supply is for the purpose of determining when a person is liable to pay tax. That is what 12 subsection 1 and 13 subsection 1 says. Section 31 is so far what we have discussed, that is due date of invoice. Section 12 deals with time of supply in case of goods, and section 13 deals with time of supply in case of services. This 12 and 13 are of CGST Act. Even in case of IGST Act also we have 12 and 13, don't get confused. That 12 and 13 is when both supplier and recipient are located in India, either supplier or recipient in India, other outside India. Then what is the place of supply? But those 2 sections are of IGST Act. Whereas the time of supply is not as per IGST Act, time of supply is as per CGST Act. In case of section 12, what should be taken as the place of supply in case, as a time of supply in case of goods, and what is the purpose of the time of supply? To determine when a person is liable to pay tax, that is 12. Whereas 13 is time of supply in case of services, when a person is liable to pay tax in case of services. So that depends upon the time of supply. That is what they are telling, but that's real, because whenever we need to determine the due date of payment of GST, the due date determines based on time of supply. If time of supply for a transaction falls in August month, then we need to pay it by 20th September. If it falls in September month, then we need to pay it by 20th October. So like that, we need to determine what is the due date. And not only that, time of supply also is relevant in valuation. We have seen for exchange rate determination. So whenever the exchange rate needs to be determined for converting the invoice in foreign currency into Indian rupees, as per rule 34, we have taken the exchange rate prevailing on the time of supply, CBIC notified rate in case of goods and GAAP rate in case of services, again time of supply. Then not only that, in order to determine the rate of GST, when there is a change in rate, so between few transactions, that is same invoice, but there are different dates, that is date of entry into contract, date of receiving the money, date of invoice. Between these dates, if there is any change in rate, so then how to determine the time of supply or what rate to be taken? Again, time of supply only is relevant. So the objective of time of supply is to determine the due date of payment of GST, to determine the rate of GST, and to determine exchange rate. So now time of supply we are learning together for 12 and 13, because majority of the cases it is common for both 12 and 13. So 12 subsection 1 is meaning of time of supply, 12 subsection 2 FCM, 12 subsection 3 RCM, 12 subsection 4 vouchers, 12 subsection 5 residual cases, and 12 subsection 6 interest, late fee or penalty for delay in receipt of consideration. Whereas 13 is also arranged in the same way. 13.1 is the meaning, 13.2 is FCM, 13.3 is RCM, and 13.4 is vouchers, 13.5 is residual cases, and 13.6 is interest, late fee or penalty for delay in receipt of consideration. And 13.2 and 12.2 both are FCM, but the provisions are different. So what is taken as time of supply in case of goods under FCM? It will be due date of invoice or actual date of invoice, whichever is earlier. And whether GST payable on advances? No, GST not payable on advances, because date of payment is not one of the date over there. So only due date of invoice or actual date of invoice, whichever is given, whichever is earlier is given, but there is no date of payment. Means no need to pay GST on advances. So whenever you are referring to section 12 subsection 2, we need to give a reference to read with notification number. Notification number, what is that? Notification number 66 of 2017. So because of this notification only, no need to pay GST on advances. However, this notification is not applicable in case of a person opting for composition scheme. This point I told there also. So therefore, a person opting for composition scheme is required to pay GST on advances. Yes. So that's the reason why how GST on advances should be computed in case of composition scheme. We need to take whatever is the bill of supply generated during the quarter minus advances received during the previous quarter for which bills are generated during the current quarter, add advances received during the current quarter for which bills will be raised in future. So that's how we need to determine, which means GST payable on advances in case of a person opting for composition scheme. What will be the time of supply? Regular due date of invoice, actual date of invoice, date of payment, whichever is earlier. Then in case of services covered under FCM, we need to check whether invoice is given within the due date. If invoice is given within the due date, so then we need to take invoice date or payment date, whichever is earlier. If invoice is not given within the due date, then we need to take long back, completion date or payment date, whichever is earlier, that should be taken. Whether GST payable on advances, yes, as date of payment is one of the date, which means that if the payment comes before, then on advances GST is payable in case of services covered under FCM. Whereas in case of RCM, time of supply in case of RCM goods, 12 subsection 3, the date on which recipient has received the goods. As it is RCM, we need to see from the recipient perspective. The date on which recipient has received the goods, the date on which recipient is making payment to supplier, or 31st day from the date of invoice, whichever is earlier. Whereas in case of services, the date on which recipient made payment to the supplier, or 61st day from the date of invoice, only 2. But in case of goods, 3 points are there. Date of receipt of goods, date on which payment is made to supplier, or 31st day from the date of invoice, whichever is earlier. Whereas in case of service, only 2 dates are there, the date on which payment is made to supplier, or 61st day from the date of invoice, whichever is earlier. Then in case of vouchers, residual cases and interest or late fee, so that subsection 4, subsection 5 and subsection 6 will be common between 12 and 13. So in case of vouchers, we need to check whether it is identifiable voucher or non-identifiable voucher. Identifiable voucher means which can be redeemed against any like particular product or service, that is known as identifiable voucher. Whereas non-identifiable voucher means it can be redeemed against any product or service of the supplier, that is known as non-identifiable voucher. In case of identifiable voucher, as the product is known or the service is known at the time of issuing the voucher itself, therefore the time of supply is the date of issuance of voucher. Whereas in case of non-identifiable voucher, the time of supply will be at the time of redemption of voucher. So in case of identifiable voucher, suppose if the person has made the payment of tax based on the date of issuance of voucher, and at a later point of time he came to know that the person is not coming and redeeming, in that case they can claim the refund of that. But in case of non-identifiable voucher, the voucher itself, that is taxable only at the time of redemption. And here voucher as such is not taxable. Here some supply of goods or service is taxable, wherein the voucher will be treated like a consideration. Then 13 subsection 5 and 12 subsection 5 deals with residual cases. Residual cases applicable in case of evasion. A person has not paid tax because he wanted to evade the tax. Is he a registered person or unregistered person? Registered person means he is required to file the returns. So whatever is the due date of filing return, the due date of filing return will be taken as the time of supply. Here the time of supply is to determine the rate of GST. Whereas suppose if he is not paying tax and he is not even registered, means he is unregistered person liable to pay tax. In that case, what should be taken as the time of supply? On whichever day he is making payment of tax, on that day whatever is the rate of GST, that should be taken. So that's what these 2 points. Periodical return has to be filed, due date of filing such return. Periodical return not filed, date of payment of GST. Then 12 subsection 6 and 13 subsection 6. So in that case, what should be taken? Already I told you that interest, late fee or penalty will be always taxable on receipt basis. Therefore, the time of supply is not at the time of issuance of any invoice or debit note or anything. It is the date on which that interest is received. Suppose if the interest is not at all received, then the time of supply shall not arise. So no need to pay GST on that interest received. This is not in case of interest on loans, advances, deposits, but this is in case of interest, late fee or penalty for delay in receipt of consideration. Then some additional points in this regard. What should be considered as the date of payment? Date of payment from the point of view of the supplier is the date of entry in his books or date of credit in his bank account, whichever is earlier. Whereas from recipient point of view, date on which payment is, account is like a date of entry made in the recipient books or date on which debit is made in his bank account. Recipient's bank account is debit and in case of supplier's bank account it is credit. Then in case of goods covered under FCM, no need to pay GST on advances. But goods covered under RCM, yes. Services covered under FCM, yes. Services covered under RCM, yes. In 4 cases, goods FCM alone not required, but in all other 3 cases on advances GST is payable. Then up to 1000 rupees received in excess of the invoice. In case of services, up to 1000 rupees received in excess of the invoice. For that excess 1000 rupees, for example, if the invoice is for 14,204, but the money is received for 15,000. Now 15,000 minus 14,204, so that is like 796 rupees. For that 796 rupees, GST is payable because on advances GST is payable. But when advance GST is payable, we need to pay GST on the basis of either regular time of supply provisions, that is the date of invoice or date of payment, whichever is earlier, or we can postpone that because this excess amount will be reflected in the future invoice, so we can pay at that time itself. So therefore the supplier is having option, but this option is applicable only when the excess is up to 1000 rupees received in excess of the invoice. So that is either it will be date of invoice or determined as per section 13 subsection 2. The supplier has the option to choose. Then in case of supply of services between the associated enterprises as per section 92A of the Income Tax Act, and we have big list, but you remember the thumb rule as 26%, greater than or equals to the 26% case. So in case of associated enterprises, generally invoice will not be there. There is import of service from associated enterprise. Generally import of service, the time of supply will be date on which payment is made to supplier or 61st day from the date of invoice, whichever is earlier. But in case of associated enterprises, as there is no invoice, the date on which payment is made to supplier or date of entry in the books of the recipient, whichever is earlier, will be taken as the time of supply. That is this. Then whenever the goods are taken outside India for exhibition, it is not a supply, because those goods are taken temporarily out of India for exhibition, it will be brought back. So therefore it will not come under permanent transfer or disposal of business asset on which ITC is availed. However, if the goods are neither sold nor brought back within 6 months from the date we are taking it outside India for exhibition, that 31 subsection 7 gets attracted, which says that on expiry of 6 months the goods are deemed to have been sold. Now say for example we gave the goods and 6 months over, so we raise the invoice also, treating it as supply. Thereafter the goods are returned. Then what is the recourse available? Credit note can be issued by the supplier to the recipient. Then tax component should be always, being an unregistered person, you are not supposed to collect tax. Suppose if you are collecting tax, then it will come under amount collected as tax but not paid. So section 76 gets attracted, and 122 subsection 1 penalty also gets attracted. Then being a person who is liable to collect tax at 5%, you should not collect more than 5%. That is second prohibition in section 32. Prohibition from unauthorized collection of tax. Second prohibition is, so you should collect only 5%, means 5% only. You should not collect more than that. That is that point. Then we completed section 31, due date of invoice, but still some more provisions in due date of invoice is not there. 12 and 13, time of supply in case of goods and time of supply in case of services. Whereas 14 is there, time of supply in case of change in rate. But remember, this section 14 is applicable only in case of services. Again, reason, notification 66/2017. Suppose in case of goods, if there is any change in rate, so don't follow section 14. You follow section 12 only. That is due date of invoice, actual date of invoice, whichever is earlier only. Whereas in case of services, between 3 dates, if there is a change in rate, what are those 3 dates? Date of completion, date of invoice, or date of payment. Between these 3 dates, if there is a change in rate, so definitely section 14 gets attracted. In that, if suppose completion is before change in rate, then we need to take invoice date or payment date, whichever is earlier should be taken. Simple. If completion is before change in rate, supply is completed before change in rate, invoice date or payment date, whichever is earlier. Suppose if completion is after change in rate, so rate changed then after the completion is happened, so then in that case, whether both invoice and payment is before change in rate, yes, then whichever is earlier. One before, one after, then whichever is later. So both invoice and payment before change in rate, whichever is earlier. One before, one after, whichever is later. Then in that case, what should be taken as the date of payment? Generally, date of payment means date of entry in the books or date of credit in the bank account, whichever is earlier, provided the credit happens within 4 working days from the change in rate. If the credit happens beyond 4 working days from the change in rate, the date on which it is credited in the bank account should be taken as the date of payment. That is this note. So here payment means entry or credit, whichever is earlier, provided the payment is credited within 4 working days. If the payment is not credited within 4 working days, then only the date on which payment is credited in the bank account will be taken as the date of payment. This is an important point we need to apply to arrive at the answers. Then next, what are the various documents involved in GST? We have tax invoice, bill of supply, debit note, credit note, like that, various documents. We need to understand what is the purpose of each and every document and what is the time limit. So tax invoice, when tax invoice, in case of taxable supplies we will be giving a tax invoice. And in case of tax invoice, who will give tax invoice to whom? Supplier will be giving tax invoice to recipient, and if the supplier is covered under RCM, where recipient will be giving the invoice to the supplier, if the supplier is unregistered and the supplier is covered under RCM. Generally supplier only will be giving, but if the supplier is unregistered and the transaction is covered under RCM, recipient will be giving the invoice to the supplier under RCM. Then in that case, so what is the time limit? Already whatever time limit that we have specified, the same time limit. Then when bill of supply will be issued? Bill of supply will be issued in case of exempted supplies And then in case of composition scheme, because a person opting for composition scheme should not charge GST to the recipient, so therefore the document will be called as bill of supply, and when that bill of supply should be issued, same time limit as the tax invoice, the same time limit is applicable. And then in case of low value supplies means value of the supply is less than 200, not equal to 200, less than 200, and then invoice is not required or bill of supply also not required if three conditions are satisfied. If the recipient is unregistered, recipient do not require tax invoice, but a consolidated tax invoice or bill of supply is generated at the end of the day mentioning all these low value supplies, so then no need to issue separately a tax invoice. All these transactions can be consolidated into one consolidated tax invoice. And suppose if the recipient is unregistered and wanted tax invoice, definitely the tax invoice should be given even if it is a low value supply less than 200. Suppose if the recipient is unregistered, even if it is a if the recipient is registered, even if it is a low value supply, invoice should be definitely given. However, there is only one exception to this low value supplies point, that is in case of admission to a multiplex cinema theatre. That multiplex cinema theatre, even if the ticket price is less than 200, definitely invoice to be given in that case. And what will be considered as the invoice? The e-ticket will be considered as invoice. That is this point. In case of multiplex theatres, an invoice to be issued even if the value of supply is less than 200. Then debit note will be given by supplier to recipient whenever there is an increase in the invoice value, and there is no time limit for issuance of debit note. Because of the debit note, supplier's liability will increase, and credit note, the debit note can be issued even in case of collection of additional tax. For example, 5% collected to collect extra tax, also they can give debit note. And credit note will be given whenever they want to reduce the invoice value, or they have collected lesser, like more tax, but their tax payment will be lesser. So to pass on that lesser tax, they can give a credit note, or in case of sales returns also they can give credit note, or in case of deficiency in the quality of the goods or service also they can give credit note. What are the situations? 4 situations: to reduce the invoice value, to reduce the tax in invoice, for sales returns, or for the purpose of deficiency in the quality of the goods or services. Supplier will be giving the credit note to the recipient, and the time limit is 30th September of the succeeding financial year or date of filing annual return, actual date of filing annual return, whichever is earlier. Then revised tax invoice. Revised tax invoice will be applicable with respect to the outward supplies after the date the person is liable to get registered till the date they get the certificate of registration. For example, a person is liable to get registered on 5/5/2021. So when aggregate turnover exceeds 20 lakhs, so that person is liable to get registered, and he is making application for registration by 31/5/2021. So that is within 30 days he is making application for registration. Then in that case, this 5/5/2021 will be taken as the effective date of registration. That is the date on which he is liable to get registered, because the application is made within 30 days. So the effective date of registration is the date on which he is liable to get registered. Now, thereafter, this is the date on which REG1 has been filed, application for registration has been filed, and thereafter the registration certificate is granted on 5/6/2021. Now in this case, when REG6 is granted, that is registration certificate is granted, now from 5/5/2021 to 5/6/2021, during this time, whatever supplies that are made, they cannot give tax invoice. Why they cannot take tax invoice? Because they have not got the registration certificate, but at a later point of time they can give the revised tax invoice for the supplies made during this period, and this revised tax invoice can be given for registered as well as unregistered persons. There is no restriction there, it can be given, but there is a time limit within which the revised tax invoice should be given. So within 1 month from this date, so within 1 month from this date, the revised tax invoice should be given. So 5/6/2021, 1 month means 5/7/2021. That is the time limit by which the revised tax invoice should be given, within 1 month from the date of certificate of registration. Suppose if the application is not made within 30 days, then what will happen? The effective date of registration is the date on which they got the registration certificate, that will be taken. So if the application is not made within 30 days, then in that case, can the revised tax invoice be given? No, revised tax invoice cannot be given. That's an important point. Revised tax invoice cannot be issued if the application for registration is not made within 30 days from the date on which liability arises, because in that case, the effective date of registration as well as the certificate of registration is same date, and revised tax invoice cannot be issued in that case. Then receipt voucher. Receipt voucher will be arising in a situation whenever the payment is received before the generation of invoice. Suppose there is an invoice date, and before invoice date itself, if the payment is received, if the payment is received before the invoice date, then only, so to evidence that the payment is received, a receipt voucher should be given by the supplier to recipient. Receipt voucher. This receipt voucher. Is it mandatory? Yes, it is mandatory. When it should be given, they have not given any time limit, means immediately it should be given whenever the advance is received. So whenever the payment is received before the date of invoice, it is known as advance. So in case of advance, receipt voucher should be issued by supplier to recipient. What if the payment is received after the date of invoice? If the payment is received after the date of invoice, receipt voucher is not a condition. Receipt voucher may or may not be given. It is up to the discretion of the supplier. That is this receipt voucher. Then refund voucher, another concept is there. Same way, before the date of invoice, suppose if the amount is refunded, invoice is not yet generated. Before the date of invoice itself, the amount is refunded. In case when it is refunded, supplier should be giving a refund voucher. But based on the advance, if the GST is already paid, in case of services based on advance, GST is already paid. So whenever they give a refund voucher, they can get the refund of GST paid from the government. Then in case if the amount is refunded, after preparation of the invoice, then what they need to do? They need to give a credit note. Suppose if they cannot give a credit note, is there any alternative? Yes, there is an alternative, because credit note has got a time limit within 30th September, means 6 months. So 30th September of the succeeding financial year or data filing annual return, whichever is earlier. What if the time limit is crossed? Credit note cannot be issued. Then what is the alternative? Refund of tax. Either credit note or refund of tax. Refund of tax under what grounds? Under the grounds of excess payment of tax. That's a CBIC circular. So that is whenever you are giving the refund after the credit note. So then that is whenever the refund is given after the invoice date, either give the credit note or you can claim the refund. But credit note is only best because whenever we give the credit note, the liability in that month gets come down. Whereas in case of refund, when you make application for refund, so then there is a statutory time limit of 60 days. After crossing that 60 days, from 61st day, if they are not giving, then only they will be paying the interest. So that is about this refund voucher. And payment voucher. Payment voucher means whenever recipient is making payment to supplier, under RCM, whenever recipient is making payment to supplier, recipient should be giving a payment voucher to the supplier. Whether the supplier is registered or unregistered, payment voucher is applicable. But the invoice given by recipient to supplier will be applicable only when the supplier is unregistered. But payment voucher will be coming whether the supplier is registered or unregistered. And then next one, delivery challan. Delivery challan will be applicable whenever, so there is no supply but there is movement of goods without involving any supply from head office to branch office. Head office and branch office is not having a separate registrations within the same state, so then there is no supply but movement of goods is there. Goods sent on job work, there is movement but it is not for supply. When I am doing sale on approval or on return basis, there is movement but there is no supply. So quantity at the time of removal is not known. In these cases, a delivery challan can be given along with the goods. So it's not a option, it is compulsion. So definitely the delivery challan should be issued, and along with the delivery challan, e-way bill also should be there, because e-way bill is applicable whether the movement is for supply or without supply. So if the goods are liquid gas where the quantities at the time of removal is not known, or if the goods transported for job work or any other transportation other than by way of supply, in that case supplier will be giving a delivery challan to the recipient. So this chart, whatever I have discussed, I have already given. So before the date of invoice, if the payment is received, receipt voucher, and if it is goods, no need to pay GST. If it is services, GST is payable on advances. After the date when payment is received, supplier may issue receipt voucher to recipient, and when the amount is refunded, so before the date of invoice, refund voucher. And in case of goods, no refund. Why no refund can be claimed? Because first of all, they have not paid tax. But in case of service, already GST paid on advances. So whatever GST paid, they can claim it as refund. Whereas suppose if the amount is refunded or supply is cancelled after the date of invoice, in that case, two options are available. What is that? Either they can give a credit note and liability gets reduced, or option 2, they can go for refund. So then section 32, already I told you that an unregistered person is not supposed to collect GST from the recipient. Then HSN code in invoice. How many digits should be entered? Remember, definitely it can be tested in MCQs. In case the aggregate turnover during the previous year does not exceed 5 crores, then 4 digits. That too only in case of B2B. If the aggregate turnover during the previous year exceeds 5 crores, 6 digits, both in case of B2B as well as B2C. What is the total number of digits in HSN? 8 digits. For SAC, service accounting code, in case of invoice, it is service accounting code for services, but there is no restriction with respect to that 6 digits, means 6 digits should be entered. So, but there is no relaxation from entering lesser digits. But in case of HSN, they have given that 4 digits, 6 digits. But remember, Only in case of B2B 4 digits. That too in case of aggregate turnover does not exceed 5 crores. When the aggregate turnover exceeds 5 crores, 6 digits, let it be B2B or B2C. Then E-invoice. E-invoice refers to what? E-invoice refers to obtaining for a normal invoice 3 things by converting the normal invoice into a JSON file. First step is that we need to prepare an invoice as per normal billing software. Then we need to convert it into a JSON file. That JSON file, so .js1 JavaScript object notation. So that should be uploaded into the invoice registration portal, IRP. After uploading it in the invoice registration portal will do the deduplication check. This is the chart. Invoice portal will do the deduplication check. After doing the deduplication check, so they will be giving back this e-invoice along with 3 things. There will be 3 strings attached to that invoice. So that is number 1 invoice reference number, number 2 digital signature, and number 3 QR code. So then this invoice will be going to 2 places, that is GST portal as well as e-way bill portal it will go. So in the GST portal, GSTR 1 of the supplier is updated and GSTR 2B of the recipient is updated. In e-way bill portal, automatically the data will be captured and no need to again do the data entry for generation of e-way bill. So this is the process of e-way bill. Process will definitely not be tested, don't worry. Okay, I have just given to you for idea purpose, because they also know, suppose if at all they are asking a question for e-invoice process for 4 marks, easily one full page also you will fill, because that is simple, that and all they will not ask. And what they will be testing is on to the to whom e-invoice will be applicable, what is e-invoice, etc. So e-invoice is simple, obtaining 3 things from the invoice registration portal. What are they? Number 1 invoice reference number, number 2 QR code, and number 3 digital signature. And to whom e-invoice is applicable? Any person whose aggregate turnover during any previous year from 2017-18 to 2000, so actually 21-22. So it is not 2021, 21-22, because this 20 crores is with effect from 1/4/2022. So due to that reason, we need to also include the financial year. We need to also include, so 2021-22. So any financial year from 2017-18 to 2021-22, if it exceeds 20 crores, in that case, so definitely e-invoice will be applicable only for B2B supplies. If it does not exceed 20 crores, then it is optional for them whether to give e-invoice or not. Suppose if e-invoice is applicable, but they have not given e-invoice, that is not called as a valid invoice. So recipient cannot enjoy the ITC with respect to that. Then there is a concept called as dynamic QR code. The dynamic QR code is the payment should be collected only by scanning the dynamic QR code. But that dynamic QR code is not generated from the portal. The dynamic QR code is generated using the payment gateway only. And this dynamic QR code, whenever the payments are to be collected only through dynamic QR code, to whom that is applicable? That is applicable for B2C supplies of a person, registered person, whose aggregate turnover during any previous year from 2017-18 to 2021-22 exceeds 500 crores. So then only dynamic QR code will be applicable, exceeds 500 crores. Whereas e-invoice is applicable once it exceeds 20 crores. And remember, e-invoice is for B2B supplies, and B2C supplies, it will be dynamic QR code. And how the invoice should be prepared in e-invoice? There is a particular format in which the e-invoice should be prepared, that is form GST INV1. And invoice can be prepared through any billing software, any accounting software. And e-invoicing is optional for a taxpayer whose aggregate turnover during previous year does not exceed 20 crores. And e-invoice gets auto-populated in GSTR1 and e-way bill, that already we have seen. And whenever we are generating e-invoice, so whether physical copy of invoice should be transported, because generally the goods, when we are transporting, the invoice should be given in triplicate. So original for the buyer, duplicate for the transporter, and triplicate for the owner, that is supplier. Whereas in case of services, only 2 copies, that is original for the recipient, duplicate for the supplier. But this copies of invoice is not applicable if e-invoice is generated. So the transporter who is transporting the goods can make available the invoice reference number to the officer whenever he intercepts the conveyance. So that is sufficient, and there is no need to copy the no need to carry the physical copy of the invoices. Or alternatively, all these invoices, e-invoices, can be mapped to a RFID device which is installed in that particular vehicle. So then also no need to carry the physical copy of the invoices. That is this. Then what are the types of transactions for which e-invoice is required? B2B transactions, only outward supplies. only for outward supplies, B2B transactions, e-invoice is required. For inward supplies, not required. For zero rated supplies, e-invoice is required. What is zero rated supplies? That is exports and supplies to SEZ, e-invoice is required. For credit notes and debit notes also required. B2B invoice containing both taxable and exempted goods, then also definitely it is required. That is, but this is actually a hypothetical situation. Whenever it is a B2B invoice containing both taxable and exempted supplies, they need to prepare two documents. One is tax invoice. The tax invoice is for what? The tax invoice is for taxable supplies. And second is bill of supply. That bill of supply is for what? For exempted supplies. They cannot give a single invoice come bill of supply. In case of B2C supplies, they can give single invoice come bill of supply. But for B2B supplies, definitely they need to give tax invoice and bill of supply separately. And this tax invoice should be e-invoice. But this bill of supply need not be in e format, because for bill of supply and or that is invoice registration portal concept is not applicable. Only for the tax invoice, that is this. Then dynamic QR code. Dynamic QR code, static QR code is like any scanning you do, the amount you need to enter and make the payment. And for irrespective of the amount or invoice, the code will be same, that is known as static QR code. Whereas dynamic QR code means with respect to every invoice, it will be changing. What are the entries that should be entered to generate a dynamic QR code? Number 1, GSTN of the supplier. Number 2, UPI ID of the supplier. Number 3, IFSC code and bank account of the supplier. And then these three will be constant, it will not change. For in every dynamic QR code, these three entries will be same. Whereas invoice number and date, so that will be changing for every invoice. And number 4, invoice amount with breakup of tax. So these are the 4 entries that should be entered into the generation of dynamic QR code. After entering these 4, once we generate a dynamic QR code, so that should be mentioned in the invoice. Through that only we need to collect the payment. However, there is an exception for dynamic QR code itself, not required in case when the payment is collected before the invoice. When the payment is collected before the invoice, no need to mention the dynamic QR code or no need to collect the payment by scanning dynamic QR code. But the payment received before invoice, that reference should be mentioned. So that is, whenever you make a shopping in supermarkets, so whenever they will be going to the, you are going to the billing counter, so they will be asking whether the payment should be by card or cash. Suppose if you are telling card, so they will ask you to give the card, they will enter and the last 4 digits of the card will be entered in the invoice. Cash payment means the date on which cash payment is received also will be mentioned, mode of collection, cash, like that they will be mentioning. Suppose if the payment is generated, made after invoice, for example in Amazon or any other place, e-commerce portal, when you are making purchases and thereafter the invoice is already generated, so now it will be pay on delivery option. So when the person comes to your house and for collection of amount, you will say GPay. So now he will enter the details and he will show his device. In that one QR code is there, the moment you scan that QR code, along with amount it will come, you will not enter any amount. So that is known as dynamic QR code. As invoice is already generated, the payment should be collected by scanning the dynamic QR code, that is this part. If payment is received before at the time of generating invoice, and cross reference of such payment received is mentioned in the invoice, then dynamic QR code is not required. Then next one, for UPI ID, what is the exception? In case the payment is not collected by the supplier but collected by a e-commerce operator or any other agent, so a courier agency or e-commerce operator is collecting the payment, then in that case the UPI ID of that courier agency or e-commerce operator should be given, but not the supplier's UPI ID. Then whenever UPI ID is linked to the bank account of the supplier, in that case there is no need to enter the bank account and IFSC code of the supplier. Then invoice number and date, when it is practically not possible to enter the invoice number and date because it is a retail supermarket wherein multiple counters are there, cash counters, sales counters are there, or cash counters are there, or billing counters are there. In that case, one unique number may be adopted for the purpose of entering in dynamic QR code, that is this. Then invoice amount along with breakup of tax. For example, if part amount is already collected before the invoice, if remaining amount is collected after invoice, then dynamic QR code should be for what amount? Only for the remaining amount, because there is an exception that if amount is collected before invoice, dynamic QR code is not required due to that reason. Then there is one latest amendment in this regard, that is, in case of export of goods and export of service, always which one will be required? E-invoice is required. Suppose if e-invoice is not required, then only dynamic QR code will come into the picture. Here there is a challenge. That is, it is a transaction which is not an export of service, but the payment is received in foreign exchange. How the payment will be received in foreign exchange when it is not export of service? Supplier in India, recipient is outside India, but the place of supply in India, so it is not export of service, but the payment can still be collected in payment in foreign exchange as the recipient is located outside India. When e-invoice is not applicable, then dynamic QR code is applicable, but in this case, both e-invoice as well as dynamic QR code are not applicable. That is the clarification. Location of supplier India, location of recipient outside India, place of supply in India, and payment in convertible foreign exchange. So it is not export of service. When it is not export of service, logically dynamic QR code should come, because in case of export of goods and export of services, e-invoice applicable. If it is otherwise, dynamic QR code should come, but in this case dynamic QR code also not required. That is a clarification. That's the latest amendment. Then to whom e-invoice and QR code, dynamic QR code is not applicable. Already this is tested. Okay, so to whom dynamic QR code is not required has been tested. So but e-invoice can be tested. So to whom it is not applicable? E-invoice, you remember, biggest. B for banking company, I for insurance company, G for government department, another G for government department or local authority, another G for GTA, goods transport agency, then E for exhibition of film in a multiplex theatre, S for SEZ unit, not SEZ developer, only SEZ unit. SEZ developer means a builder who maintains that SEZ, not that, only SEZ unit. And then T for transportation of passengers by any mode. So in case of transportation of passengers by any mode, so airlines also will be coming. So no need to give e-invoice. For B2B supplies. Cinema theatre, definitely their turnover during previous year exceeds 20 crores, but e-invoice not required. Like that, these cases, even if their turnover during any previous year exceeds 20 crores, e-invoice is not applicable. Whereas in case of B2C, dynamic QR code, even if the aggregate turnover exceeds 500 crores during any of the previous financial year, then in that case, so e-invoice, that is dynamic QR code not required. For big toe, B same, I same, banking company, insurance company, government department or local authority, GTA, and then T also same, that is transportation of passengers by any mode. O will change. There S is there, in the place of yes we have O, that is OIDR supplier located outside India making supply to non-taxable online recipient. E is also same, that is exhibition of film in a multiplex theatre. So except to this, everything will be same. That is, to whom e-invoice is not applicable, to whom dynamic QR code is not applicable. With this, we completed invoice and time of supply. So now look into I think what's the next area? Payment process, returns and all is also over, accounts and records. Yes, refunds under GST. Segment 19, page number 124, refunds under GST. So let me clarify the queries. So goods received in lots, can we issue one invoice? Yes, invoice can be one, but that invoice should be given only at the time of last lot. That's why recipient also can take ITC only on the time of last lot. Then next, whether the condition of crediting payment within 4 working days is applicable only for section 14? Yes, applicable only in case of section 14. For 12 and 13 we don't have that condition, mainly because lot of people will escape from payment of tax at the new rate when the new rate is higher by just passing an entry even though they have not received the money. To avoid those kind of escape routes only, they are telling that, so the date on which payment is credited only will be taken as the date on which payment is received. But they are giving a grace days of 4 working days. Suppose if you pass an entry before change in rate and thereafter if you ensure that the payment is created within 4 working days, super, so the entry date only will be taken as the date of payment, so we can enjoy the benefit of old rate. For that purpose only they created that provision. Then look into refunds under GST. So these are the 10 alternative possible ways with which a person can get the refund, but this is just the illustrative list. And not only this, in any other case, if the refund is if the refund is eligible, when the refund is eligible, tax is paid in excess, they will be eligible to get the refund. So what are the 10 cases? Refund of IGST paid on zero rated supplies. What are zero rated supplies? Export of goods, export of services, supply of goods or services to SEZ is known as zero rated supplies. At the time of making zero rated supplies, we have two options: export upon payment of IGST and get the refund of IGST, or export without payment of IGST and get the refund of unutilized ITC. So I am talking about which case, first point. So refund of IGST paid, which means export or supply to SEZ upon payment of IGST. Then refund of unutilized ITC. So what are the cases where we are eligible to get the refund of unutilized ITC? Two cases. One is zero rated supplies, just now we saw. Another is inverted tax structure. What is inverted tax structure? The tax rate on outward supplies is less than the tax rate on inward supplies. Is it not the tax payable? This is the tax rate. Then refund on account of deemed exports. There are some transactions which are considered as deemed exports. In case of deemed exports also, that is, goods are not actually being sold outside India, but the goods are sold to a person who in turn exports. So for the person to whom we are selling is an exporter. So for us it is deemed export. So in that case also we have a refund. Refund of tax on account of wrong classification, classifying intrastate sale as interstate sale and vice versa. So we pay the correct tax and we get the refund of the wrong tax. For that it is possible. Then refund of balance in the electronic cash ledger. So whenever we have deposited excess money into the cash ledger, even CTP and RTP is required to pay advance tax. So there is an excess amount in the cash ledger, or by mistake we deposited more money into the cash ledger, but we have lot of money in the credit ledger for adjustment with the liability. So we can get the refund of balance of cash ledger. Then refund on account of issuance of refund voucher. Just now we discussed, whenever we collected the money before invoice, so for that we will give a receipt voucher, and whenever we refund that amount before the date of invoice, we will give a refund voucher. On that advance, if GST is already paid, in case of services, in case of goods, no need to pay GST on advances. In case of services, whatever GST already paid on advances, we will be getting the refund based on refund voucher. That is this. Then refund of GST paid by duty free shop or duty paid shop in an international airport. In international airport, there will be DFS or DPS. So duty free shop or duty paid shop, they will be importing the goods either with payment of duty or without payment of duty, and they will be keeping the goods in their shop and they will be selling. Now these shops can make local purchases also. When they are making local purchases, there is no exemption, GST is chargeable. But these shops, when they are selling to tourists who is living outside India, so that sale to tourist is exempted from GST. But on their inward supply already they paid GST. So to get a refund of the GST only, this point is created. So that is refund of GST paid by duty free shop or duty paid shop in international airport. Refund on account of provisional assessment. So whenever we are making application for provisional assessment, so upon finalization, if the final assessment amount is less than the provisional assessment amount, so that amount we can get as a refund for that. Refund on account of judgment or order. So whenever court passes an order or judgment, so for the purpose of making payment of tax, we paid the tax and we went for appeal. Suppose if we have paid some tax which we are not supposed to pay and the case is in our favor, so that amount will be refunded by the court or tribunal's order, that is this. And refund to unique identification number holder. UN holder, UN embassy, consulate, etc. Their outward supplies are exempted, and on their inward supply whatever GST they paid, that they can get as a refund for this 10th point. Apart from this, any other cases also, refund can be claimed under the grounds of excess payment of tax. These are the various refunds, but there are some provisions which are common in all these cases. There are some provisions which are different for different situations. Now, we will try to understand, so what are the difference in the provisions, and at the last I have given what are the common provisions. So after this, procedural aspects, that procedural aspects are common with respect to the refunds. So this is the best possible reduction I could make in refunds, because refund study material is very, very big, and even in the class also I will be taking minimum 6 to 7 hours, 2.5 sessions I will be taking for the purpose of completing this. Okay, so due to that reason, lot of information is there, but so trust me, this much is sufficient. This much is sufficient, so that lots and lots of information that contains general knowledge, other knowledge, scolding finance minister, everything will be there in that. But in this nothing, so this much only sufficient. So at least this much you listen, prepare this much and go for the exam. So see this. First, refund in case of zero rated supplies. Again, we have divided into two, exports and supplies to SEZ. In case of exports, what will happen? There are two options already we know. Upon payment of IGST or without payment of IGST under bond or LUT. upon payment of IGST or without payment of IGST under bond or LUT. Now in this case, so what will happen? We will get the refund. First option we will get IGST refund, second option we will get ITC refund. First case when we are getting IGST refund, in case of goods, that refund is not processed by the GST officer, but that refund is processed by the customs officer. For that purpose, one document needs to be filed at the time of export with the customs, that is known as shipping bill. So once we file shipping bill, in that itself we mentioned upon payment of IGST, that is sufficient, we will get the refund. But how customs department will come to know that we have really exported? So they will be checking the export manifest, departure manifest or export report. Export manifest is a document which is to be filed for the purpose of export of goods by vessel. Departure manifest is a document which is to be filed in case of exports by aircraft. And export report is a document to be filed in case of exports by vehicle. This document is not filed by us. This document is filed by the person in charge of the conveyance with the customs officer. And whatever shipping bill we file, so then we are telling that we are exporting, but is it really taken outside India or not? They will cross check with the departure manifest, export manifest or export report which is filed by the person in charge. If these goods are present in that, which means the goods are taken outside India. So therefore goods are exported. Second, he need to also check whether we have paid GST. So he will be checking our GSTR 3B. In that GSTR 3B, there in outward liability, there are multiple rows. In that multiple rows, 3.1B, export upon zero rated supplies upon payment of IGST is there. There we need to enter. The moment we are entering there, customs officer will come to know that yes, this idiot has exported and this idiot has paid. So then we will give the refund to this idiot. So that's it. That is about the shipping bill. Whereas in case of export of goods without payment of IGST under bond or LUT, which means IGST payment is not there, so shipping bill will not be processed, which means that we need to separately go for refund, and that refund will be by filing regular refund application RFD1. In all other cases, it's a regular refund application RFD1. For services, first of all, customs department will not come into the picture, so therefore only GST officer will sanction the refund, so therefore RFD1. And conditions, whenever customs officer is processing the refund, the customs officer will check whether the goods exported are mentioned in departure manifest, export manifest or export report filed by the person in charge of the conveyance. Then even his 3B also will be verified, so whether he has made the payment of tax. This much only you need to remember in case of exports of goods or services upon payment of IGST option. Then supplies to SEZ upon payment of IGST, simple. So here also we have two options. One is pay IGST, get the refund, or refund of ITC. So refund application RFD1 only. But here there is an important document that should be given along with the refund application. What is that important document? That is SEZ officer certificate. Whenever we are making supplies to SEZ, we need to get a certificate from SEZ officer stating that we are making supplies only to an SEZ authorized operations, and therefore without SEZ officer certificate we will not be able to get the refund. That is this. So the supplier will have to file a refund claim, and the application shall be filed by supplier of goods after the such goods have been admitted in full by the SEZ specified officer. Whereas services also same. In both goods and services we need to get the specified officer of the zone certificate, so that these goods are used for authorized operations. Then only we will get the refund, otherwise we will not get the refund. So that is this. This much only you need to remember. Then whether export upon payment of IGST or without payment of IGST under bond or LUT, whether this bond or LUT is applicable even in case of exempted goods. Remember, for exempted goods we don't have two options. For exempted goods only one option, because upon export of exempted goods, they are exempted goods, but the moment when it is exported, it will become zero rated. When it becomes zero rated, then are we eligible to get the refund? Yes, we are eligible to get the refund, but only one option. Which option? Upon payment of IGST option not there. Why upon payment of IGST option not there? Because where we have GST on exempted goods, there is no GST. Therefore, the only option is under bond or LUT, and we will get the refund. But here, for goods, they gave a relaxation. Bond or LUT is not required. So as per circular 45/19/2018, there is no need of bond or LUT. So means even without bond or LUT, if you export goods also, but it is exempted goods, we will get the refund of ITC. But for services, export of exempted services, definitely bond or LUT is required, then only we will get the refund of ITC. Remember, when it is duty taxable goods under GST, taxable service under GST, both the options we have. What are both the options? Upon payment of IGST or under bond or LUT, that is refund of IGST, refund of ITC. But in case of exempted goods or services which are exported, only one option, that is option 2, that is refund of ITC option. Then look into the second one, refund of ITC. How to calculate the refund of ITC? We need to take net ITC into zero rated turnover divided by adjusted total turnover. So is this the refund that we will get? No, this is the maximum refund that we will get, which means that this maximum refund is subject to balance in the credit ledger. Even though we are eligible for 2 lakh refund, but that much of balance is not there in the credit ledger, we have spent. So then we are eligible for refund only to the extent of whatever is there in the balance. So because this refund is subject to the condition that you are maintaining that much of balance, because this is not a refund of tax paid, this is a refund of unutilized ITC, means there should be some unutilized ITC, then only we will get the refund. How to calculate this formula? Maximum refund, net ITC into zero rated turnover by adjusted total turnover. And in net ITC, what should be taken? Can we take opening balance? No, we should not take opening balance. Then what we need to do? We need to take only this particular, what is the month for which we are filing this RFD1 under this. So for that month, what are all the inward supplies we have made? So those inward supply details only should be mentioned during the month, and opening balance of ITC should not be taken. Also on capital goods, we will not get the benefit under this particular case. Means net ITC means what? Only the inward supplies, inputs and input services during the relevant period, and inputs and input services, we don't have capital goods, minus ITC refund under 89(4A)(4B). Then what should be taken as zero rated turnover? Zero rated turnover means zero rated turnover of goods plus zero rated turnover of services. And when it is zero rated turnover of goods, we need to make one comparison. What is that comparison? Whatever is the export value of goods or supply of goods to SEZ should be compared with value of like kind of goods sold in the domestic market multiplied with 1.5. Whichever is lower only should be taken, because a lot of people are inflating that. So for that purpose only they are telling that it should be restricted to 1.5 times of the value of such goods domestically supplied by the same or similar place supplier. Not necessarily the same supplier, similarly placed supplier, some other supplier also can be taken. Whichever is lower only should be taken as the value. Because for example, if the ITC is 1,50,000 and if the export turnover is 20 lakhs, and then the adjusted total turnover is say 100 lakhs. So then how much refund we will be getting? ITC refund. So that is 30,000 we will get. Whereas if I inflate the export value to 40 lakhs divided by 120 lakhs, definitely it is not 30,000, more than 30,000. 1,50,000 into 40 by 120. How much? 50,000. So when people try to inflate this, that's where they are telling it should be restricted to 1.5 times the value of such goods sold in the domestic market. Okay, that is this. But it is not necessarily by the same supplier, it can be by similarly placed supplier. And this is applicable in case of zero rated supply of goods, means it is common for both exports and supplies to SEZ. And here we should take out supplies in respect of which refund is claimed under 89(4A)(4B), and we should take zero rated supplies made without payment of IGST. In the numerator zero rated turnover, we should not take zero rated turnover upon payment of IGST. We have two options. Upon payment of IGST, already we claimed that, so that should not be taken into numerator. Then what should be taken into numerator? We should take only zero rated supplies made without payment of IGST. Then only we will get the refund. Upon payment of IGST, where we will get the refund? Already you claimed the refund. Again, you cannot take the benefit here. That is another point. They will give both. Exports upon payment of IGST, exports without payment of IGST. But in numerator, we need to take only exports without payment of IGST. Then next, turnover of zero rated supply of services. When we take zero rated supply of services, we need to take zero rated supplies made without payment of IGST only again. Upon payment of IGST, we should not take. Then how that should be computed? Payments received during the period. How much payments are received during the period? Because in case of services, we can get the refund only upon receiving the money in Conex. Otherwise, we will not get the refund. So that's why they are asking us to rebuild the value based on payments received. how much of payments received during the period, minus advances with respect to which supplies are not made. So we may receive some advances which are related to future supplies, take out. Add advances received during the past for which supplies are made during the current period. So that should be taken. It is like payments received during the current period pertaining to supplies during the current period. You understood or not? Payments received during the current period pertaining to supplies during the current period. So that's why we are reducing the advances for which supplies are yet to be made in future and adding back, because we excluded like this even in the past. So that's why we are adding back those advances for which supplies are made during the current period. So this adjustment we need to make. And then here adjusted total turnover. Adjusted total turnover includes turnover of zero rated supply of goods minus exempted supplies. Exempted supplies will not be taken. Logic is correct, because the moment you take ITC, this ITC is only for our outward supplies which are taxable. Whenever we take ITC, when our outward supplies are exempted, we will not take ITC. So which means in the turnover related to that ITC, definitely exempted should not be there. Where from we are taking ITC on exempted supplies pa? When my outward supply is exempted, can I take ITC related to that? No. The moment I say ITC, in my outward supply there is no exempted. Means that ITC pertains to which outward supplies? Taxable outward supplies. That's why we should take out exempted supplies. Minus supplies for which refund is claimed under 89-4A-4B. So this is the meaning of refund, maximum refund. Then when you take ITC avail, which ITC avail? Matched ITC. Matched ITC, eligible matched ITC. Eligible matched ITC means whatever is there in 2B minus blocked credit minus ineligible credits used for exempted, used for non-business purpose. Then add back GST paid under RCM. So that should be taken into ITC avail. Eligible matched ITC. Eligible matched ITC. Then now there is one 89-4A-4B. So multiple places it came, not multiple places, exactly 3 places it came. Number 1, from ITC also we are taking out, and thereafter we are taking out in the numerator zero rated supply of goods. Then in the denominator also adjusted total turnover we are taking it out. What is first of all this 89-4A-4B? 89-4A-4B is related to refund on account of deemed exports. Now you have to concentrate, no other go. If you sleep, better sleep for some time. So, but don't be in the middle, okay? So, either sleep or be with full attention, listen. So, that is, I am making supplies to you. When I am making supplies to you, you are an exporter, I am deemed exporter. Whenever I am making supply to you, I will collect the GST from you. Whenever I am collecting GST from you, you will take it as ITC. Now, instead of going it under refund of ITC, there is another alternative applicable to you. That is, then and there you can get the refund. No need to export. No need to export, no need to export and get the refund of ITC under this formula, but immediately you will get the refund. That is known as refund on account of deemed exports. What is refund on account of deemed exports? Whenever I am making supply to you, who the hell you are? Exporter. And I am deemed exporter. Whenever I am supplying to you, where am I located? India. Where are you located? India. We both are in India only. So then it is not an export for me. Then what it is? Deemed export. Whenever I am making deemed export to you, I will collect GST from you. I will treat it like a normal sale. When I treat it like a normal sale, you will be taking it as ITC. And that ITC, you don't have to wait till the time you export. If you wait till the time you export, that ITC into zero rated turnover divided by adjusted total turnover. This bloody stupid zero rated divided by adjusted total turnover logic is missing. I am purchasing something used only for export, then also I need to take proportionate. I am purchasing something, using it only for export, then also I need to take proportionate. Okay. So therefore, I am purchasing 80% of the materials which is used exclusively for export, and I have also domestic. In the domestic, this material is not at all used. Even then, the formula only. This formula is not like input wise, not T1, T2, exclusively for taxable exclude, common credit you take proportion. No, only one formula we have, where we have the steps like that. No, T1, T2, T3 you take out, T4 you take out, common credit into exempted divided by total. Where we have that full whatever you purchase, sir, used fully for export, let it be, take formula only, into 0 rated by adjusted total turnover. Then those kind of exporters will go for deemed export refund option. What is that? I am making some purchases. That purchase is exclusively used for export. Why should I deduct this? Why should I do this formula? If I do this formula, I will not get full amount. For example, I paid 2 lakhs and 2 lakhs into export turnover by 0 adjusted total turnover. I will not get full refund. So due to that reason, what I need to do? I need to go for deemed export. When I go for deemed export, in case of deemed export, they are telling whatever you paid. How much you paid? 2 lakhs you paid. How much refund you will get? 2 lakhs. Full 2 lakhs you will get. Full 2 lakhs you will get under deemed export option. Now you claimed there 2 lakhs na. Again don't put it here. That's why you need to take out from the ITC. And you made a turnover na, export turnover using this. Using this you made a export turnover. Take it from the export turnover. When you take it from the numerator, take it from the denominator. That's how math says, okay. So whatever is taken from the numerator, the same should be taken from denominator also. Purida Iliapa. So tell me, what are the 3 places from where we should take it out? Net ITC minus ITC under rule 89(4A)(4)B. 0 rated supply of goods minus turnover using 89(4A)(4)B. Correct or not? Denominator turnover minus adjusted total turnover minus supplies which are covered under 89(4A)(4)B. This 89(4A)(4)B is like venom. Venom. Have you seen Spider-Man? In Spider-Man movie, so how a red color Spider-Man, goodbye will be there, venom will come and it will be going on his body. So fully it will make him dangerous. So already you have claimed refund. Again if you claim refund, dangerous, erroneous refund, penalty, imprisonment, many things get subtracted. So take it out. Take it out completely. How the effect will be taken out? Where and all it is there, completely you should take out. Where and all it is there, ITC it is there, take out. Turnover it is there, take out. So therefore, now you will get a good Spider-Man. Even though Venom is a hero, but in a different universe. So take him out to that universe. That is separate refund. You understood or not? Then, say this, case 2. Maximum refund in case of inverted tax structure. How to calculate this? So far what we have seen is on account of 0 rated supplies. Now inverted tax structure, net ITC into inverted rate turnover divided by adjusted total turnover. So why? First I need to get how much of my input tax credit pertains to inverted turnover. And what is inverted turnover? The rate of GST on outward supply is less than the rate of GST on inward supplies. How much of my input tax credit pertains to inverted turnover I need to find. So after finding it, from that I will be seeing how much of the tax already I have paid. For example, I have inputs, and remember in this case ITC is only inputs. ITC is only inputs, only inputs, not capital goods, not input services, only inputs. So inputs is 1 lakh. On that 12% is paid. That will be equals to 12,000 rupees. So now using these inputs, I made 2 turnover, inverted turnover and non-inverted turnover. Okay, non-inverted turnover means what? That is the rate of GST on outward supply is more than or less than? More than the rate of GST on inward supply. Then what is inverted? The rate of GST on outward is less than. Then only there will be unutilized ITC. Correct or not? Say the inverted turnover is 20 lakhs. And on this 20 lakhs, the GST payable will be 5%. Okay. So then, non-inverted is 30 lakhs. On that non-inverted, the rate of GST payable will be 18%. Okay. Like this it is there. Now what we need to do? First we need to find out of this 12,000, how much pertains to inverted. How to calculate? 12,000 into 20 by 50 equals to 12,000 into 20 by 50, 4,800. And what is 20 lakhs into 5%? 1 lakh. So definitely we don't have any unutilized ITC. Why we don't have unutilized ITC? Sir, whatever is the ITC pertaining to this, the GST liability on inverted turnover is 1 lakh. We don't have unutilized ITC, so no refund. When we will get refund? Now I am modifying this. This 20 lakhs, 30 lakhs, I am taking to 2 lakhs and 3 lakhs. Now, same. So 2 by 5, 2 by 5. So 4,800 only. Now, 2 lakhs into 5%, 10,000. Now also, okay. Then when sir there will be refund? So usually inverted rate turnover, refund will come only when our liability is too small. Okay, too small a liability, then only will come, or the inputs is somewhere like 3 lakhs. So 3 lakhs into 12%, 36,000. So 36,000 into 2 by 5. 36,000 into 2 by 5. 14,400 minus GST payable on 2 lakhs. 10,000, that equals to 4,400, we will get as refund, that is this. And what is the meaning of adjusted total turnover? Same as above, whatever we have seen above, the same meaning is the adjusted total turnover. And remember, so it should not be ITC on capital goods or input service, it should be only inputs, that too not opening balance of inputs, inputs purchased during the month. Then this refund of ITC is not available in 2 cases. What are the 2 cases? Export on payment of export duty. Sir, you are exporting. That export is subject to export duty. When exports are subject to export duty, there are some goods on which we need to pay customs duty on export. Then you will not get this option. Which option you will get? Only one option. First option, upon payment of IGST. Avails duty drawback. That is relevant now, because in duty drawback clearly they are telling that the duty drawback is not given for the purpose of IGST, which means that this point is practically irrelevant now. Only one condition you need to remember. What is that? When refund of unutilized ITC not applicable, if exports are subject to payment of export duty, customs duty under export, then refund of ITC not available. Then deemed exports. What are considered as deemed exports? So you remember 3 points, basically 3 points. I am a person. I am selling to a person who is having advance authorization. Who will have advance authorization? If you are an exporter, then advance authorization will be given to you under DGFT, Directorate General of Foreign Trade, for the purpose of import without payment of customs duty or local purchases without payment of customs duty. Now, under that advance authorization, you can buy from me. So, which means for me it is deemed exports. Again, I am repeating, you are an exporter and you are having advance authorization. Who gave you that advance authorization? DGFT, Directorate General of Foreign Trade, under FTP. So, that advance authorization, if you have, what is the meaning of that? Either you can import goods without payment of customs duty, or you can locally procure goods without payment of GST. Now I am supplying goods to you. For me it is deemed export. Same way, you have EPCG license. EPCG license means Export Promotion Capital Goods license. That will be given by whom? DGFT, under foreign trade policy. If you have EPCG license, what does it mean? It means that you can import without payment of capital goods. You can make without payment of like customs duty capital goods, and even you can buy the capital goods locally without payment of GST. Now if I am selling capital goods to you, for me it is deemed export. Or you are a export oriented unit, you get the status as EOU from foreign trade policy. So DGFT only will give you that status as EOU. Now I will be selling goods to you, for me it will be called as deemed exports. So what are 3 deemed exports? Supply to AA holder, supply to EPCG holder, and supply to EOU. Goods or services are both are only goods. We don't have services in deemed exports. Only goods we have in deemed exports. What are the benefits in case of deemed exports? Already I told you this. What are the benefits in case of deemed export? Option 1 I did not tell. Option 1 is, again listen. You are one exporter. I am one person located in India. I will be selling goods to you. Option 1, I will not recover any GST from you. I will pay it to government. I will get it as a refund. That is option 1 for me. Under this option, what is the tax burden on you? 0. You did not pay any tax at all. Option 2, that I discussed already. I will recover GST from you. Treat it like a normal sale. I will pay it to government. Now you will get the refund. Got it? Recipient paying to supplier, supplier paying to government, from government you will get as a refund. Triangle, okay. This triangle series is known as option 2. And single, I will not at all collect GST from you. I will pay, I will get as a refund. That straight line is option 1. You understood or not? So these are the 2 options. in respect of supplies regarded as deemed export, who will claim the refund? Who will claim the refund? Option 1, who will claim the refund? Supplier. Option 2, who will claim the refund? Recipient. Either recipient or supplier are allowed to file the refund application. The supplier can seek refund only where the recipient does not avail ITC on such supplies and furnish an undertaking that supplier may claim refund. Means what? Means the recipient is not taking ITC, means recipient takes ITC and claims the refund. When you will take ITC? When you will take ITC? If I charge, you will take, correct or not? When I am not charging, how will you take? Correct, yaar. So means it's nonsense, yaar. One person high on weed sit and write this provision pa. So that and all we don't have to. Simple logic. Will I collect first of all GST from you under option 1? No. When I am claiming refund, why the declaration is required? God only knows why the declaration is required. Supplier only claiming refund means supplier not charging GST to recipient. So recipient should give a declaration that recipient will not go for refund. You will laugh at me. Sir, first of all you did not charge GST to you. How we will go for refund? No, like that we should do, but that is GST for you. Then refund on account of wrong classification. This is like by mistake we treated intra as inter or inter as intra and we paid. Okay. Then we have to pay the correct tax and then we need to get the refund of wrong tax. What is the time limit for refund application? 2 years. Usually the time limit for refund application is 2 years. But the 2 years should be counted from the payment of wrong tax, the correct tax, correct tax, not the wrong tax. From the time when you pay correct tax, then only the refund will arise. So therefore, we need to count it from the date of payment of correct tax. Now, who can find this? Intra as inter, inter as intra. Either suo moto, that person can find, or officer can identify and tell. So both cases they can go for refund. Either identified by taxpayer or by the officer. Usually state government officers will find this and tell because their revenue only gets affected. And refund of wrong tax paid not available if the taxpayer has made tax adjustment through credit note. Suppose in the credit note already I made the adjustment. So invoice I gave for intra and I gave a credit note for this invoice under inter. I made already the adjustment. So which means at the time of payment of tax I would have paid under CGST, SGST only. So no issue. Got it? Again I don't have to go for any refund etc. And even PMT 9 already I adjusted, no need to go for refund. So when this refund will come, already the tax has been paid under the wrong head. When I paid it under the wrong head, then only this will arise. Okay. Suppose if I give a credit note after I have paid, yes, I can do that. So that's what they are telling. If you don't want to go for refund, in the credit note itself you can do the adjustment. Means in credit note what I will do, I will treat it like intra. That is interstate first I treated, now I treat it as intra. So therefore automatically there will be minus balances that will be coming in the liability. Okay. So that way also I can do, that is this. Then this is being rocket revision, that much of portal and all I cannot open and show pa. So try to understand. Then refund to UIN holder. This refund to UN holder is, there are specialized agencies of UN, embassy or consulate, their outward supply is exempted on their inward supply, either import or local supplies, whatever GST they paid, that GST they can get it as a refund. That is known as refund to UN holder. But these people are required to claim refund by filing one form called as RFD 10. And along with RFD 10, they should show the details of all their purchases in one return called as GSTR 11. And in every invoice, the UIN holder number, that UIN number should be there in the invoice given by the supplier. Then only the refund will be processed. Means whenever they are making purchases, they need to ensure that their ID, UI, that is unique identification number, is mentioned in the invoice. What if it is not mentioned? Is there any relaxation for that? Yes, one circular has been given recently stating that if that invoice is attested by the authorized representative of the applicant, then they will process the refund claim. Got it? Generally, there is a condition that all the purchase invoice of the UIN holder, in that purchase invoice, the GSTIN, that is UIN of the UIN holder should be there. If it is not there, refund will not be processed. However, there is a relaxation. If that invoice is duly attested by the applicant, that is officer of UIN, so then in that case they will process the refund. That is this. Acknowledgement shall be made available in RFD 2 and inward supply should have been received against a valid tax invoice. What is the time limit within which refund should be claimed? Generally 2 years from the relevant date, but in this case 18 months from the last date of the quarter in which such supply was received. And refund not allowed in respect to single tax invoice where the price involved is less than 5,000. Suppose if their purchase value is less than 5,000, not equal to 5,000, less than 5,000, on that purchase invoice, whatever GST paid, they will not get it as a refund. So therefore, the invoice value of purchase invoice value should be more than 5,000. Then refund order will be passed in RFD 6 within 60 days from the date of application for refund. That's usual. Usually the time limit to order refund is within 60 days. If not, interest will be payable from 61st day. And this 18 months time limit is wrongly printed in the study material. It is printed differently as 6 months and all. But actually that is wrong. It is 18 months only from the last date of quarter in which supply was received. Okay. So this is correct only because some students asked me that, sir, in study material there is a different point like this. No, this is correct. I double checked, cross verified. This is the updated provision. Okay. So 18 months from the last date of the quarter in which supply was received. Then next, refund allowed to retail outlets. Already I told you, that is, whenever there is a retail outlet which is in an airport, that retail outlet supplying goods to a tourist, so then that is exempted. Who is a tourist? The one who is coming from outside India to India. When he will be called as a non-resident, 182 days, less than 182 days, correct or not? 182 days convert into months, 6 months. So therefore in GST, 6 months if he is staying not more than 6 months, then he will be called as a tourist. If he is staying for more than 6 months, he will not called as a tourist. So therefore tourist means he stay not more than 6 months. For what purpose? Legitimate non-immigrant purpose. Then he will be called as a tourist. So supply to this tourist, exempted. Now this retail outlet is making inward supplies for which they paid price plus GST. That GST went to government. From government they will get the refund of the GST to make their inward supply zero. Tax burden on inward supply 0. But whenever they are making supply to a tourist, they need to take a passport copy. Then only they will not charge GST, because this person may not be tourist. He may be an Indian resident going abroad from India. So therefore in that case, he will not be eligible for that exemption. So he should be a tourist. So passport contains the details of when he came to India and when he is leaving India. So if that period is does not exceeding 6 months, then on the strength of the passport copy, so they will not be charging GST. For example, 1 lakh units purchased, 60,000 units sold to normal people in the airport and 40,000 units sold to this kind of tourists. Then the refund is only to the extent of that 40,000 units. These retail outlets making tax-free supply of indigenous goods to an outgoing tourist are entitled to claim refund of GST paid on inward supply. So therefore reetail outlets will supply such indigenous goods without collecting any taxes from the eligible passenger and may apply for refund. Then procedural aspects related to refunds. So far we have seen like what are all the differential points. Now whatever we are going to discuss will be common. If there is any difference, so that difference alone we need to remember. First, what is the application for refund? RFD 1. Who need to file? Everyone need to file RFD 1 only application. However, shipping bill needs to be filed in one case. Which case? Export of goods outside India, and wherein upon payment of GST, that refund is processed by the customs officer. So their shipping bill will be taken as the application for refund. Then RFD 10 in case of UIN holder, and that is this extra RFD 10 and shipping bill, but otherwise it is RFD 1. And now other authentication is mandatory in case of refund application. Then once we file the refund application, an acknowledgement will be generated. That acknowledgement will be generated in RFD 2. What is the time limit within which the acknowledgement should be generated? Within 15 days of filing application. Suppose if there is any deficiency, that deficiency will be communicated to that person. So now when the deficiency is communicated to that person, again he will rectify and he will make an application. Now the second time he made an application, that only considered as the date of application in the acknowledgement. So means till the time he rectified the deficiencies and file a rectified application, acknowledgement will not be generated. So therefore in the acknowledgement, already he filed one application, he rectified, that is it is rejected with deficiency, again he filed. Now what will be taken as the date of application? Second time he is filing, that will only be taken as date of application. For the purpose of counting that 60 days also, refund order should be passed within 60 days. 60 days should be counted from when? From the date he filed the rectified application. Now there is one trouble here, that is within 2 years from the relevant date, the application should be made. Okay. So therefore the relevant date is Please concentrate. The relevant date is 30th June 2021. From this time, within 2 years, they need to make the application for refund. Yes, within 2 years, they made refund application. So RFD 1 has been filed on, say, so 25/5/2023. Within 2 years, within 2 years, RFD 1 has been filed. So after filing RFD 1, so deficiency memo, the deficiency memo is issued in RFD 3, deficiency memo in RFD 3. So this was issued on somewhere 30/6/2023. Thereafter again revised RFD 1 filed on 5th July 2023, but 2 years is over. 36/2021 to 5/7/2023, beyond 2 years. So then the refund will be rejected? No. While counting the 2 years time limit, this deficiency memo date and the date of filing this revised application, that is, whenever you file the original application to this deficiency memo time, will be excluded. See this, while computing 2 years, period from the date of filing refund claim. What is that period from the date of filing? Here, what is the total time limit? 2 years, 5 days. 2 years, 5 days minus. So, date of filing refund claim. Date of filing refund claim is 25/5/2023, and till the date of communication of deficiencies, that is, so 36/2023. How many days? How many days? 5 days in the month of 6 days in the month of May and 30 days in the month of June. So 36 days. If you exclude 36 days, it will be less than 2 years. Therefore, refund claim is made on time. Understood or not? I could not increase the speed, so energy came down. That's why. Okay. So try to understand. And what is this? That is, whenever they are making a refund application, they get a deficiency memo. From the refund application to deficiency memo, that period whatever is there will be excluded for the purpose of counting the 2 years. So in this case, the 2 years is valid. So this point is not tested. I expected this for May 22 exam. They have not tested this for May 22. Definitely there is a chance of asking this for November 22 exam. This was a May 22 amendment. Then time limit for filing refund claim within 2 years from the relevant date. And in case of refund to UN holder, what is the time limit? Generally 18 months from the last date of the quarter in which supply is received. And this time limit of 2 years is not applicable. Latest amendment, not applicable in case of electronic cash ledger, refund from the electronic cash ledger. Now what should be taken as the relevant date for counting the 2 years time limit? In case of export of goods, the date on which goods leave India. In case of export of services, the date on which payment is received in foreign exchange, or the date on which invoice is raised, whichever is later. Please remember, please remember. In case of export of goods, let it be on payment of IGST or without payment of IGST under bond or LUT. Both cases it is the same relevant date. For export of goods, same relevant date, both the options. On payment of GST or without payment of GST. Both refund options, same time limit. The date on which goods leave India. In case of export of services, payment received date or invoice date, whichever is later. If the payment is received now, but the invoice is generated in future, I told you we need to exclude that advances. From the zero rated supply of services, we need to take out the advances received during the period for which the supplies to be made in future. Why? Because the invoice is not yet generated. So that's why whichever is later. Then next, same point applicable even in case of option 1 or option 2. Yes. Then in case of deemed exports, the date on which return is filed by the supplier. So whether refund is claimed by the recipient or refund is claimed by the supplier, we need to count 2 years from the date on which return is filed by the supplier. Actual date of filing return, due date of filing return, actual date of filing return. In case of deemed exports, actual date of filing return. In case of deemed exports, actual date of filing return, not due date of filing return. Please register in your mind. Whereas, look into unutilized ITC on account of inverted tax structure. Please see, refund on account of inverted tax structure. But it should be taken due date of return, actual date of return, due date of return. In one place it is actual date of return, another place it is due date of return. Actual date of return is in case of deemed exports, and in case of inverted tax structure it is due date of return, due date of GSTR 3B, and also in case of supplies to SEZ it is due date of GSTR 3B. Kindly remember this will be tested in MCQs. Then in other cases easily you can remember, in case of judgment, decree or order, the date on which the judgment, decree or order is given. In case of provisional assessment which gets finalized, 2 years will be counted from the date of final assessment. Refund claimed by the recipient. When refund will be claimed by recipient? When supplier has passed on the burden to the recipient, refund is subject to unjust enrichment. So supplier should prove that he has not passed on the burden to the next person. If the supplier passed on the burden to the next person, then the recipient will claim the refund. Now the relevant date will be from the date of purchase. In any other case, the date on which payment, for example excess payment of tax, the date on which we paid the tax, from there within 2 years it should be counted. Can the refund application may be withdrawn? Yes, we can withdraw. There was a restriction previously, we made a refund application. Wrongly we made a refund application in the month of July, and there is some error that we could not consider certain inputs, and we have made a refund application in the month of July, and thereafter we identified in the month of August that yes, there were some inputs on which input tax credit was not taken for the purpose of counting the formula, because of which we are eligible for more refund. Again, when you go into the portal and when you click on that refund, so refund for the same month not allowed more than once. So that was a restriction. Due to that reason, what we need to do? So that is under the same reason. There are multiple reasons for which we need to file refund. In RFD1, when you open in the portal, multiple reasons will be there, different buttons will be there. So we need to select that. We need to select, then it will ask which period you are claiming. So already one July month we filed means, again for the same reason, we cannot go for the same month. It will ask you to file for the next month. So but now there is a facility. What is that facility? You can withdraw the refund application. Whatever refund application you file, that can be withdrawn. So refund application file can be withdrawn before issuance of provisional refund order or final refund order or payment order or refund withhold order or show cause notice. Before giving any refund order or before passing any show cause notice, yes, we can withdraw the refund application. And there is a concept called as provisional refund. Provisional refund is applicable if there is a deemed exports or export like zero rated supplies. Which case? Only in case of zero rated supplies. Highlight. Only in case of zero rated supplies we are eligible for provisional refund. What is that provisional refund? 90% of whatever you have paid, that is whatever you are claiming refund, that you will get as a refund within 7 days. The remaining amount you will get within 60 days. If not, interest will be payable. So 90% of the refund claim will be given in principle within 7 days from the date of acknowledgement. For that they will be passing a refund order in RFD 5. And suppose payment order, if they wanted to give, refund order is RFD 4, RFD 5 is payment order. So these form numbers you need to remember. RFD 1, what is RFD 1? Application. RFD 2, acknowledgement. RFD 3, deficiency memo. RFD 4, that is provisional refund order. RFD 5, payment order. So after refund, to make the payment to your bank account, they will be passing a payment order. Then RFD 6, regular or final refund order. So therefore, RFD 6, final refund order, and the payment will be given in payment order RFD 5. Payment order given in RFD 5 needs to be revalidated if refund not disbursed in the same financial year. Suppose if the refund is disbursed in the next financial year, actually in case of income tax we will be seeing that whenever they process our ITR and they will be giving how much is the TDS refund, how much is the interest. How they will calculate the interest? They need to calculate interest till the time they need to give now, because they will be specifying, they will be having a estimated date by which they will be giving us the money. So to that amount they will calculate the interest. In ITR you can see interest like that. So they will be knowing which date they will be paying. Suppose by that time they could not pay and it falls in the next financial year. So then in that case they will be revalidating that and they will be computing the interest and they will be paying. So that is that revalidation of the payment order. But refund order and all no need to revalidate, because already refund got sanctioned. As there is a payment delay, interest also will come. Due to that reason they need to do the revalidation. Then withholding of refund. Withholding of refund means whenever there is an outstanding demand order against a person. Already we saw one of the modes of recovery is what? So any refund due to the person will be withheld, correct or not? So that is known as withholding of refund. and where the proper officer is satisfied that refund is no longer liable to be withheld, then they will pass a release order. Only after passing release order for withheld order, so then only they can pass a refund sanction order, that is this. Then refund subject to unjust enrichment. So every person should prove that they have not passed on the burden to the next person. That is known as refund subject to unjust enrichment. How to prove that? So if the refund amount does not exceed 2 lakhs, then self-declaration. If the refund amount exceeds 2 lakhs, a certificate from a CA or CMA is required that refund is not burden is not transferred. So the person who is claiming refund is eligible for the refund. So that's where 2 people got arrested recently, 2 chartered accountants under this ground only, that they certified without checking that this person is eligible for the refund, and that exporter is a fake exporter, made some fake export invoices and he is claiming the refund. Okay, so that is the certification, because the complete burden is on chartered accountant or cost accountant only certifying the refund application. So therefore refund is subject to unjust enrichment, that can be proved by self declaration if the amount does not exceed 2 lakhs. If the amount exceeds 2 lakhs, a certificate from a CA or CMA required. However, there are 5 cases where refund is not subject to unjust enrichment, means neither declaration nor certificate from a CA or CMA is required. Refund of IGST paid on export of goods or services. IGST paid on export of goods or services, not required. Then refund of unutilized ITC in case of zero rated and inverted tax structure, not required. Refund arising on account of refund voucher, not required. Refund on account of wrong classification, intra as inter, because that's a revenue neutral, not required. Refund of excess balance in the cash ledger. Whether export of goods or services upon payment of IGST, refund is subject to unjust enrichment? No. Supply to SCZ upon payment of IGST, whether refund is subject to unjust enrichment? Yes. Please see the first box. In the first box there is no zero rated supply, there is only exports, which means whenever we are making supplies to SCZ, then upon payment of IGST option, refund is subject to unjust enrichment. We need to prove. Suppose we are claiming refund of ITC. Look into the second box. Look into the second box. They use the word zero rated supplies. Means for SCZ also no need to comply with this provision. Is it clear or not? But in the first case they did not give zero rated, they gave only exports. In the second box they gave zero rated. That you please keep in mind. Okay. Then now the latest amendment is that in case of refund of excess balance in the cash ledger, so then also this declaration or certificate is not required. Consumer welfare fund. Consumer welfare fund is whenever the refund is not payable to the person because of unjust enrichment, not proving unjust enrichment, that amount of refund, whatever is collected excess, will be going to consumer welfare fund, and this income from the fund will also be credited to that fund, and a committee is appointed for utilization of that fund. And for what purpose they can use that fund? That fund can be also used for publicity or consumer awareness on GST, like ads, etc. For the purpose of GST they can use. But how much they can use? 50%. I don't know how publicity or consumer awareness on GST will come under consumer welfare. Okay. And another doubt is why in that Chechi's photo and PM's photo will come, that also I have a doubt. Means it is their publicity or publicity about GST, and that too why they are touching consumer welfare fund. It is for the purpose of giving benefit to the consumers whenever they go to the court against the consumer forums. Consumer forum they will go against the companies. For that only they should be paid compensation out of this consumer welfare fund, or the fees should be borne by them. So this is what consumer welfare fund is created for. But see how much they are looting from consumer welfare fund. 50%. That's an amendment. 50% of what? Amount credited every year, and provided the availability of funds for consumer welfare activities of the Department of Consumer Affairs is more than 25 crores per annum. Now listen carefully. That is, what is the balance? So the balance is 15 crores. Opening balance 15 crores. Credited during year. Credited during the year is 40 crores. So tell me how much they can spend. How much they can spend? So what is the total now? Closing balance. Closing balance is how much? 55 crores. Now, how much they need to retain? Retain 25 crores. Okay. So, then how much can be given? Spent for publicity. Spent for publicity. A. That is amount credited 40 crores into 50%. 20 crores or excess balance. What is the excess balance? 30 crores, whichever is lower, that is 20 crores can be spent for publicity. Okay. Clear pa? So this also can be asked as a MCQ. Okay. With this we completed refunds under GST. Next. Look into the next one, last segment. In this last segment, multiple concepts are there. We will complete this and take a break, and thereafter we will start with customs. Okay. So please hold on, okay, and listen. So liability to pay tax in special cases. Whenever there is a transfer of business, in case of transfer of business, transferor and transferee both are jointly and severally liable for the dues with respect to the pre-transfer period, that is before the date of transfer. So transfer is liable for the dues even pertaining to the transferor before the date of transfer. Jointly and severally liable means if transferor is not paying, transfer is liable to pay. But this is not with respect to the post-transfer dues, it is with respect to the pre-transfer dues. Then every agent who is making supply on behalf of principal, when an agent will be called as making supply on behalf of principal, if the invoice is raised by the agent in his name, then agent is acting on behalf of principal. In case of purchase transaction, invoice should be in the name of the agent. Then agent is acting on behalf of principal. In a sale transaction, agent name invoice should be raised to the buyer. In case of purchase transaction, the invoice should be in the name of the agent. Then agent is acting on behalf of principal. Whenever supplies are made by agent on behalf of principal, then in that case, not only the agent, but also principal is jointly and severally liable. Suppose if agent is not acting on behalf of principal, only principal is liable for the dues with respect to the supplies made by the agent, because agent is not acting on behalf of principal and the invoice is raised only in the name of principal. Then in case of section 87, that is 85 and 86, 87, liability in case of amalgamation or merger of companies. Two companies in principle agreed for merger and they got a stock exchange and SEBI permission also, and they are literally like merged, but still that merged entity did not get a certificate of incorporation because the court has not yet given the order, because certain mergers are subject to approval by the court or a tribunal. Now in that case, the date on which court order is passed, from that date only they will be treated as merged entity. Until that point of time, they both are treated as different entities and any transactions between them will be chargeable to GST. That is this. Then section 88, liability in case of company liquidation. Whenever a company is in liquidation, one liquidator will be appointed, but all these provisions are subject to IBC. Suppose if it is IBC, then as per IBC only it will prevail. Suppose if there is no IBC, then liquidator is appointed. When liquidator is appointed, he need to notify his appointment to the commissioner within 30 days, and thereafter commissioner will notify him what are the dues against that company within 3 months, and that dues of the company should be considered as statutory payments, because liability to pay GST is first charge, which means that, so that should be considered as statutory payments and he need to discharge the statutory payments. That is this. Suppose if the company is a private limited company, then all the directors who are the directors of the private limited company jointly and severally liable. What if there is a director who retired? If the liability pertains to the period before his retirement, so then he is required to pay the dues. Suppose if the liability pertains to the period after his retirement, he is not required to pay the dues. So he need to prove to the satisfaction of the officer that whatever dues that arises is after his retirement as director from the private limited company. But in case of a partnership firm, they are not giving that relaxation. In case of partnership firm, what they are telling is that if a partner is retiring, he need to give his notice of retirement within 1 month. You can see that in section 90. In section 90 you can see, in partnership firm, the partner should give the notice of his retirement within 1 month. If he gives the notice of his retirement within 1 month, then in that case, he is liable to dues till the date of his retirement. However, he forgets or he fails to give the notice of his retirement within 1 month. Till the date he gives the notice of retirement, until the date he is liable for the dues, even though it is after his retirement. Got it? Then retiring partner will continue to be liable till the time he gives his notice of retirement, if such notice is not issued within 1 month from the date of retirement. And in case of partnership firm, so firm and partners are jointly and severally liable for the dues. And as per section 89, directors of a private limited company, all directors shall remain liable jointly and severally. However, if private limited company is converted into public, then director is not liable. Then section 91, liabilities of guardians and trustees. Guardians and trustees appointed for minor and a trust or incapacitated person will continue to be liable, and as if the minor becomes major and doing business himself, and as if the incapacitated person is capacitated and doing business himself, whatever is the liability on them, even imprisonment on them, that the guardian or the trustee will undergo. That is the point there. Okay. Then liability of court of wards. The court of wards is also the same way. Whenever there is a estate and that estate is inherited by a minor, then in that case, if there is no guardian for that minor, so then court of wards is appointed. Under the court of wards, the government will take over the property and official trustee or one person will be appointed, and he will take care of the revenue of that estate, and he is liable for the dues of that estate. Suppose if there is any dues, but not the person to whom that belongs to, but under whose control it is. Estate of a taxable person under the control of court of wards, administrator general, official trustee or any receiver or manager shall be liable to pay dues. Death of a person, liability of legal representatives. Suppose if the business is continued or not, you need to check. If the business is continued, then legal representatives are liable even beyond the estate inherited. For example, they inherited an estate of 300 crores, but the GST liability is 500 crores. So they need to pay all 500 crores, entire 500 crores if the business is continued. But if the business is discontinued, they are required to pay the dues to the extent of 300 crores, how much estate they have inherited. Then HUF or AOP, partition of assets among the members. Each member shall be jointly and severally liable for the dues. Suppose if the partnership firm is dissolved, so whenever there is a partition, we will continue to recover money from the members even after partition. Same way, partnership firm dissolved, we will continue to recover money from the partners even after dissolution of the partnership firm. Whereas in case of termination of guardianship and trust, even then the guardian is liable to pay the dues. He will continue to pay the dues with respect to the period before that guardianship or trust got terminated. Then liability in other cases. Suppose if there is a partnership firm, HUF or AOP, business discontinued. So some people started a partnership firm and they have generated lot of revenue. They need to pay GST, but they did not pay GST, and that business got discontinued. When the business got discontinued, they will feel okay, business is closed, but even then assessment can be completed and recovery can be made. Partnership firm, HUF or AOP, change in constitution, partners members will remain liable jointly and severally. Say for example, you qualify CA, definitely you will qualify CA, that's not an example, that is certain, but thereafter you have been given in a partnership firm like partner by your principal, so that you have made bonded laborship for this many years. I like your bonded laborship. Now you need to continue like a slavery, and I want you to make as a partner. So therefore he made you as a partner. Now in that case, don't accept any partnership like that, because you will be liable for the dues of that partnership firm even before you joined as a partner, because jointly and severally partners will remain liable. Okay. So therefore any person going into a partnership firm, admitted into a partnership firm, should do the compliance audit before going into the partnership firm, or should make an indemnity clause in the contract separately with the partners, remaining partners, that if there is any dues pertaining to the period before the partnership, that is before me admitting into the partnership, that dues should be indemnified by the remaining partners to me in case if there is any liability on me. Like that, an indemnity agreement should be made. Otherwise, gone. The admitted partner is also liable jointly and severally. Then partnership firm, HUF or AOP, because we don't know now what and all principles you like they have done. Then partnership firm, so HUF, AOP dissolved, partners or members will remain liable jointly and severally even after dissolution. So these are the points. You don't have to remember any section number here. Any section number you don't have to remember, but remember the provisions, that is sufficient. If at all you want to remember any section number, that section 85 and 90 alone you remember. That 85 and 90. because those two are very important ones, transferor and transferee, that partnership firm. Okay. Then next area, e-way bill. E-way bill is a document which is submitted by every person who is causing movement of goods. That person, when he need to submit the document, before movement of goods or after movement of goods, before movement of goods, at the time of commencement of movement of goods, the e-way bill should be generated, and it is to be generated before movement of goods. Whether e-way bill is applicable in case of exempted goods? No, only for taxable goods. What if the value of the goods does not exceed 50,000? E-way bill is not required. But while calculating 50,000, whether we need to include GST or not, we should include GST. Generally, value excludes GST, but in this case, we need to include GST, include GST, include GST, exclude exempted supplies. Generally, GST will not be coming in value, but in e-way bill provisions, GST should be added while counting that 50,000. And in case of job work and handicrafts, definitely e-way bill is required. Don't see the value 50,000. So definitely e-way bill is required in two cases, that is goods sent on job work and if it is handicrafts. And usually e-way bill will have two parts. Part A will contain the invoice details and part B contains the vehicle details. Part A should be entered by a registered person who is causing movement of goods. That is, if the supplier is registered, that supplier will enter part A details. If the supplier is unregistered and the recipient is registered, recipient is causing movement of goods, so recipient will enter the part A details. If both are unregistered but the goods are taxable goods, transporter should enter the part A details. Suppose if transporter is unable to enter, then either supplier or recipient can enter by enrolling as citizen of India. So this is the person's responsibility to enter part A details. Who will enter part A? The registered person causing movement of goods. If the supplier is registered, that supplier. And if the supplier is unregistered and the recipient is registered, that recipient. If the recipient is also unregistered, then the transporter. Sir, between two unregistered persons, there is no supply. Then why e-way bill is required? Because the goods are taxable goods. Because of that reason. And suppose if no one is generating, either supplier or recipient can enroll as a citizen of India and we need to enter. Beware, any goods that you are purchasing and which are transported from one place to another place in small vehicles, if at all officer stops that vehicle and there is no e-way bill, sir, you are unregistered. Your supplier is registered. At least you should have generated, but you should be careful about that. So never ever make the purchases at that stage. So tell that only when you deliver to me, then only it is considered as sale. Otherwise, don't buy any product from them, because now it is highly risky. GST officer may stop the vehicle and will ask for e-way bill, and that person who is bringing the vehicle don't know anything, bringing the goods don't know anything about that, and then unnecessarily the goods will be seized, and thereafter the 200% of tax will be payable as penalty. Then only the goods will be released. So that problem is there. So therefore, even between two unregistered persons, if the goods are taxable, e-way bill should be there. By enrolling as a citizen of India, we need to enter the details in e-way bill. This is about part A. What about part B? Part B contains transport details. Who will be entering transport details? If it is own conveyance, then either supplier or recipient, they will enter the vehicle number. If it is a transporter, third party conveyance, the transporter will enter the vehicle number. Suppose if it is railways, waterways, airways, then instead of entering the vehicle number, we will be entering the document reference number. That is airway bill number, then railway receipt number, or in case of waterways, bill of lading number. So that should be entered. Then what is the validity of e-way bill? E-way bill, once it is generated, that is by entering both part A and part B, once e-way bill is generated, so its validity will be depending upon the kilometers, because in e-way bill, we will be entering the place of origination and the place of delivery. So these two, based on these two pin codes, it will be calculating how many kilometers. So based on that, the validity will be determined. Suppose if the number of kilometers is 480 kilometers, what will be the validity? 3 days. 1 day for every 200 kilometers are part thereof. Previously 100, now they changed it to 200 kilometers. 1 day for every 200 kilometers are part thereof. But in case of over-dimensional cargo, like big turbines they will be taking, or aircraft parts they will be taking, windmills they will be taking, in that case we need to take 1 day for every 20 kilometers are part thereof. 1 day for every 20 kilometers are part thereof. Then also multi-mode transportation. Multi-mode transportation where at least one leg involves transport by ship, up to some distance by airways, thereafter by land, thereafter waterways, again by landways. In that case, in this, one leg of the journey involves by ship. So then also 1 day for every 20 kilometers are part thereof. But in all other cases, 1 day for every 200 kilometers are part thereof. So 480 kilometers, first 200 1 day, next 200 1 day, remaining 80 1 day. Then this validity will always be counted from the midnight of the day in which e-way bill is generated, and it will be till next day midnight will be counted as 1 day. For example, 3 days will be counted from today's midnight. Today at any time it is generated, so it will be counted from today to tomorrow 1 day, tomorrow midnight to day after tomorrow another day, day after tomorrow midnight to yet another day. That is 3 days, which means e-way bill will always expire by midnight only. And once the e-way bill expires, we need to renew the e-way bill. What is the time limit within which the e-way bill can be renewed? Within 8 hours from its expiry. So the e-way bill can be extended. But for extension, we need to give the reason why the goods could not be delivered at that time. So validity counted from the midnight of the day when e-way bill is generated. Then FAQs on e-way bill. When e-way bill is not required. This is examiner's most favorite area. MCQs will be coined on this only. If the goods are transported by non-motorized vehicle, so then it will be e-way bill not required. Bullock cart, horse cart, manual rickshaw, etc. and all, e-way bill not required. In that also that many kilometers we will not travel. Then goods transported from customs port, airport or air cargo complex. So from port or airport or from land customs station. Then inland container depot. Land customs station is the check post for roadways, import or export by roadways. Inland container depot and container freight station. Inland container depot is dry ports, and container freight station is the place where stuffing and destuffing of the containers, segregation and aggregation of the containers will happen. Now, this place to this place, if there is any movement, so that do not require e-way bill. E-way bill is not required because it is under the control of customs. That is the second point. Then third point, so from port, airport or land customs station to inland container depot or container freight station to the customs warehouse, the goods are transported without payment of customs duty. So this transportation to the customs warehouse also do not require any e-way bill because still the goods are under the customs control. That is third point. Then transit cargo transported to or from Nepal or Bhutan. Here two or from both are there. That is, suppose if the goods are coming to India from Nepal or Bhutan for export from India. So because India is having MOU with Nepal and Bhutan, and Nepal and Bhutan being landlocked countries, so goods will be brought to India to take it from Indian port, export. Also import from Indian port, it will be going to Nepal and Bhutan. This movement of the goods do not require any e-way bill. Then movement of goods for Ministry of Defence, because we will know what goods they are transporting from which place to which place and which vehicle number if they enter, and then we can steal those weapons and all, and we can kill people. That's why. Then empty cargo containers are being transported. So in empty cargo containers there is nothing inside that. Okay. So therefore what is the need of e-way bill? Not required. But that cargo containers are goods na. So but there is nothing in that. That's why e-way bill is not required. Then consignor transporting goods to or from between a place of business and a weigh bridge. That is, from the factory to the weigh bridge, first they will take a lorry to check the weight of the lorry, and thereafter again they will load the goods into the lorry, again they will be taking it to the weigh bridge. Now to check weight of the lorry with goods. Weight of the lorry with goods minus weight of the lorry without goods. The difference will be taken as the weight of the goods. So therefore, for taking the weight of the goods, so they will be taking the goods along with the lorry to the weigh bridge. Now within 20 kilometers only the weigh bridge is there. Then in that case e-way bill is not required at all. Part B not required, or e-way bill itself not required. E-way bill itself is not required. Goods being transported by rail, where the consignor of the goods is central government, state government, local authority. What is the difference between the sixth point and the eighth point? Sorry, fifth point and eighth point. Fifth point, Ministry of Defence, any mode. Ministry of Defence, any mode if it is transported. But here, central government, state government, local authority goods if it is transported by only rail. Then point number 9. Some state governments can exempt the e-way bill requirement with respect to some goods. Then for that goods, e-way bill is not at all required. Then some specified goods given by central government. What is that? LPG for supply to household or non-domestic exempted category customers. That is that red color cylinders. But transportation of that blue color cylinders will require e-way bill. Kerosene oil sold under public distribution system. So suppose if this LPG for supply to household or non-domestic exempted category, that should not be a dealer of cylinders. So this point is not applicable for dealer of cylinders, not a dealer of not a dealer of cylinders. Dealer of cylinders means gas agencies are there na, for them it is not applicable. Then it is applicable for whom? This is applicable for normal people other than those dealers. Then kerosene oil sold under public distribution system, that is ration shops. Postal baggage that is postcards, letters, etc. That is natural culturals and jewelry, same reason like defense. If you know which vehicle it is taking, then money heist season 6 will come. Okay. Then used personal effects and household effects. Already these are used goods at the home. For that why e-way bill is required, so e-way bill not required. Whether e-way bill is required if the movement of goods is not for supply. Yes. Even if it is not for supply, if movement of goods is there, there is e-way bill required, provided the goods are, which goods? Taxable goods. Whether the 50,000 limit is for taxable goods or exempted goods. So this is for taxable goods only. Means if it is both taxable goods and exempted goods, what we need to do? Take out exempted goods. So we need to take only taxable goods. While computing the invoice value, whether GST to be included or to be excluded, we need to include. Who will generate e-way bill? E-way bill will be generated by registered person. Already we discussed, if he is causing movement of goods. Supplier. Suppose if the supplier is unregistered and the recipient is registered, then recipient, otherwise a transporter. Whether transporter required to generate e-way bill if supplier has not generated because the value does not exceed 50,000. There are 10 consignments transported in a single lorry. Each consignment value does not exceed 50,000, but cumulatively all consignments exceed 50,000. Now in that case, transporter should generate e-way bill single for each consignment. Also all these e-way bills should be consolidated into e-way bill 2. So therefore he need to do that. Transporter should generate e-way bill where all consignments in the conveyance individually does not exceed 50, but in aggregate it exceeds 50. Blocking of e-way bill. Suppose if the returns are not filed for 2 consecutive tax periods, either GSTR 1 or GSTR 3B or CMP 8, then with respect to their outward supplies, not with respect to their inward supplies, with respect to their outward supplies, whichever person has not filed return, with respect to their outward supplies, transporter or his recipient or he cannot generate e-way bill. But for his inward supplies, can the e-way bill be generated? Yes. So e-way bill generate facility is blocked only with respect to outward movement of goods by registered person. However, e-way bill can be generated in respect of inward supplies of the said registered person. Then some other points. In case of bill to ship to transaction, even though there are 2 supplies, one between the original seller and the billing address and the second between billing address and the shipping address, only one e-way bill is required, because in e-way bill itself we have bill to ship to functionality. Multi-vehicle updation is possible in e-way bill. Up to some distance in one vehicle, thereafter in another vehicle, we can update that. Part B should be updated within 15 days from updation of Part A. So once Part A is updated, invoice details added, means the movement should start within 15 days. So we need to enter the Part B details. And e-way bill should be accepted by the recipient within 72 hours from the generation of delivery of goods, whichever is earlier. Within 72 hours from the generation of e-way bill or delivery of goods, whichever is earlier, the recipient should accept this e-way bill. And Part B may be updated by supplier, recipient or transporter. You can see that movement of goods, if it is taxable goods under supply, already we discussed this chart, tax invoice plus e-way bill. Movement of goods, taxable goods without supply, delivery challan plus e-way bill. Exempted goods do not require e-way bill, just bill of supply and the delivery challan. So this is about this e-way bill pa. Then, so only 2 areas are there. 3 areas are there. Can we complete or break you need? Complete? Okay. So see this, anti-profiteering. Anti-profiteering provisions. So there is one amendment for anti-profiteering pa. That amendment only will be tested in MCQ. That is, previously the anti-profiteering was expired by 4 years from the date on which chairman is appointed for the anti-profiteering. But now it has been extended to 5 years. The authority shall cease to exist after expiry of 5 years from the date on which chairman enters upon to his office, unless the council recommends otherwise. So the chairman entered into office on 30th November 2017. So therefore 30th November 2021 it was over. But now they have extended for 1 more year, and that is 30 November 2022. So therefore 5 years. We need to just remember this, 5 years. What is the purpose of anti-profiteering? Whenever you have to pass on the benefit to the next person, by way of reducing the sale price, because you have got the reduction in tax rate or you got more ITC, then you need to pass on the benefit to the next person by way of reducing the price. If you have not passed on the benefit to the next person, then in that case anti-profiteering authority will pass an order, and that order may be to reduce the prices or for imposition of penalty. What will be the penalty payable? 10% of the profited amount. 10% of the profited amount means how much benefit you should pass on by reducing the sale price. You did not reduce the sale price, means you earned a profit. So that much of profit earned into 10%. And we need to return that money, whatever we have not passed on to the buyers, we need to return that money along with interest 18% per annum. Suppose if you could not return that person, then put it in consumer welfare fund, and there will be cancellation of registration. So this is what they can order for. Very important for short note. So what can be ordered by the anti-profiteering? This can be ordered by anti-profiteering authority. Then who can make an application for anti-profiteering? Affected consumers may file application, or even officer also can file. So with whom they need to file? There are two persons, two committees: Standing Committee on Anti-Profiteering, State Screening Committee. If the issue is of local in nature, State Screening Committee. If the issue is of national in nature, Standing Committee on Anti-Profiteering, they need to make application. Then look into some circulars, whether interstate movement of conveyance carrying the goods between distinct persons will be coming under supply. Between distinct person, any transaction will be treated as supply, goods or services. Whether conveyance taken from one distinct person to another distinct person treated as supply? No, because conveyance will not be further supplied, it will be returned. Suppose if the conveyance is further supplied, then on conveyance they need to pay GST. But because here conveyance is not goods, conveyance is just carrying the goods, then conveyance will be unloading the goods and will be returning. No need to pay GST on that conveyance. Same way, suppose if the conveyance is sent for repairs to the workshop of the same person in another state, then also no need to pay GST on the conveyance. However, that workshop will be providing the repair service. On that repair service only GST payable, because between distinct persons, even though without consideration, it constitutes supply. Then same way, third point. First point is mere movement of conveyance between distinct person carrying goods. No need to pay GST on the conveyance. Number two, conveyance sent for repairs. No need to pay GST on conveyance, but on the repair service GST payable. Number three, so that is tools which are sent from one distinct person to another distinct person, not for further supply, but for consumption in that distinct person. So then also there is no need to pay GST. That is this. So if there is any movement of conveyances, carrying goods or passengers, no need to pay GST. For repairs or maintenance, no need to pay GST. However, GST is payable with respect to repairs and maintenance on that conveyance. And this circular is extended for interstate movement of all tools, rigs, tools, spares and all goods on wheels, provided they are not for further supply. Then, so this already we saw, when an agent will be called as agent acting on behalf of principal. In case of sale invoice, he need to raise invoice. In case of purchases, the invoice should be in agent's name. So then only he will be called as agent on behalf of principal. Then, whether printing of books will be coming under supply of goods or supply of services. In the activity of printing of books, there are two elements, that is material. Paper and ink is material, goods element, and the printing and binding is the service element. Now, we need to check whether it constitutes supply of goods or supply of service based on principal supply. In case of books, brochures, flyers, etc. So printing is the principal supply, the paper and ink is only ancillary, therefore it will be treated as supply of service. Whereas in case of tissue papers, letterheads, etc., the paper is the principal supply, whereas the logo printing is not, because even though the hotel name is there in the tissue paper, we will use it for whatever purpose we need to use, but we will not be keeping it, folding and keeping in our pocket na. So therefore it is used as a tissue paper. So the principal supply is paper only, and it will be coming under supply of goods. Then whether the activity of bus body building is supply of goods or supply of services. In bus body building, so usually the seller of the bus will sell only the chassis, engine along with the tires, but the body, everything will be fabricated by the bus body building shop. In the bus body building shop, so they will purchase the metals, material, metal, sheets, etc. They will do the fabricate the structure, and that fabricated structure will be fixed on to this bus. Now this will be purely supply of service, because the material element is goods, but the fabrication is the service. Fabrication is the principal supply, therefore it will be coming under supply of service, but we need to determine based on what constitutes principal supply. Then, So here principal supply is what? Supply of services, fabrication. That's why it is treated as supply of service. Then rethreading of tires. Rethreading of tires means on the old tire they will be attaching a grip. That is known as rethreading of tires. Suppose if I buy the old tire and I sell the rethreaded tire, means it is sale of goods. If I take the old tire and if I do the rethreading and give, that is supply of service, just like carrying out process on the goods belonging to other person. Suppose if I purchase those goods and thereafter I process and sell the rethreaded goods, then it is sale of goods for me. Then whether priority sector lending certificates. Priority sector lending certificates are the certificates which is sold by one bank which has overachieved the loan to priority sector to another bank which has underachieved the loan to priority sector, so that the another bank which has achieved under the limit, so therefore when they buy, the moment they buy the priority sector lending certificate, which means that they have also indirectly achieved the priority sector loans. So usually this transaction will happen between the banks, so through e-Kuber portal. So this will not be treated like transaction in securities, because these priority sector lending certificates are not like shares, debentures, etc. So it should be treated like goods and it will be chargeable to GST. Now what you need to remember is that priority sector lending certificates are goods and chargeable to GST, that much only. Then whether artwork sent by artist to art gallery. I am an artist, I am sending the artwork to your art gallery. Now you will pay money to me now? No, you will never pay me money just because of sending. So that will be displayed and one idiot will come and buy it from you, and then only you will get money, then only you will share money with me. So therefore what will be taken as time of supply in my case? The day when art gallery sells it to the customer, that is the time at which I will be considering it as supply. Until that point of time I cannot consider it as supply. Then whether tenancy rights or Pagadi system is chargeable to GST. In tenancy rights what will happen? There will be two things: transfer of tenancy rights or announcement of tenancy rights. For example, I will enter into a lock-in contract of tenancy with the property owner. Means 3 years I only should occupy the property. I will only pay rent to that property owner. Now what I will do? I will transfer this tenancy right to another tenant, for which I will be getting a tenancy premium because I created a conducive environment for the building. So now I will get a extra money premium from the another tenant. Now out of that premium, fully it will be taxable in my hands, whatever may be the type of property. But out of this premium, a portion will be shared with the property owner as per the tenancy contract. That portion received by the property owner will be taxable. If the rent of the property is taxable, the tenancy premium also taxable. If the rent of the property is exempted, tenancy premium also exempted. So in relation to residential property exempted, in relation to commercial property taxable. But this is in whose hands? Owner hands. But for the tenant hands, always tenancy premium will be taxable. Then GST remuneration on directors, already we discussed, that is, suppose if that remuneration payable to the directors is eligible for TDS under 192, then it will be called as salary to the director, that will be excluded from supply. If the remuneration to director is subject to TDS under 194J, then whatever received by the director will come under PGBP or IFOS, therefore that will be chargeable to GST. On the director will not pay, but the company or body corporate will pay under RCM. Then this del creditor agent. In case of del creditor agent, what about the GST implications? A del creditor agent will be receiving interest, because del creditor agent is different from another agent. How he will be different? For example, there is one principal. I am a del creditor agent. You are my buyer. So generally, if I am a normal agent, what I would have done? So the moment I make a sale to you, I will not pay to my principal. I will recover the money from you. I will deduct my commission and I will be paying to the principal. This is what a normal agent will do. Whereas a del creditor agent, the moment the sale happens, I will be making payment to my principal. I will recover from you along with interest. So therefore, a del creditor agent will get interest. Whether this interest is on account of delay in receipt of consideration or this interest is on account of like loans or advances, that is the point of dispute. Simple. Suppose if I am raising invoice in my name, for you who is the supplier, del creditor agent or the principal? Del creditor agent. So therefore, whenever you pay interest to me, that is for delay in receipt of consideration, will be chargeable to GST, include in value and chargeable to GST. Suppose if my principal raises invoice to you, means I am not an agent acting on behalf of principal. My principal raises invoice to you, then for you who is the supplier? My principal. Then whatever interest that you are giving to me is nothing but on loans advances, that will be exempted. Got it? So therefore, so here, suppose if invoice is raised by the del creditor agent, then in that case, so when invoice is raised by the del creditor agent, so here supply of goods, scenario 2 you see, then that interest will be treated as interest for delay in receipt of consideration and included in the value. Suppose if principal is only raising invoice to the customer, invoice is not raised by del credit agent, then whatever interest that is collected by the del credit agent will be exempted under the grounds of interest on loans, advances, deposits. Clear? Simple one only. So del credit agent raises invoice, interest is taxable, include in the value. Del credit agent is not raising invoice, interest is exempted. Then GST practitioner, the last area. So what are the activities that a GST practitioner can do? They can apply for registration, and they can file returns and forms, and they can apply for refund and make payment, and they can act as an authorized representative. Except this, the other three works even bonded labor will do. So they can, in extra, they can become an authorized representative, and also they can do data entry work. That is, they can furnish the details for e-way bill, and they can furnish the details for challan, that is ITC04. That is goods sent on job work and receipt from job work, and they can file application for amendment or cancellation of registration. No, unique enrollment number, only unique enrollment number. A transporter or warehouse keeper is required to get that one only, and file an intimation to pay tax under composition scheme or withdraw from composition scheme. That CMP2 and CMP4 they can do. Okay, these are the activities, these are the 8 activities that can be done by a GST practitioner. But for doing these 8 activities, what is the qualification that is required? They should be citizen of India, because foreign citizens and all may come and do. No, that's why. Then they should be having they should be a person of sound mind and not adjudged as insolvent. For insolvency and this, what connection? Only God knows. Director disqualifications it is. So they should be citizen of India, person of sound mind, not adjudged as insolvent, and not convicted for an offence involving imprisonment for a period less than 2 years. Suppose if he is imprisoned for 2 years, yes, he can come out and he can become GST practitioner, as no one will give him job. But beyond 2 years means he cannot become GST practitioner. Okay, because they use the word not less than 2 years, means greater than 2 years. Okay, so therefore all the people who go to jail and all, this is a very good idea. We can open one coaching center inside jail for GST practitioner. If you open, appoint me as a faculty, I will take class. So then responsibility for correctness of particulars. So who will be responsible for entering the details in the return? GST practitioner will enter, but the responsibility is not on GST practitioner, it is on the registered person. Whenever GST practitioner enters, so that GST practitioner should give the return to the registered person. Registered person should verify and say, okay sir, everything is correct sir. Then GST practitioner will file. And then if registered person can verify everything is correct, then why he need GST practitioner? God only knows. The responsibility for correctness of any particulars in the return or other details shall continue to rest with the registered person only, on whose behalf such returns are furnished, and it will be made available to the registered person on common portal, and a confirmation should be sought from every registered person over email or SMS. And registered person, before confirming, should ensure that the facts mentioned in the return are true and correct. Suppose if he is not responding, deemed confirmation. And GST practitioner shall prepare all statements with due diligence and affix his digital signature. And if the GST practitioner is found guilty of misconduct, what sir? We will arrest him. No. He will not become GST practitioner for that person. Means his enrollment will be cancelled, but no imprisonment. If a chartered accountant do this mistake, send him prison. Chartered accountant, ban ICA, kill all ICA students, like that. Okay. So if the GST practitioner is found guilty of misconduct, his enrollment will be cancelled. Again he will apply. What is his problem? He will easily apply. Okay. Is that a penalty? And this is about GST practitioner. With this, we completed GST fully. Okay. So take a break, relax yourself and come back. And or you want to take a lunch break now itself? Sure? Fine. So we will meet at 1:30, 1:45. Okay. 1:45 we will meet. And we will continue from there, customs. Okay. Okay. So there are few queries related to GST. Sir, after comparison, if we consider the value as 1.5 into value of domestic supply, then can we consider this value in both numerator and denominator? Of course, we have to. That is when we take export turnover or 1.5 times of domestic supply value, whichever is lower. So whatever we take in the numerator for zero rated turnover, the denominator also should be same. It should not change. Then can we include both starting date and ending date? I think he is asking with respect to e-way bill, I think. So yes, e-way bill, that is the day in which it is generated, that day to next day, midnight. That's how we will consider it as one day. I think it is related to that, I feel. Fine. So these are the two queries. Anything else? Whether condition of crediting payment is already discussed. Okay. So the last area that is left is customs and FTP. So we'll quickly complete that. So first, for the purpose of section 12 of Customs Act is the levy, and section 12 says that there will be levy of customs duty if four conditions are satisfied. What are the four conditions? There must be goods, and the goods must be dutiable goods, and the dutiable goods should be imported or exported, and that import must be into India or export must be from India. So these are the four conditions. Upon satisfaction of this, there will be levy of customs duty. And even government is also person under customs. Yes, government import on par with non-government import. So therefore, both are applicable. So therefore, even government is importing any goods, they are also required to pay customs duty. However, there are some exemptions, specific exemptions available, but otherwise they need to pay. Then what is the meaning of goods? So the meaning of goods under customs is vehicle, vessel and aircraft. That is also part of goods. That is vessel and aircraft which is coming also will be treated as goods. And stores refers to goods which are for the purpose of consumption during the journey. So that is fuel, spare parts, other articles. So that will be called as stores. And baggage refers to passengers' luggage. That is also goods. Currency and negotiable instruments. So under GST, currency is not goods, but under customs, currency is goods. Suppose if there is any foreign currency that we are bringing beyond the specified limits, we need to pay customs duty, but we don't have to pay any IGST. So because there is like in baggage provisions one point which says that when you are coming to India and if you are bringing currency beyond the FEMA regulations, so that currency will be chargeable to duty, and on that we need to pay only basic customs duty. We don't have to pay any IGST. Even normally also any currency imported, suppose if it is not allowed, so then we need to pay customs duty. For the purpose of IGST, nothing, because currency is not treated, money is not treated as goods for the purpose of GST. Then any other kind of movable property. Whether drawings and designs are also called as goods under customs? Yes. Drawings and designs also called as goods under customs if it is imported in any pen drive or hard disk, etc. So then it will be called as goods. Then what is the meaning of import? Import means bringing goods from outside India to India. That is known as import. Then export means taking from India to a place outside India is known as export. And what is the meaning of India for the purpose of customs? 12 nautical miles. What is the meaning of India for the purpose of GST? 200 nautical miles. But here only 12 nautical miles. The moment when it enters into 12 nautical miles, the goods are said to be imported. The moment when it crosses 12 nautical miles, the goods are said to be exported. Then territorial waters, that is what territorial waters is. Then exclusive economic zone is there up to 200 nautical miles from baseline. Then what is the purpose of this? That is only for the purpose of exercising the powers of the customs officer. Customs officer can board any vessel or any vehicle which is within 200 nautical miles from the baseline, and they can arrest any person. So their powers are extended up to 200 nautical miles, but what is treated as import or export is only 12 nautical miles. So customs officer has power to arrest or search a vessel, etc. And high seas is beyond 200 nautical miles from baseline. Then what is customs area? Not every port and airport belongs to customs, and there will be some ports and airports where import and exports are permitted. That will be called as customs port or customs airport. In that also complete area will not be under the control of customs. There will be some specified area which will be under the control of customs, that is known as customs area. Then dutiable goods means any goods which are chargeable to duty on which duty has not been paid. Suppose if you pay duty, then it will become duty paid goods. Until that point of time, it will be called as dutiable goods. And in the customs, dutiable goods includes exempted goods also. In GST, taxable goods do not include exempted goods, but under customs, dutiable goods includes exempted goods also. So that is one point. Then, so you can write that dutiable goods includes exempted goods. Includes exempted goods. Then what are non-dutiable goods? Non-dutiable goods means which are not chargeable to duty. Why is it not chargeable to duty? Because it is not covered under Customs Tariff Act. So when it will be called as dutiable goods? So because if you see one of the conditions which says that such goods should be in Customs Tariff Act 1975, then only it will be called as dutiable goods. Suppose if it is not in the Customs Tariff Act 1975, so then it will be called as non-dutiable goods on which there is no levy. So dutiable goods, that is which are covered under Customs Tariff Act, again may be exempted also. So that's the reason why dutiable goods includes exempted goods. Then Indian customs waters. So what will be considered as Indian customs waters? So up to 200 nautical miles. But import is said to be taken place only when it enters territorial waters. Now, yes, but as the powers of customs officer extends up to 200 nautical miles, so therefore up to 200 nautical miles is known as Indian customs waters. And export goods means, so goods which are taken out of India. And exporter, who will be called as an exporter? Either the owner or beneficial owner or any person holding himself out to be exporter. Owner in the sense the one who manufactures the goods and export the goods, that is owner exporter. Suppose if he is manufacturing and he is sending the goods through any other person, because to export goods we need a license. There are some restricted goods under foreign trade policy which requires a license. So those licensed goods can be exported only by the person who has been given an authorization, those restricted goods. So therefore I am manufacturing and you have the license, so you are exporting. I will be called as a beneficial owner and you will be called as the person holding yourself to be an exporter. You are also exporter, I am also exporter. So therefore owner, beneficial owner and any person holding himself to be an exporter. And who is the beneficial owner? On whose behalf the goods are being exported or imported. So that person is known as beneficial owner. On my behalf you are importing, on my behalf you are exporting. So I will be the beneficial owner. On whose behalf the goods are imported or exported, or who exercises effective control over the goods. Then imported goods means brought into India. So then what is importer? Same meaning of exporter and importer. Owner, beneficial owner, any person holding himself out to be an importer. Then baggage. Baggage refers to passengers' luggage or member of crew luggage. And that can be unaccompanied baggage also. Unaccompanied baggage means baggage which is not coming along with the passenger is known as unaccompanied baggage. And generally the baggage provisions will be applicable even in case of unaccompanied baggage also. But baggage does not include motor vehicle. No idiot will bring motor vehicle as a part of baggage. So no need to give that. Then coastal goods. Coastal goods means goods which are transported from a port in India to another port in India is known as coastal goods. So coastal goods also has got some restrictions. Goods other than imported goods transported in a vessel from one port in India to another port in India. In the name of coastal goods, the imported and exported goods may enter into India or leave India. So under the name of coastal goods, due to that reason, coastal goods also have certain restrictions. Then foreign going vessel or aircraft. A vessel or aircraft which is taking people or goods from India to a place outside India is known as a foreign going vessel or aircraft. Easily, correct? A vessel or aircraft which is taking people or goods from India to foreign, that is called as a foreign going vessel or aircraft. And it includes any naval vessel of foreign government taking part in any naval exercises. So naval vessels of outside India, foreign countries will be coming to India. They are also called as a foreign going vessel. Any vessel engaged in fishing operations beyond territorial waters. So it is leaving India. So therefore it is also called as a foreign going vessel. And any vessel or aircraft proceeding to a place outside India for any purpose whatsoever. So whatsoever, any purpose whatsoever. Maybe one person taking the flight to outside India to bring one terrorist will be also called as a foreign going vessel or aircraft, whatsoever purpose. Okay. Then next, options available to importer for import of goods. Option 1, That is, once you import the goods are unloaded in the port or airport or land customs station. Either the importer can take the goods directly to his place of business. Then he need to file one bill of entry called as bill of entry for home consumption. Or he can deposit the goods in the warehouse without payment of customs duty. For that, he need to file a bill of entry called as bill of entry for warehousing or inbound bill of entry, because for depositing the goods in a warehouse they need to execute one bond. That's why it is called as inbound bill of entry. At the time of clearance from the warehouse they need to file one bill of entry, that is known as ex-bond bill of entry. So in option 1, directly they will take it for home consumption. So bill of entry for home consumption. Should they pay duty at that time? Yes, they need to pay duty. Option 2, they can deposit in warehouse without payment of customs duty by filing into bond bill of entry, and thereafter they need to pay duty and clear it from the warehouse. For that, ex-bond bill of entry for home consumption. Can without filing bill of entry goods be cleared for home consumption? Impossible. So we need to pay duty, then only we can clear. However, we have one option called as deferred payment of customs duty option. What is a deferred payment of customs duty option? No need to pay customs duty now, but we can pay it at a later point of time at frequent intervals. So that is deferred payment option, but there also we agree to pay in future. But duty payment is must, and goods can be cleared to warehouse without payment of duty, but again thereafter we need to pay at the time of actual clearance, and that warehouse will be a warehouse owned by the government. No, warehouses are not at all owned by the government. Warehouses are licensed by the government. So any person who is eligible, who satisfies the licensing condition, can get a license to operate a warehouse. So that person is called as a licensee of the warehouse, and therefore customs warehouse is never warehouse owned by customs, but it is licensed by customs, and there we can deposit the goods without payment of duty. And when the bill of entry needs to be filed, either bill of entry for home consumption or bill of entry for warehousing, when it should be filed? Before the date of arrival. Previously it was within 1 day from the date of arrival was there. Now it is before the date of arrival. For example, goods are imported today. By yesterday the bill of entry should have been filed. It can be filed even before also, but it should be filed maximum by yesterday midnight. So that is the time limit for filing. What if yesterday was Sunday? So then also they need to file by that. Working days are not there, like working days, holidays, irrespective of that, before the date of arrival they should have filed the bill of entry. And suppose if they are not filing bill of entry within that time, then the late fee will be payable. And as clearance from warehouse is the taxable event, suppose at the time of deposit in the warehouse the goods are exempted. At the time of clearance from the warehouse the goods became dutiable, and whether we need to pay customs duty? Yes. So what is the taxable event under customs? Whenever we file bill of entry for clearance for home consumption, that is only the taxable event. Means at the time of import it is exempted, or at the time of deposit in warehouse it is exempted. At the time of clearance by filing bill of entry, so the goods were dutiable. Should we pay duty? Yes. Opposite, suppose at the time of import it is dutiable, we kept it in the warehouse without payment of duty. At the time of clearance from the warehouse, so the exemption is given for the goods. Should we pay customs duty? No, no need to pay customs duty. That is this. So the taxable event is at the time of clearance. At the time of clearance means either we are filing bill of entry for home consumption or ex-bond bill of entry. That will be taken as the taxable event. Then if an importer has a warehouse for which license is obtained, can he import the goods and keep those goods in his warehouse without payment of customs duty? Yes. So even he can obtain license for his own warehouse, that is called as a private warehouse. We have public warehouse and private warehouse. Public warehouse means not only the person who import the goods, his goods should be kept. Any person's goods can be kept in that warehouse, that is public warehouse. Whereas private warehouse means, so my goods only can be imported and kept in that warehouse. That is known as private warehouse. Yes, there are some exporters who are eligible to establish the private warehouses, and those exporters can import the goods, keep it in their warehouse. When they are actually using, they need to pay. But remember, whenever they are depositing the goods in warehouse, they are deferring the customs duty payment. Due to that reason, only some interest-free period of 60 days is only there. And not 60 days, 90 days is only there. After 90 days, they need to pay interest. That we will be learning in warehousing provisions. Then what are the various documents that are involved in case of import and export? In case of import, so what are the documents to be filed by person in charge? If they are importing goods by vessel, it is known as import manifest. This is to be filed by PIC, means person in charge. If it is aircraft, arrival manifest. If it is vehicle, import report. Import manifest, arrival manifest, import report. it is to be filed by person in charge with the customs officer. Whereas what is the document to be filed by the person in charge with the customs officer at the time of export? So that is export manifest, departure manifest, export report. So these documents, import manifest, import report, export report, arrival manifest, departure manifest, should contain the details of the goods present in that conveyance. So that should be given. Then what is a document to be filed by the importer? Bill of entry. Already we saw that. What is a document to be filed by the exporter? That is, in case of vessel and aircraft, we call it as shipping bill. In case of vehicle, we call it as bill of export. Then who is the person in charge? In case of vessel, it's master. In case of aircraft, it's pilot. And in case of vehicle, any conductor or guard. And only after filing import manifest, grant of entry inwards will be given in case of vessel. So vessel, they cannot come into India directly. So they have to get the grant of entry inwards. When they will get grant of entry inwards? Only after they file the import manifest. But that import manifest, captain of the ship cannot file, because he cannot anchor the vessel, cannot swim and file the import manifest. So his agents will be filing it. So only after filing import manifest, grant of entry inwards is given for the vessel. But this grant of entry inwards concept is not applicable in case of aircraft and all, because where they can keep the aircraft until that point of time. So therefore the aircraft will come. But the grant of entry inwards is only for the purpose of unloading the goods. That is this. Then along with bill of entry, importer has to submit one document proving that he is the owner of the goods. What is that document? Document of title to the goods. In case of aircraft, it is airway bill. In case of vessel, it is bill of lading. In case of vehicle, either lorry receipt or railway receipt. Along with that, invoice also he need to submit. What are the three documents that will be submitted by a importer at the time of filing bill of entry for clearance? First, bill of entry. Number 2, document of title. Number 3, invoice. So based on that only the goods can be cleared. Okay. Then what is the taxable event? Already I told you. In case of import, the date when goods cross the customs barrier is known as taxable event. It is not the date when goods enter into the India. So entering into India, unloading in India is not the taxable event. The day when we take it out of the customs, that is only taxable event. So therefore either clearance for home consumption or clearance after warehousing, not clearance for warehousing. Clearance for warehousing, still import is not there. Only when we clearance from warehouse, so then only import has been taken place as per Kiran Spinning Mills case and Garden Silk Mills case by Supreme Court. Whereas what will be treated as export, the taxable event in case of export, as per Rajendra Dyeing and Printing Mills case and Sun Exports case, the date when goods cross the territorial waters, then only it will be treated as export. Until that point of time, it will not be treated as export. So that is about these two cases. So taxable event in case of import, the goods cross the customs barrier. And what is the taxable event in case of export? The date when goods cross the territorial waters. Then section 15 and 16 talks about the relevant date for determination of rate of duty and exchange rate. In case of import, it is section 15. In case of export, it is section 16. So section 15 says, if the goods are imported by aircraft, or vehicle, then date of presentation of bill of entry or date of arrival, whichever is later. Option 1. I am talking about option 1. What is option 1? Imported goods directly taken for home consumption. So what should be taken as a relevant date? Date of presentation of bill of entry or arrival of the aircraft, whichever is earlier. Whichever is earlier or whichever is later? Whichever is later. Not whichever is earlier, whichever is later. Usually which will be later? So it is arrival of aircraft or vehicle only later, because we need to file the bill of entry before the date of arrival. So whichever is later will be the date of arrival. Suppose at the time when we file the bill of entry to the arrival of aircraft, there is a change in rate. But which rate will be taken? At the time of arrival only, because now whichever is later. Previously this problem was not there, because bill of entry will be filed after arrival. Okay, can be filed after arrival, within 1 day after arrival, like that we can file. So whichever is later could be bill of entry date, but now bill of entry has to be filed before the date of arrival. So whichever is later will be definitely arrival. Suppose if there is any change in rate of customs duty, we need to take the rate prevailing at the time of arrival. Then what we need to do? There is a concept called as amendment of the bill of entry. We can do amendment to the bill of entry for amending the rate and pay the differential amount. And for that we don't have to pay any charges. For that amendment we don't have to to pay any charges, we can do that. But this will not happen now and then. Only during the budget time this problem will arise. That is, whenever government gives a notification for increase or change in the customs duty rate, so this will happen. So therefore, we need to take date of presentation of bill of entry or date of arrival, whichever is later. Whereas in case of imports by vessel, then we need to take same date of presentation of bill of entry or grant of entry inwards, whichever is later. But here which will be later depends. Sometimes date of bill of entry later, sometimes grant of entry inwards later, because they give grant of entry inwards, but the arrival could be later. Grant of entry inwards given, thereafter bill of entry submitted, thereafter the vessel has come. Okay, so therefore bill of entry and grant of entry inwards only we see, not the date when vessel has arrived. So therefore that is whichever is later will be taken. Then this is in case of option 1, that is imported goods directly taken for home consumption. Then what will be the exchange rate? The date on which we present the bill of entry. What is the date on which we present bill of entry? That is for home consumption only, one bill of entry only, that bill of entry only will be taken. Then suppose if it is option 2, in case of option 2, goods are deposited in warehouse. So we need to take for exchange rate into bond bill of entry. The date on which we presented the bill of entry for warehousing should be taken for exchange rate. But for rate of duty, we need to take the rate of duty prevailing on which date? When we actually do the clearance. So what is the date on which we actually do the clearance? We will be filing a ex bond bill of entry. So that ex bond bill of entry for clearance from warehouse for home consumption should be taken. This is the relevant date for determination of rate of duty under section 15 for import. In case of section 16, so what is the relevant date for determination of rate of duty? Let export order, the date when customs officer passed the let export order, that will be taken. For exchange rate, it is shipping bill or bill of export. And whose exchange rate should be taken? Exchange rate determined by CBIC should be taken. And in case of improper imports and improper exports, okay, in case of improper imports and improper exports, so the relevant date is the date on which we pay the duty. Just like time of supply and residual cases, the date on which we pay the tax is taken as the time of supply, like that. The date on which we pay the duty, that will be taken as the relevant date for determination of rate of duty. What is improper import, improper export? Smuggling. In case of smuggling, there is no bill of entry, grant of entry inwards, etc. So that's the reason why whenever we pay duty, that date what rate is there, that should be taken. So this is the taxable event. So here mainly what will be tested is the table. So relevant date for determination of rate of duty and exchange rate, that will be tested in practical questions. So they will be giving this as one adjustment. So be careful with respect to that. Apart from that, there is nothing in that. So if at all they want to ask definitions, they can ask, but till date in new syllabus they have not asked one question also on the definitions. Then the next segment that you have is classification of goods under customs. So here for the purpose of classification of goods under customs, again we will not be getting any descriptive questions and all in this. So only MCQ type questions, that is general interpretative rules. The general interpretative rules might be tested. So we need to know about the general interpretative rules. Along with rule number, try to remember. So rule number 1 says that titles are for reference only. That is in Customs Tariff Act. When you see the headings, tariff headings, that is for reference. But whenever there is a dispute between the headings in the tariff versus the chapter notes and section notes in the tariff, which will prevail? Chapter notes and section notes will prevail over the headings. What does chapter notes and section notes says? That only will be relevant, but not the headings. Got it? So therefore, which will have overriding effect? The section notes and chapter notes will have overriding effect. Like that you remember. Rule 1, section notes and chapter notes will have overriding effect, but not the headings. Okay. Then next, rule number 2A, it says that any reference to complete goods also includes reference to incomplete or unfinished goods. For example, we are importing a car without tires, car without seat. Car without tire and car without seat will have the essential character of a car. So therefore, along with car only we will be classifying. We will not call it as parts of car. We will call it as car only. Then next 2B, any reference to a material includes combination of that material with the other material. You can write examples if you want. So rule 2A, example. So car without tire and seats classified as car. Below that I have given space, there you write down. Don't worry, lot of space is there. So there you write down example for rule 2A. car without tires and seats treated as car. Treated as car. So therefore it will be classified along with car. Next. 2B. 2B is any reference to a material includes combination of that material with other material. Example, so coffee with chicory will be classified as coffee only. So because any reference to a material includes combination of that material with other material. Coffee powder, example you write down for this, coffee powder with chicory. Usually chicory is an element, it's a tree extract. That powder will be mixed with the coffee powder to neutralize the nicotine content into the coffee. So people advise that 70-30 or 80-20 is best, otherwise 100% pure coffee powder if we consume, so that is not good for health. So therefore this coffee powder in which a little bit element of other chicory powder is there, just because of that it will not become some other product, it will be still a coffee powder only, it will be classified along with coffee powder. Then specific description shall be preferred to heading providing general description. 3A, rule 3A, first rule 1, titles are for reference. Rule 1, titles are for reference. Rule 2A, so incomplete or unfinished goods classified with completed or finished goods. 2B, any reference to material includes combination of that material with other material. Now 3A, prefer specific over general. What is that? For example, you are importing a shaver. This shavers, we have under two separate headings. Electric shavers we are importing. Electric shavers are having two headings. One is domestic appliances with motor, another is shavers and hair clippers. Which is a specific heading to this? Shavers and hair clippers is specific heading. Write down. Electric shaver classified under shavers and hair clippers instead of electric shavers classified under shavers and hair clippers instead of appliances with motor. Domestic appliances with motor. Domestic appliances with motor means it includes mixie, grinder, everything will come under domestic appliances with motor. But shavers and hair clippers is a specific heading, that one. And then rule 3B says, if a particular product is mixture or combination, composite of different articles, then the classification will be based on essential character. For example, so pencil with eraser classified along with pencil because the essential character of that is pencil only. So pencil with eraser classified under pencil. Example for rule 3B, pencil with eraser classified along with pencil. Then rule 3C, if both the headings are specific, then prefer the latter the better, means that heading which comes last in the numerical order should be taken. So 8702, like that one heading is there, motor vehicles for transportation of persons, and 8704 is there, motor vehicles for transportation of goods. So there are two headings, one is motor vehicle for transportation of persons, another is motor vehicle for transportation of goods. Tata Ace is a vehicle which is capable of transporting both people as well as goods. Some places they will be using people for transportation, some places they will be using goods. Then where it should be classified? Both are specific, therefore it should be classified under last heading. So which comes last in the numeric order. So that last in the numeric order is transportation of goods. Okay, so write down. So Tata Ace classifiable under motor vehicle for transportation of goods. Tata is classifiable under transportation of motor vehicle for transportation of goods because it is the last heading applicable. Then next, akin goods. Akin goods means similar goods. So whenever we cannot classify a particular product into any of the heading, then we will be taking akin goods rule. So rule 4 talks about akin goods, which says that suppose if there is electric, like sun microfilms, which are there for the cars to protect from the sun glare. So they will be putting that films, okay, black color films they will be putting. Allowed, it is allowed in India, okay. So only thickness, the thickness matters. So therefore the sun glare films are allowed. But for that sun glare protector films, we don't have any kind of heading. So that is classified along with So blinds used for closing the windows. Curtains and blinds which are used for closing the windows, that is akin goods, similar goods. Then packing containers and packing materials can be classified along with the main articles. Example, write down violin box classified along with violin. Violin box cannot be used for any purpose. It can be used only for the purpose of violin. So it is classified along with violin. Of course, little bit of exceptions will be there, that AK-47 and all they will be carrying inside violin box in some movies. But that is irrelevant. But what we need to see is violin box is used only for the purpose of taking violin. So it should be classified along with violin. And goods can be compared only at the same level, which says that, so one heading cannot be compared with a subheading. So one subheading cannot be compared with a tariff heading. Heading to heading, subheading to subheading, tariff heading to tariff heading. Goods can be compared only at the same level. So that is this. These are the 6 rules that you need to remember, because they will be giving a situation and they will ask which of the following rules are applied in this case. So therefore, there you should not get confused. That's why I am asking you to remember, because already one MCQ has been asked in this. That's why. Then segment number 23, types of customs duties. How to compute the customs duty payable? There is a particular format which we need to follow for computing the customs duty. First we need to arrive at the assessable value. Say the assessable value is 1 lakh. So then we need to take the basic customs duty. That basic customs duty will be given in the question. You don't have to do anything with respect to that. So this basic customs duty will be given. You don't break your head what should be taken as the rate. So basic customs duty at the rate of say 15% on assessable value. So assessable value 15%, 1 lakh into 15%, 15,000 will be taken as basic customs duty. To this basic customs duty, we need to add social welfare surcharge. Social welfare surcharge will always be 10%. You need to remember this. At the rate of 10% calculated on what? Calculated always on basic customs duty. So therefore 1,500 will be taken as social welfare surcharge. Then there is something called as CVD. CVD refers to countervailing duty, to counterbalance the excise duty on like articles. So for example, if there is alcoholic liquor for human consumption, is there a excise duty? Yes. And on petroleum products, is there a excise duty? Yes. So therefore this CVD at present is levied on those 2 goods. So countervailing duty under section 3 subsection 1 was levied in order to counterbalance excise duty. You can see that in order to counterbalance excise duty, and special additional duty under section 3(5) was levied in order to counterbalance sales tax. At present, wherever there is excise duty, in that place there will be CVD. Wherever there is sales tax, in that place there will be SAD. Now, suppose in question if they give CVD, not yet tested so far, but they may test it. Suppose if they give CVD in the question, that rate definitely will be given, you don't have to worry. So this rate will be given in the question. At what rate? Say for example 12.5%. It should be computed on what? CVD should always be computed on assessable value plus basic customs duty plus social welfare surcharge. So you take assessable value 1 lakh plus basic customs duty 15,000 plus social welfare surcharge 1,500. So 1 lakh 16,500 into 12.5%. So that will be 14,562.50, and don't round off any calculations. So you take with 2 decimals and at the end you calculate the total value rounded off to nearest to 1 rupee. But intermediate calculations don't round off, then only your answer will match with the the suggested answer or guideline answer once whatever is provided. So for the sake of that, please don't round off. And now if you add these 3, that is known as customs duties excluding additional customs duties. Excluding additional customs duties. Even though CVD is additional customs duty, but it will come in the first itself. First block itself it will be coming. Now, what is the total? 15,000. Don't total assessable value. Assessable value will always be separate. Wherever required only we need to take assessable value into calculation. Otherwise it will be separate. So 15,000 plus 1,500 plus 14,562.5, that will be 31,062.50. Now to this we need to add 3 additional customs duties. Those 3 additional customs duties are, so safeguard duty, and then anti-subsidy duty, then anti-dumping duty. ASD refers to anti-subsidy duty, ADD refers to anti-dumping duty. This safeguard duty is levied under section 8B, whereas anti-subsidy duty is levied under section 9. Anti-dumping duty is levied under section 9A. So we need to take this and how to compute this. So this we will see, like whatever is the computation as per prescribed method, so that we need to follow. Usually safeguard duty will be a percentage, anti-subsidy duty will be a percentage. So that percentage only we need to follow. What is that percentage? This safeguard duty and anti-subsidy duty will be a percentage of either assessable value or the landing value. Okay. So safeguard duty and ASD is a percentage of assessable value or landed value. What is landed value? Landed value means what? Please, landed value means what? Assessable value plus basic customs duty plus social welfare surcharge is known as landed value. So safeguard duty and anti-subsidy duty, they will give percentage in the question. So whenever they give percentage, only one rate you need to remember, that is social welfare surcharge. Everything will be given in the question. Sometimes social welfare surcharge also will be given in the question. You don't have to break your head. Suppose if it is not given also, we need to take social welfare surcharge, 10% of basic customs duty. And this safeguard duty, anti-subsidy duty, that percentage given in the question, we need to closely look into the question whether it is AV or LV, landed value. Suppose if they have not given anything, you take it on assessable value. If they have given, you follow that. That is assessable value. Definitely they will give on what? Assessable value or landed value. If it is landed value, be careful. Calculate assessable value plus basic customs duty and social welfare surcharge. And then how anti-dumping duty will be computed? For that we have a prescribed method. That is dumping margin or injury margin, whichever is lower. So that should be taken. So what should be taken in case of anti-dumping duty? So in case of anti-dumping duty, ADD is lower of A, dumping margin. What is dumping margin? Who is dumping the goods into India? So the exporter is dumping the goods into India. So dumping margin should always be seen from the exporter perspective. Please concentrate. So lot of points I wanted to cover, because these are all some areas which are not yet tested. That's why listen. So dumping margin means from exporter point of view. So what should be taken as dumping margin? The price at which exporter is selling the product in his country minus the price at which he is exporting to India. That should be taken. That is normal selling price in exporter's country minus export price to India. What if there is no normal selling price in his country? We need to take the price at which he exports to a third country, not India, third country. That should be taken as the normal selling price. What if he is not exporting to a third country? Then in that case, cost of production plus usual profit margin should be taken. Understood or not? So 3 points. Either we need to take normal selling price if available. If that is not available, we will be taking the price at which they are selling to a third country. If that is also not available, then we will be taking cost of production plus usual profit margin of whom? The exporter. So therefore dumping margin equals to, so normal selling price where normal selling price of exporter minus export price to India, that will be taken as the dumping margin. Then B, injury margin. What will be taken as injury margin? Injury margin means who is getting injured? The domestic industry is getting injured. So we need to take to what extent they are injured. That is the price at which they are selling in India minus the landed cost of the imported goods. The landed value of the imported goods should be taken. So normal selling price in India, say the normal selling price in India is $100, okay, minus landed value of imported goods. Landed value of imported goods is $80. So then how much will be taken as the injury margin? $20. $100 normal selling price minus landed value $80. So the $20 will be taken as the injury margin. Whereas dumping margin, so they are selling in their country for $75. And they are exporting to India at $50. So what is the dumping margin? $25. $25 or $20, whichever is lower, $20 should be taken as the anti-dumping duty. So lower of dumping margin or injury margin. So that should be taken. So now once we take these three, then we need to add this. So that we will be calling as, so that 31,062 plus these three, 31,062.50. Now it will be called as customs duties excluding IGST. So then we need to add IGST, but IGST will be computed again at the rate that will be given in the question itself. Say at the rate of 18%. On what it will be computed? IGST is computed on assessable value plus customs duties. Assessable value plus customs duties so far. So then you take assessable value 1 lakh. 1 lakh plus 31,062.5. 1,31,062.5 into 18%. So that will be 23,591.25. So this will be called as total customs duties payable. Total customs duties payable, that is 54,653.75. So 54,653.75 will be taken as the total customs duties payable. And suppose if there is any compensation cess, where that compensation cess will come as a part of this last. And there is something called as SAD, where SAD will come as a part of this. Whenever there is IGST, there is no SAD. They both are mutually exclusive, because SAD is applicable on what? SAD is applicable wherever there is sales tax. So there is sales tax on alcoholic liquor for human consumption and petroleum products, but SAD on alcoholic liquor is removed. So we don't have to levy at all, not there. But SAD is applicable only on one product, that is petroleum products. But petroleum products, there is no IGST. So IGST and SAD will never come. Okay, wherever IGST is there, SAD will not be there. Wherever SAD is there, IGST will not come. But both are computed same way. IGST is also computed on what? Assessable value plus total customs duties. SAD also computed what? Assessable value plus total customs duties. That is this. Then next, note 2, in case of exports, only basic customs duty is payable. We don't have to pay anything else. IGST, social welfare surcharge, nothing is payable. Only the basic customs duty is payable. In case of warehoused goods sold by way of transfer of warehouse receipt, that is, whenever we are importing the goods and we are keeping the goods in the warehouse and we are transferring the document of title called as warehouse receipt, then in that case, what should be taken as the assessable value? So normal, the price at which original importer has imported. For example, I am the original importer. I imported the goods. I kept it in the warehouse. I imported for $10,000 and I kept it in the warehouse. Now I sold it to you for $12,000. Now customs duty computation. Basic customs duty always computed on original import price. What is the original import price? $10,000. But for IGST computation, what we need to do? IGST on assessable value plus customs duties, assessable value plus customs duties into 18%, or transaction value into 18%, whichever is higher. What is the transaction value? The $12,000. So therefore, for IGST purpose only it will differ whenever the warehoused goods are sold. Please see this. So in case of warehoused goods sold by way of transfer of warehouse receipt, IGST under customs shall be computed on assessable value plus basic customs duty plus social welfare surcharge, all sale value of such warehouse receipt, whichever is higher, that will be taken. And one more point, when basic customs duty is nil, social welfare surcharge is also nil. So because social welfare surcharge is 10% of basic customs duty, due to that reason. Okay, but what we need to do is that don't just take basic customs duty as 0. Don't just take basic customs duty as 0. So please take basic customs duty, then social welfare surcharge, compute IGST, and then exempt the basic customs duty. This is one important point which you need to know. For example, in the above case, what is the assessable value? Assessable value is 1 lakh. And what will be the basic customs duty? Basic customs duty is exempted. But before exemption, what is the rate? That we need to know. Definitely, if rate is given and then if they are telling exempted, so take the rate. First take the rate. Say 10%, 10,000. Social welfare surcharge at the rate of 10%, that will be 1,000. So now 11,000 you will get. Then you need to take IGST. IGST at the rate of 18%. So IGST at the rate of 18% will be how much? 1,11,000 into 18%. 1,11,000 into 18% is what? 19,980. So now what is the total customs duty payable? Total customs duty payable is 19,980 if it is exempt and if it is exempt. When basic customs duty is exempt, then social welfare surcharge also exempt, then we need to pay 19,980. Then what our students will do? anyhow these two are exempted. So then 18% they compute on 1 lakh. 1 lakh into 18%, 18,000. That option also will be there. So we will be selecting 18,000. Yeah, shabash, we wrote correctly, like that we will think. But the answer is 19,980. So please be careful with respect to that. Provided if the rate is given in the question and thereafter they are telling it as exempted. Suppose if they have not given rate, super. Directly you will take 18,000, but that is easy. So they know that kids also will do that. So they will be giving a rate and then telling exempted because they wanted you to commit the mistake. But be careful with respect to this because it's the latest amendment. Then additional customs duties on import. So we have protective duty, safeguard duty, anti-subsidy duty and anti-dumping duty. So these are the 4 additional customs duties. But protective duty is not an additional customs duty as such, but it is increase of the basic customs duty. So therefore here what we will do is that regular basic customs duty is 10% means the revised basic customs duty once protective duty comes into the picture will be 40%, like that, okay. And whereas safeguard duty, anti-subsidy duty and anti-dumping duty are separate line items, okay. When safeguard duty is levied in case of fair export, so that is they are exporting fairly but we are importing in large quantities, so then only safeguard duty will be applicable. Anti-subsidy duty, unfair export, so they are exporting unfair by exporting country, that is exporting country gives subsidy to the product, so the product is being imported into India at a cheaper rate, so that is known as unfair export by the exporting country. Then anti-subsidy duty will be levied. So they are giving subsidy to their manufacturers. Who is giving? For example, China is giving subsidy to their manufacturers to sell it to India at a lesser rate. So then there will be anti-subsidy duty on that goods. Then anti-dumping duty. This is not by the exporting country, but it is unfair export by the exporter. So whenever the exporter manufactures it in large quantity and then economies of large scale production he achieved, now he will be dumping into India at a lesser price, then also the domestic industry gets injury. So for that reason they will be levying anti-dumping duty. So safeguard duty, fair export or unfair export? Fair export, but in large quantities by the importers in India. Then next, so what about anti-subsidy duty, in which case unfair export but on account of exporting country's mistake. And then anti-dumping duty, unfair export by whom? By the exporter. So then sections, so protective duty 6, 8B for safeguard duty, 9 for anti-dumping duty and 9A for, 9 for anti-subsidy duty, 9A for anti-dumping duty. Who will be levying protective duty? Central government, but on the recommendations of Tariff Commission, which means that Tariff Commission from time to time will look into the goods and they will be giving recommendations for increase in the rates, so that central government will implement. But the other 3 are not recommended by Tariff Commission, so the person should make a complaint. The domestic industry should make a complaint levied by central government upon receipt of complaint or information. So then they will conduct the investigation and then they will be levying these 3 additional duties. So what is the relief? Relief in case of protective duty to protect the domestic industry against import, whereas in case of safeguard duty to protect the domestic industry against imports in large quantities. Then anti-subsidy duty to protect the domestic industry against imports at a cheaper rate on account of export subsidy enjoyed on the product. Then in case of anti-dumping duty to protect the domestic industry on accounts of imports at a cheaper rate. Okay, so both cases it is same. Anti-subsidy duty, anti-dumping duty, both cases goods are coming to India at a cheaper rate. But why it is coming at a cheaper rate? Because of the subsidy, then anti-subsidy duty. Because they are dumping to India, then anti-dumping duty. And what is the extent of relief? So protective duty is just increase to the basic customs duty, nothing else. Whereas in case of other 2, anti-subsidy duty and safeguard duty, I told you already it will be a percentage. So rate will be given in the question, so that we need to follow. Whereas anti-dumping duty, dumping margin or injury margin, whichever is lower, that should be taken. Then investigation, in case of protective duty, no investigation required. Why no investigation is required? Because already Tariff Commission recommendations they are implementing, that's why. Whereas in case of other 3 it is required because that is based on any complaint made by the domestic industry. And until the time the investigation is completed, they will be doing a protective, that is till the time a provisional levy will be made. So because to protect the domestic industry, a provisional levy will be made, and this provisional levy will be until investigation. What is the time limit by which the investigation should be completed? In case of safeguard duty, 200 days. For MCQ purpose it is important, and in case of anti-subsidy duty 4 months, and in case of anti-dumping duty 6 months. So 200 days, 4 months and 6 months. Suppose upon finalization, that is they have decided not to levy this, then whatever they have levied will be refunded. Suppose if they have decided to levy but at a higher rate, then the differential amount will be collected. So refund allowed or differential duty payable. What is the duration of levy? So in case of safeguard duty, 4 years plus 6 years, but the maximum time is only 10 years. Whereas in case of other two, anti-subsidy duty and anti-dumping duty, 5 years plus 5 years plus 5 years plus 5 years, like that infinite 5 years. There is no maximum time limit. They can levy it because that is on account of unfair export. But in case of safeguard duty, it is a fair export. So maximum 10 years. But the other two can be for an unlimited time they can levy. However, they need to do review for every 5 years to decide whether to extend it or to drop. And now they could not complete the review within 5 years. So then, that is they have not decided to continue or drop. Then there will be automatic extension for 1 year. Automatic extension for 1 year if not decided whether to extend or not within the expiry of 5 years. So this automatic extension is there for 1 more year. So this means in this 1 year they need to decide. What if they have not decided within 1 year? Then the anti-subsidy duty and anti-dumping duty will not be there. Okay. Then exemption from levy. All three, that is safeguard duty, anti-subsidy duty, anti-dumping duty, is exempted for import by 100% EOU or a SEZ. However, that EOU or SEZ is then clearing it to DTA, means there will be anti-subsidy duty, anti-dumping duty, safeguard duty, because the intention is for consumption in that EOU or SEZ only they have given exemption. But if they are clearing it to DTA in the same form or in any other form, they need to pay the duties. Retrospective levy. Safeguard duty cannot be levied retrospectively because that is there is no mistake on the part of exporter. As Indian importers are importing in large quantity, that is not a mistake of the exporter. So no retrospective levy. But the other two, anti-subsidy duty and anti-dumping duty, can be levied retrospectively in order to preclude such recurrence. Okay, so that is it should not happen. That's why they will be levying retrospectively within 90 days prior. That is within 90 days prior. They can give a notification today for levy within 90 days prior. That is both in case of anti-subsidy duty, anti-dumping duty, this retrospective levy is there. And note, in case of imports in large quantities, government can also resort to tariff rate quota. What is tariff rate quota? That is they will be fixing this much only quantity you can import, and if you are importing more than this quantity, so then you need to pay extra duty. That is known as tariff rate quota. Yearly they will be fixing a quantity for import of a particular product from a country. Beyond that, if you are importing, so they will be telling that you will not be able to import at that rate, means you need to import at a higher rate of customs duty. That is known as tariff rate quota, and that is also can be levied as a safeguard measure instead of safeguard duty. And then anti-subsidy duty and anti-dumping duty are mutually exclusive. So 9 and 9A. So 9 and 9A both are for the same reason, because goods are imported at a cheaper rate. So due to that reason, so if one is levied, the other will not be levied. Then special points on above. Non-applicability of safeguard duty. Articles originating from developing country. So that is when there won't be any safeguard duty. So two cases, already we know one exemption. What is that exemption? Imports by 100% EOU or SEZ. In that case, there is no safeguard duty. Apart from the two cases, there is no safeguard duty. That is, you are importing from one developing country, and import from that developing country does not exceed 3% of the total imports of that article into India. Then for that country alone, so there is no safeguard duty. Generally, safeguard duty is product price. So on that product there is safeguard duty. But if that product is imported from a country, so if that does not exceed, which country I am importing? Developing country. How many developing countries? One developing country only. from a developing country, one developing country, and that does not exceed 3% of the total imports of that article into India, then there won't be any safeguard duty. Suppose if I am importing from more than one developing country, then import from all developing countries together does not exceed 9%, but which should be taken together with less than 3% should be taken together. Say for example, so A, B, C, D. So I am importing here 3.8%, 2.5%, E also. Okay, country A, all these are developing countries, and on this product there is safeguard duty. On this product there is safeguard duty. Okay, A, B, C, D, E. On this product there is safeguard duty. What is the percentage? 3.8%, 2.5%, 1.6%, then 2.9%, and then 2.8%. Like that I have imported. Then what is remaining? Remaining from developed countries. Now what I should do? So I have to take with less than 3%. What are the countries with less than 3%? These countries. So taken together 2.5 plus 1.6 plus 2.9 plus 2.8. Quickly do total. 9.8. So as it exceeds 9%, so A definitely safeguard duty will be there. B also it will be there, C also it will be there, D also it will be there, E also it will be there. Why? Because we will never take more than 3. We will take only less than 3. Less than 3, not equal to 3 also. We will take less than 3. And in that less than 3, taken together, those countries should not exceed 9%. Here it exceeds. So there will be safeguard duty. Suppose in this E case, in this country E case, it is 1.2%. 1.2%. Then how much it will be? 8 point. So some less than 9, correct? So does not exceed 9%. So then will there be safeguard duty on these countries? No. There won't be safeguard duty on import from B, C, D and E. So that is what this point is. Article originating from more than one developing country, so long as the aggregate imports from developing country with less than 3% taken together does not exceed 9%. Then circumvention of anti-dumping duty and anti-subsidy duty. You are trying to escape from anti-dumping duty, anti-subsidy duty by changing the description or name of the article. So an article is attracting safeguard duty, that is anti-subsidy duty or anti-dumping duty. So now you change the description. Same article you are importing under another description. So you are escaping from this. Same way, you are importing it in unassembled or disassembled form, so that there won't be any anti-subsidy duty or anti-dumping duty, because anti-dumping duty applicable on car. So you are importing car like parts, so that you are escaping from this. Or you are changing the country of origin or export. So import from China attracts anti-subsidy duty. So you are taking from China to somewhere another country, and from that another country you are bringing it to India. So then also you are escaping this. When you try to escape from anti-dumping duty or anti-subsidy duty by following these three, previously once a notification is given, that will be valid for 5 years. So but now means they cannot alter that for 5 years, but now they are telling it can be altered. So they will alter that notification and they will extend that notification even for these goods if you change the description of that goods, and they will be extending it for unassembled or disassembled goods, or they will be extending it for a different country of origin also. It may extend ASD or ADD to such other articles also, from such date not earlier than the date of initiation of inquiry. So that is this circumvention of anti-dumping duty, anti-subsidy duty. Then absorption. Absorption in the sense, like whenever we have got some anti-dumping duty, so to compensate that anti-dumping duty, exporter reduces the price further. For example, exporter's price is $40. Exporter's price is $40. And in his country he is selling for $80. Okay, this is the normal selling price. This is the normal selling price, and this will be export price. So therefore, anti-dumping duty is levied as lower of this. So that is A. 1 second. Import price also will take. So import price is, say they are exporting for 40. So here by the time it comes, it may be $55. And normal selling price in India normal selling price in India will be say somewhere $60, okay, $60. Then what will be the anti-dumping duty? Anti-dumping duty is $5 per unit. How? What is the difference between these two? 5. And what is the difference between these two? 40. So therefore anti-dumping duty will be $5, okay. And now, so what happened? So therefore the import price will be 55, add anti-dumping duty, so they will be taking it at $60. Now exporter has given a further reduction, so $40 he made as $35 in order to give relief to the importer in India, because $40 if he is paying, so then more or less the same selling price in India. So due to that reason, so export price has been slashed down by $5 in order to absorb this $5. Now again what government can do, they can increase the anti-dumping duty to $5. You reduce it to $10, they will increase it again by that $10. You understood or not? So this is known as absorption. Previously this absorption concept was not there, but now they have brought in, where central government on such inquiry as it makes necessary is of the opinion that absorption has taken place, whereby anti-dumping duty so imposed is rendered ineffective. It may modify such duty. Previously, once a notification was given, they were not having power to modify, but now they can modify, okay. That is this absorption. And when absorption takes place, if there is a decrease in the export price, if there is a decrease in the export price without any commensurate change in the cost of production, means whatever anti-dumping duty levied in India or whatever anti-subsidy duty levied in India, in order to absorb that, the exporter is reducing the price to give the benefit to the importer, then only import articles will become cheaper, okay. So then in that case, so whatever benefit now again exporter has given, to that extent, so Indian government can add it to the anti-dumping duty, thereby increasing the anti-dumping duty or anti-subsidy duty. Then what are the old customs duties and how is it connected? For example, if you are locally selling alcoholic liquor for human consumption, you need to pay state excise duty, CST and VAT. On import, wherever excise duty is there, there is CVD. Wherever sales tax is there, there is SAD, but the SAD is omitted, which means on import of alcoholic liquor, we need to pay only CVD. Then on petroleum products, locally sold, we need to pay excise duty, CST and VAT. As excise duty is there, CVD is there, as CST or VAT is there, SAD is there. Then tobacco products, we need to pay excise duty and GST. As excise duty is there, CVD is there. As GST is there, IGST also will be applicable. Then other goods, on other goods only GST is there. So therefore only IGST will be applicable. So I just connected the domestic to the import so that you can remember it easily. Only exception is this place. Even though on sale of alcoholic liquor, there is sales tax, but on import of alcoholic liquor, we don't have any SAD. Computation already we discussed. Now there is one section 19, that is articles liable to different rate of customs duty. So we are bringing a set of articles. So in that set of articles, so as a pack we are bringing, there is DSLR camera and there is tripod and there is lens and there is storage card. So like this, we are importing 4 articles as a package. When we are importing 4 articles as a package, how we need to determine the payment of customs duty? Now, first we need to see whether they are liable to duty at same rate. Yes, then don't worry, whatever is the value and on that value you pay the same rate, there is no confusion. No, they are liable to duty at different rates. Say DSLR is at 10%, then tripod is at 10%, lens is at 15%, storage device is at 20%. Like this, different rates are there. So then, can we ascertain the value separately? Yes, we can ascertain the value separately for this. Say DSLR is $1,500, tripod is $50, lens is somewhere $500, storage card is some $100. Then what we can do? Simple, respective rate will be taken on the respective value, respective rate on respective value, like individual supplies. GST is there, na? Like that. Suppose if the separate value cannot be ascertained, means compulsorily supplied along with the main article, then so that is separately not ascertainable, but this tripod, lens and storage card is compulsorily supplied along with main article. Then what we need to do? Simple, for this tripod, lens and storage, means we don't have the separate values like this. We don't have the separate values like this, but together everything is brought for $3,200, like that it is brought. Then what we need to do? Simple. Is this 3 an accessories of camera? Yes, these 3 are accessories of camera, compulsorily supply along with camera, and separately there is no price. Then simple, on entire 3,200 we will be taking only the rate applicable to the main article, like a principal supply we will be applying. Got it? Suppose, no, these are not compulsory accessories, these are optional accessories. Means if you don't want this, you don't have to pay for it, you have to pay only for the camera. Then in that case, but it is supplied as a group with 3,200. Now the mixed supply concept gets attracted. What is the highest rate? 20%. Then entire 3,200 will be taxable at 20, dutiable at 20%. So capable of supply separately, but separate price not available. So entire consignment chargeable to duty at highest rate. Only 3 points you need to remember. That is separate value available, take separately. Separate value not available, but compulsory accessories, rate of main article. And it is not compulsory accessories also, optional accessories only, highest rate. Suppose in this, if some of the goods are dutiable to nil rate, then what will happen? If some of the goods are dutiable to nil rate means, so for example, 15% lens is there na, so that 15% lens you take it for 0%, then what will happen? In that case also we need to pay the same way. In that case also we need to pay the same way, that is that highest rate whatever is there, that highest rate only. So that is what, if suppose there are some articles not liable to duty, they will be chargeable to duty at the rate at which articles liable to duty with reference to value are liable as adjacent. Got it? Which means, suppose if this tripod I am taking as 0%, then also entire 3,200 into 20% only, it will not change. Don't separate the tripod. Okay. So that is with respect to rates. Then we are moving on to valuation under customs, segment 24. See that. So valuation in case of import and valuation in case of export we need to know. In case of import, we need to take CIF price. CIF price means the price prevailing at the importer's port is known as CIF price, but the price prevailing at the exporter's port is known as FOB price. Okay, and the link is simple. FOB price means, so the price prevailing at the exporter's port, and for that if you add the freight and insurance, you will be getting the CIF price. So what is the connection between FOB price and CIF price? CIF full form is what? Cost, insurance, freight. So therefore in the place of cost you add FOB. So FOB plus freight plus insurance will be called as CIF. So therefore what is taken as assessable value? And section 14 deals with the transaction value concept. Section 14 is valuation under customs. Section 12 levy. Section 13 is pilferage. Section 14 is valuation. 15 and 16 is relevant date for determination of rate of duty. Same way like GST, I have given a customs section index summary at the end. So therefore, you please try to remember these section numbers also, so that it will definitely help you while writing the exam. Okay. So section 14 says that what is the assessable value in case of import? So it should be CIF price. What is CIF price? FOB price plus insurance plus freight will be taken as CIF price. FOB price plus insurance plus freight will be taken as CIF price. Insurance, if ascertainable, take actuals. If not ascertainable, take 1.125% of FOB. And freight, if it is ascertainable, then again divide it into two. Air freight or other freight. Air freight, we will be taking actuals or 20% of FOB, whichever is lower. And suppose if it is others, then we will take actuals. And if it is not ascertainable, even if ascertainable, air freight should be restricted to 20% of FOB. And whereas in case not ascertainable, always it will be 20% of FOB. But when we take these percentages, be careful. It should not be on the FOB that is given, FOB that is revised. So how FOB will be revised? There will be some inclusions and exclusions. We need to make that inclusions and exclusions, and we need to revise the FOB price. On that revised FOB price only, this 1.125%, 20% and all will be computed. Okay. Then In that, the moment when you take freight, what will be there in freight? Cost of transportation. So what are all part of freight that we need to know? This is the place where generally we get confused. So first we need to take, I'll give you the template, simple only. First we need to take FOB price. That FOB price given should be taken. Then we need to take adjustments. Then we need to make some adjustments. When you make some adjustments, you will be getting revised FOB. To this revised FOB, only two things we will add, nothing else. Only two things we will add. What is that? Freight and insurance, nothing else. Okay, freight and insurance. So therefore, always freight and insurance should be taken at the last. So then only you will be getting CIF price. Okay. So FOB price given, what are those adjustments we will see. But freight when we are taking, ensure that this freight is from the factory of the exporter till the port of importation. So for ICI purpose, ICI valuation purpose, we need to do this way only. And in case of CMA exams, CS exams, they have not specified like this. But CA Institute only taken this crazy view. What is that crazy view? So when we take freight, that freight is from exporter's factory till the place of importer. That should be taken. Okay, exporter's factory till the place of importer, that will be taken as the freight. But in case of CMA and CS exams, they will take freight means from the exporter's port to importer's port. So what will happen? I will tell you. The biggest problem is 20% when you are taking, 20% of FOB when you are taking, say revised FOB is $10,000. What is 20% of $10,000? $2,000 when you are taking. In this $2,000, whatever expenses that are already given is also merged into this. For example, so freight from, for example, it is given freight from exporter's factory freight from exporter's factory to port is say $150. Then this $150 is already there in that $2,000. Don't add that $150 again, because when you take $2,000, that $2,000 include this $150 also. Don't add that $150 again. Okay, you understood or not? So therefore, that is the point that you need to keep in mind. So, but this freight from exporter's factory to port $150 is part of FOB price already. Is part of FOB price. Because what is FOB price? Price prevailing at the exporter's port. So then this 150 will be already part of FOB. We need to take it part of FOB, because what is FOB price? Price prevailing at the exporter's port. Then what is the treatment we need to do? Simple part. So 20% of FOB, but this 150 already there in 10,000, correct or not? So then this 2,000 you take, 2,000 minus 150, 2,000 minus 150, 2,000 minus 150. How much will be taken as freight? The freight will be 1,850. This is the adjustment you need to do. What is the adjustment you need to do? That is, you calculate normally FOB. Don't change anything. What is FOB? Price prevailing at the exporter's port. You take. Whether freight from exporter's factory to port also will come in FOB? Yes. Whether loading charges in port also will come in FOB? Yes. Price prevailing at the exporter's port is FOB. You calculate normally FOB and you take the freight. What is the freight that you are taking? Actuals. No, don't worry. Dandanaka dancer. Don't worry. Leave it. We don't have to bear this torture at all. Okay. Answer super. Completed. Okay. Don't worry about this. This discussion not required. So this idiotic provision not required. Happy, be happy. But when it is 20% of FOB, the torture starts. What we need to do? Take FOB into 20%. How much it will be, you see? From that, you take out freight from exporter's factory to the load airport minus loading charges at the load airport. Ayya, please remember this point, okay? So, no other go. This will be tested. I am not lying. you refer to the study material, and if you refer to the study material, you will come to know all these points, okay, where you will read study material, okay, you will depend only on this that's it book and you will go for exam, okay. So please read the study material, then you will come to know. As you are not reading, you have to believe me. You believe me, no? Okay, so therefore, what is it we need to do? So regularly you do computation. First you need to take FOB given. First you need to take FOB given. For that FOB given, we need to add adjustments. We need to make some adjustments. After making some adjustments, we will get revised FOB. When we will get revised FOB, for that revised FOB, we need to take freight. And when you take freight actuals, and add insurance, so that is also actuals, leave it. You got CIF price, complete, answer complete, 5 out of 5, okay. Suppose if the freight is taken as 20% of FOB, if the freight is taken as 20% of FOB, then what we need to do? First take FOB given, and then add adjustments. In that adjustments, everything will come, because when you are making adjustments, keep in mind FOB means the price prevailing at exporter's port. FOB means the price prevailing at exporter's port. FOB means the price prevailing at exporter's port. So we need to make these adjustments. That is known as revised FOB. To this revised FOB, what we need to do? First we need to take freight. So that freight is taken as 20% of FOB, hold on, 20% of FOB minus, first calculate 20% of FOB minus freight from, two things will be excluded, freight from which place to which place? Freight from exporter's factory to load port means exporter's port, plus what is next? Loading charges at load port. These two should be excluded. Freight from exporter's factory to load port plus loading charges at the load port. These two should be excluded, and then you will be adding finally insurance, and we will be getting CIF price. Then also you will get 5 out of 5, okay. Follow this simple treatment. What is that simple treatment? When you take 20% of FOB, freight from exporter's factory to load port plus loading charges at the load port, these two things should be excluded from the 20%. Because these two things, why we are excluding? Because these two things are already part of what? FOB, revised FOB. These two are already part of revised FOB for that reason, okay. I don't know what you understood, but I have given this question in Mighty 51 question I have given. So in that again I will be applying it, so don't worry about this. So then one more adjustment we need to make, that is generally freight shall include handling charges but not at the place of import. If there is any unloading charges at the place of import, don't take it as a part of freight. Unloading charges in the Indian port means after importation anything should not come. Even unloading charges in India also should not come into the value. Then what about ship demurrage charges? Ship demurrage charges means the charges which are payable by the shipping company or the vessel for anchoring the ship at an outer place without bringing it to the port. They need to pay ship demurrage charges. That ship demurrage charges is before import or after import? Before import, so it should be part of freight. Then what about normal demurrage charges? Normal demurrage charges are payable by the importer for not clearing the goods within the time limit, that is 3 working days. So in that case, so there will be ship demurrage charges, but this ship demurrage charges will be, normal demurrage charges. Ship demurrage charges will be included, but normal demurrage charges will not be included, because normal demurrage charges are payable by the importer after import, unloading in the port. For not clearing the goods within time, they will pay that normal demurrage charges, that is post import. It should not come into the freight. So So what should come into the freight? Only ship demurrage charges should come into the freight. Then lighterage and bar charges. This lighterage and bar charges are for bringing the goods from the ship to the shore. For bringing the goods from ship to the shore, they will be levying some charges called as lighterage and bar charges. This lighterage and bar charges also will be included in the freight. Then, so that is charges for incurring the transportation goods from ship to shore. So now tell me, what are the adjustments you need to make to the freight? One last time I am telling concentrate. So you need to take the freight. So whenever you take the freight, this freight will not include, so freight from exporter's port to exporter's factory to exporter's port, or loading charges at exporter's port. Why? Because it is already taken in FOB. So when you take 20%, you need to deduct. When you take actuals, you take the actuals. When you take 20% only, you need to make this adjustment. That is one point. Then second, freight usually includes ship demurrage charges, but not the normal demurrage charges payable by the importer. Then next, number 2, freight includes lighterage and bar charges, that is for bringing the goods from the ship to the shore. Okay, these 3 points you need to remember. Then one more point, 4th point, unloading charges in the port will not be coming under freight, because that is post importation, that will not come. Then what are the adjustments to be made to the FOB price? First, commission we need to take. Commission will be divided into 2, buying commission, selling commission. Buying commission means commission paid for purchase. So who is buying? Importer is buying. Then that commission is paid to whom? Importer's agent. So definitely that will not come, because it is an expenditure of the importer. It will not come. Then export agent will be paid commission by the exporter. That will also not come, because it is his exporter's expenditure. But if exporter's agent commission paid by the importer, it will come. You understood or not? Suppose for your wife, if you are spending, no problem. If for someone's wife you are spending only, the problem will come. You understood or not? That is this. So commission paid to the exporter's agent paid by the importer to be included in the value. Then the other name for selling commission is local agent's commission. Why it is called as local agent's commission? Which agent is located in India? Exporter's agent is located in India. That's why it is called as local agent's commission. The moment when they give local agent's commission, don't get confused. It is nothing but the selling commission. Then second adjustment. So the first adjustment is selling commission paid by importer to the exporter's agent should be included in the value, because it's an indirect consideration to the exporter. Then next, number 2, material sent by the importer. So that is outside India, that person, that is one person is manufacturing outside India. We are the importer. We send some material here. Using that material, he is making the finished goods, and the finished goods we are bringing. So in that case, what is that we need to do? So whether that finished goods include the value of material sent free of cost? Yes. The value of material sent free of cost should be included either at actual cost or at apportioned cost. If it is raw material, actual cost. If it is capital goods, apportioned cost will be included. Then any other expenses recovered by exporter. So exporter is recovering any expenses when? Before import. Definitely it should be included in the value, any kind of expenses. So in which value all these inclusions should be made? In the FOB price. Then suppose if any expenditure is incurred by the exporter after import, whether it is as a condition of sale of import, yes, it is as a condition of sale of import, then it should be included. Example, installation charges is a condition of sale of import, so they need to incur that installation, so therefore it will be included. But customization charges is not as a condition of import, so therefore it is post import we pay for customizing, so that will not be included. So after import, as per importer's request, that should be excluded from the value. Clear pa? Then look into the next area, customs valuation rules. So customs valuation rules will be applicable in case where price is not sole consideration. So rule 3 says, first we need to take assessable value as the transaction value. Rule 3 says assessable value equals to transaction value, provided it is unrelated parties. So if the sale is between two unrelated parties, means so supplier and recipient should not be related. Same condition as in GST. price must be the sole consideration, same condition as in GST. Two more conditions, it should be unrestricted sale, unconditional sale, means exporter should not put any restrictions on the importer for sale, and exporter should not put any conditions for the sale of those imported goods. If these four conditions are satisfied and customs officer is not rejecting the declared value on the doubt of truth and accuracy, then only transaction value will be taken. What is the transaction value? In case of import, CIF price, again I am repeating. So assessable value equals to transaction value. The transaction value equals to CIF price. If total 5 conditions are satisfied, condition number 1, so supplier and recipient are not related. Condition number 2, price is the sole consideration. Condition number 3, no conditions put by the exporter for sale of these goods in India, and no restrictions put by the exporter for sale of these goods in India, and then customs officer is not rejecting the value declared on the grounds of truth and accuracy, then we will be taking transaction value as CIF price. Then suppose if value is, and we need to make adjustments, already we saw that adjustments. Suppose if this value is rejected by the officer, or if price is not sole consideration, or any case transaction value not applicable, then we need to apply the below rules. TISDCR. T is transaction value. If that fails, I. What is I? Identical goods. And yes, similar goods. D, deductive value. C, computed value. R, residual value. TISDCR. T for transaction value. If not, identical goods, value of identical goods. If that is also not, then similar goods. If that is also not there, then D, deductive value. DCR. C, computed value. R is residual value. Now, what does identical goods says? Identical goods means what? Identical goods. And who will determine this valuation? Importer or customs officer? Customs officer. Importer will not do. Who rejected the value? Customs officer. So he only should determine the value. So therefore, identical goods. How to take the identical goods? That identical goods are also imported goods having the same physical features and characteristics, produced in the same country and manufactured by the same person, but preferably, for example, you are importing a Samsung washing machine, front load. Now, LG front load washing machine will be coming under identical, yes, because produced by the same person preferably, but both should be imported from the same country, both should be having same physical characteristics, both should be front load, both should be with the same characteristics, same capacity, etc., and they should also be imported. Then we will be taking that as identical goods, and when we take it as identical goods, just 4 conditions only for identical goods, that should also be imported, same physical features, characteristics, same country, same producer preferably. Then once we take this identical goods, blindly we cannot take that as comparable value. We need to make 3 adjustments. We need to make adjustment with respect to difference in the quantity, difference in the transportation cost, difference in the commercial level of importation. So these 3 adjustments we need to make. So difference in the quantity, for example, we are importing 10,000 units and comparable is importing 15,000 units. Had he imported 10,000 units, what will be the value? Like that adjustment should be made. And number 2, difference in transportation cost. We are importing to Chennai port. The comparable is imported in Mumbai port. If that is imported in Chennai port, what could be the value? Like that we need to make the adjustment. Then difference in commercial level. We are importing from manufacturer. They are importing from a distributor. If they import from a manufacturer, what could be the value? That difference in adjustment should be made. And now we are getting more than one value. So then which value should be taken? The lowest of such value. So when multiple identical goods values are given, we need to take the lowest. Then in case of similar goods is also like, identical goods only, but in similar goods, they are imported goods, commercially interchangeable. Commercially interchangeable means for front load washing machine, top load washing machine could be a comparable, interchangeable. That is in similar. But in identical, for a front load washing machine, it should be another front load washing machine only. Produced in the same country, produced by the same person. Okay, preferably. So everything same except second point. So in identical goods, same physical features, characteristics. In similar goods, it is commercially interchangeable. And here we need to make extra one more adjustment. Difference in the materials and engineering work. And suppose if more than one value we got, we need to take lowest of such value. Then when above values are not possible, then we need to take either deductive value or computed value. Deductive value or computed value interchangeable, like in the sense like either we can go for first deductive value and then go for computed value, or computed value and then deductive value. So both follows a different approach. In computed value we follow top down approach. We take the raw material cost and we arrive at the price prevailing at the time of import. So we add all the production cost, etc., freight, etc., and we will arrive at the price at the time of import. This is top down approach, okay? Whereas bottom up approach is deductive value. We take the selling price in India, the price at which the imported goods are first sold. First sold means what? First level after importation, means not the retail sales. Take the level at which the importer subsequently sold. Take that resale price. From that resale price, eliminate all post exportation expenses. We will get the price prevailing at the time of importation. That should be taken. Deductive value, selling price of imported goods or similar goods to unrelated buyers minus post importation expenses including customs duty. The balance will be price prevailing at the time of importation. Whereas in computed value, we take the cost of production, profit and general expenses, freight and insurance. Then we arrive. That is rule 8. Then best judgment value means where the value will be determined by the officer, and using the principles of valuation you need to determine at the value. So that is known as best judgment value or residual value. Then what will be taken as the value in case of exports? Very simple. FOB price. Any adjustments? No adjustments. Just FOB price, whatever is given. Suppose if the FOB price is declared more, then the officer may reject the value, because lot of people will be inflating the FOB value for the purpose of export incentives. Due to that reason, officer will reject the value. When officer reject the value, so then in that case rules will be applicable. So rule 3 of customs valuation rule says assessable value equals to transaction value. Proper officer should satisfy that the declared value is genuine, and even if it is a related party, transaction value may be acceptable. So there are no conditions here. In case of import, we had conditions, but export there are no conditions. Even if it is a related party transaction, it will be taken as transaction value. But only thing, customs officer should not reject the value on the grounds of suspicion. Otherwise, whatever value we declare, that will be taken. Suppose if the customs officer rejected the value on account of inflation, that is we have overinflated the value, then what should be taken? Rule 4 says take the transaction value of like kind and quality. What is like kind and quality? So exported goods, they are imported goods, here exported goods, same physical features, quality, there also, here also, produced in the same country, there also, here also, produced by the same person, preferably, not compulsory. So same as identical goods, except that there it will be, in the context of imported goods, here it is in the context of exported goods, everything same. And 3 adjustments: difference in quantity, difference in transportation cost, difference in commercial level. If we get more than one price, what we need to do? Again, lowest should be taken. Thereafter we don't have similar, only this like kind and quality. Thereafter we don't have similar, directly it is computed value. Computed value is same, cost of production plus profit and general expenses, but no transportation cost, because we are taking FOB price. So no transportation cost. Then if that is also not applicable, then best judged value, where value determined by the customs officer. Then what is the valuation in case of import of second hand goods? So whenever second hand goods are being imported, usually valuation will be very difficult. For that, what is the procedure to be followed? So this is given in a circular. First, whether the overseas chartered engineer certificate is available. Yes, available. Then whatever value given by the overseas chartered engineer, that will be taken. Overseas chartered engineer certificate is not available. Then whether Indian chartered engineer certificate is given. Yes. Then compare that between the value declared by the importer and the depreciated value. So 3 values will be compared. What are the 3 values compared by the customs officer? Number 1, value declared by the importer, value as declared by the chartered engineer, and depreciated value. Between these 3 values, if everything is proper, that is there are no much deviation, so then they will take declared value itself. Suppose there is a huge deviation in that, so they will be asking the importer to give proper explanation, and importer gives the explanation satisfied by the department, so customs department, then also transaction value declared. Otherwise, so they will proceed to determination of value. But which value they will go? Basically rule 9, because 4 identical and all may not be second hand, identical, similar, all these things will not be there. So usually they go for residual value, but it is given as rule 4 to rule 9 should be applied. Okay. So that is with respect to this. And then segment 25, customs procedures. So we have seen up to valuation. Now in this customs procedures, 1 second. One second. Okay, I don't know how to rotate this page. Okay, fine, you see properly. I will explain from here itself. So there are total 11 steps involved in case of import procedure. First have a look into that import procedure. Total there are 11 steps. First, exporter will be receiving an order from the importer. So therefore exporter hand over the goods to the shipping company. That is step number 1. You please just follow the steps that is involved. So exporter will hand over the consignment to the shipping company, and the shipping company will be giving a document of title to the goods, that is known as bill of lading, and that bill of lading will be sent by the exporter to the importer. When they are sending it to the importer, then the importer is having the evidence that he is the owner of the goods, and then the shipping company will bring the goods to India, and the person in charge of the ship will be giving one document to the customs officer. Point number 4 you see, that is arrival manifest or import manifest and arrival report. So he will be submitting that report, and whenever he submits that report that contains the details of the goods which are present in the conveyance, then the customs officer will grant a entry inwards. Then the goods will be coming and it will be unloaded, and when it is unloaded, it will be unloaded under the supervision of a customs officer, under the custody of a custodian. Custodian is not a customs officer. Custodian is a officer of port trust authorities or airport authority of India. So he will be there, and under the control of custodian the goods will be deposited. So thereafter what importer should do, with that the person in charge role is over. Now importer will be filing a bill of entry and will be paying the customs duty, or he will file a bill of entry for warehousing. Suppose if he pays the customs duty, then customs officer will pass out of customs charge order. After this out of customs charge order, the importer should also obtain delivery order. This delivery order will be obtained by from the custodian. So that is not from the custodian, from the person in charge. So therefore importer should submit the bill of lading with the person in charge. Person in charge will give the delivery order. Now this delivery order and out of customs charge order will be going and submitted to this port trust authorities, that is custodian. When it is submitted, so on seeing out of customs charge order, it is clear that this person has paid the customs duty. By seeing the delivery order, it is clear that these goods belongs to him. So therefore they will release the goods and this person will take those goods. So this is the import procedure to be followed by importer, person in charge, exporter and customs officer. These are the various steps that are involved. In case of airways, wherever bill of lading is there, it will be replaced by airway bill. And in case of vehicle, wherever this bill of lading is there, it will be replaced by lorry receipt or railway receipt. And then in case of grant of entry inwards, for aircraft and vehicle, it is not for entry but for unloading the goods, but goods can be unloaded only after grant of entry inwards. And in case of import manifest, aircraft, it will become arrival manifest. In case of vehicle, it will become import report. So those are the changes that I have given below, notes to above. All the import and export procedures or customs are through customs common portal. What is that customs common portal? icegate.gov.in. In case of import by aircraft, so So this 2, 3 and 9 replaced with airway bill. So the 2, 3, 9 means what? Bill of lading, etc. So bill of lading comes in 3 places na, that will be replaced with airway bill. In case of vehicle, that is replaced with lorry receipt or railway receipt. In case of aircraft and vehicle, grant of entry inwards not required, but arrival is required for unloading of goods. Then what are the complaints to be followed by person in charge? Person in charge is, already we have seen, master of vessel in case of vessel, and in case of aircraft, pilot, driver in case of vehicle. So they need to come only at the approved place only, that is to the port, customs port or customs airport and land customs station. So that should be the place of arrival, and they need to file import manifest, arrival manifest or import report. When they need to file import manifest and arrival manifest should be filed before the date of arrival, whereas import report should be filed within 12 hours after arrival. If there is any belated filing, the penalty will be 50,000. In all cases in customs, the general penalty is only applicable for our exam, but there are other penalties that is not for our exam. So wherever you see customs penalty, it will be 50,000. Okay. So therefore, for belated filing, penalty up to 50,000. And what is the mode by which they need to file import manifest, arrival manifest? Electronic only. But in case of vehicle, it is manual. Then they need to file passenger name record information along with import manifest, import report or arrival manifest, because you know who are all the people that who are all coming into that aircraft, coming through that aircraft or coming into that vessel along with the goods. So the passenger details also should be submitted. In case of imports by vessel, goods can be unloaded only after obtaining grant of entry inwards, and goods go into the custody of custodian, and custodian shall ensure safe custody. And suppose in case of pilferage means petty theft, who will be responsible for payment of customs duty? Custodian will be liable to pay the duty. And then only those goods which are mentioned in the import manifest, arrival manifest or import report, those goods only should be unloaded, and it should be unloaded only at the approved place, and it should be unloaded under the supervision of proper officer. Suppose for unloading, if small boats are required, so then that good should be accompanying a boat known. Otherwise, under the guise of smuggled goods, so they may think, coastal guard may think, and they may take over those goods. So these goods which are coming in the waters from the ship to the shore should accompany a boat known, which is given by the customs officer. Suppose if the unloading happens on holidays, so they need to pay extra charges called as merchant overtime charges. These are the 10 points to be followed by person in charge. And what is the complaints to be followed by importer? Imported goods unloaded shall remain in the custody of the custodian, who shall be responsible for imported goods till clearance. Suppose if it is pilfered, such custodian shall pay customs duty, already we have seen. And we will be filing one bill of entry. What is that bill of entry? So there are 3 bill of entries: bill of entry for home consumption, bill of entry for warehousing, and export bill of entry. This is for import of goods which are to be cleared on payment of duty. This is for storing of goods in the warehouse. This is for clearance of goods from the warehouse upon payment of duty. What is the time limit for filing bill of entry? Minimum before the date of arrival, maximum 30 days prior to the date of arrival, which means that we file a bill of entry, 30 days over, the bill expires, again we need to file a fresh bill of entry if the vehicle does not arrive. So if the vehicle or vessel does not arrive within 30 days of filing bill of entry, a fresh bill of entry shall be filed. What is the late fee for delay in filing bill of entry? So the late fee will be for everyday delay 5,000 rupees if the delay is up to 3 days. If the delay is beyond 3 days, for 3 days it is 5,000 per day, and thereafter it will be 10,000 per day. But what is the maximum amount of late fee payable? If it is exempted goods, 50,000 penalty 50,000. Okay. So maximum 50,000. If it is other than exempted goods, that is dutiable goods, then it will be 100% of the duty payable. That is the late fee. And pay customs duty after filing bill of entry for home consumption, and customs officer will pass out of customs charge order. Suppose if the goods are not cleared within 30 days after unloading, so then the customs department may either dispose of the goods or may keep in the goods for a period of 30 days. For every 30 days they will do a review whether to dispose it off or to retain it in the warehouse for next 30 days. So therefore they will be, if they are disposing of the goods are gone, and they will be giving you only the money realized after deducting all the expenses. Suppose if they are keeping the goods in the warehouse, then you can file a bill of entry and you can do the clearances, but you need to pay the late fee and other charges. So this is about import procedures and export procedures. These export procedures will be simple only. First, exporter will be filing shipping bill or bill of export. In case of aircraft and vessel, it is shipping bill. In case of vehicle, it is bill of export to the customs officer. Customs officer will verify the shipping bill and will be passing let export order. Exporter will be submitting the shipping bill or bill of export to the person in charge, and person in charge will be obtaining grant of entry outwards and will be loading the goods into the ship. In case of baggage, it can be loaded without the permission, and person in charge will be submitting what are the goods that are present in that vessel. So that is by way of export manifest. And what are the compliances to be followed by person in charge? Same point. Goods should be loaded only at approved place. They are unloaded at approved place, and they are unloaded under the supervision of officer. Here loaded under the supervision of officer. So loading with the help of small boats, no need of boat note. Their boat note was required because it is coming from outside India to India. Whereas in this case it is going from India to outside India. So already there is shipping bill. So boat note not required. Loading on holidays and after office hours, same. Merchant overtime charges payable, and shall obtain entry outwards from the customs officer before loading the goods. But that is only in case of vessel, not in case of aircraft or vehicle, only in case of vessel. Shall file export manifest, departure manifest or export report for the details of goods that are present in the conveyance. And they also will file passenger name record information and shall obtain permission to leave India. What is the compliance to be followed by exporter? Simple, they will file shipping bill or bill of export, and they will assess and pay customs duty if applicable, and shall pay duty, and shall obtain late export order. So we don't have that much of customs procedures in case of export, but import lot of points are there because exports are liberal in India. Then transit and transshipment of goods. Transit means goods are coming to one port, thereafter the same ship is taking the goods to another port. In this case, the transit freight and insurance should be included in the value. For example, 10,000 units came to one port, and in that 6,000 units are unloaded. Remaining 4,000 units are taken to another port. Now there is a transit freight and insurance. The transit freight and insurance is included in that 4,000 units. Whereas in case of transshipment, another ship will come. So one ship they import and they will be unloading into another vessel or aircraft. In that case, that another vessel or aircraft will have some cost, freight cost, that will not be included in the value. So remember, transit freight and insurance included in value. Transshipment, so not included in value. Included in value, and transshipment freight and cost not included in value. Not included in value. Okay. And for transit, so there no need of any bill or declaration. But for transshipment, a bill of transshipment or declaration of transshipment is required. And continuity in records, yes, it will be there. Transit goods, all the records will be continuing. But transshipment, as the vessel changes, aircraft changes, there won't be any continuity of records. And they need to submit the details of all goods which they are bringing into the first port or airport as well as to the subsequent port or airport. And this point already I gave, this is the important point. So transit freight and cost shall be part of freight in CIF value. This transshipment shall not be part of freight in CIF value. Then next, in case of import or export by post, what should be taken as the relevant date for determination of rate of duty that is given? So if it is import by vessel, generally import by vessel, what is the relevant date? Date of presentation of bill of entry or grant of entry inwards, whichever is later. But in this case, date on which postal authority present the list to proper officer, or date of arrival of vessel, whichever is later. Their bill of entry, here parcel list, okay, and their grant of entry inwards, here date of arrival of vessel, whichever is later. In case of aircraft, generally what is the relevant date for determination of rate of duty? Date of presentation of bill of entry or no, date of arrival, whichever is later. Aircraft, date of arrival, whichever is later. But here we don't have date of arrival, it is the date on which parcel list is submitted, okay. Date on which postal authority submit the parcel list to proper officer. In case of export, what is the relevant date? Let export order for general. But in case of post, it is the date on which exporter delivers the goods to the postal authorities. Now whatever we discuss is equally applicable for courier also. Only thing, postal authority is replaced with courier agency. Remaining provisions are same. Then faceless assessment under customs. Here what happens is that now under faceless assessments, first importer will be filing a bill of entry, and this bill of entry will not be assessed by only the jurisdictional customs officer. So the risk management system will be allocating it to different customs officers, and the customs officers will do the verification, and they will be uploading customs compliance verification. If everything is proper, so they will be immediately giving that clearance for bill of entry. Otherwise they will be rejecting the bill of entry by specifying the reason for rejection. Again they need to modify and they need to submit the revised bill of entry. So now the faceless assessment wherein, so the officer is not necessarily the jurisdiction officer, he can be anywhere in India. Okay. So bill of entry that is identified scrutiny is assigned to the assessing officer who is physically located in a custom station which is not the port of import in the customs automated system. It separates the assessment from physical location of the port. From importer's perspective there is no change, only thing back end what happens only is what we are discussing. Then section 37 says that customs officer at any time board any conveyance carrying imported or exported goods and may remain in such conveyance for such period as he considers necessary. And section 38, he can ask any questions to the person in charge, and the person in charge should respond to that and should submit any documents which are asked. That is 37 and 38. Then we have section 51A and 51B which talks about electronic duty credit ledger and electronic cash ledger. So just like GST, they have brought in electronic cash ledger and electronic duty credit ledger concept even in customs. In electronic cash ledger, so whatever amount that is deposited for payment of duty, that will be credited into this ledger, and now that balance can be used for payment of customs duties, interest and penalty, and any balance unutilized we can claim as a refund. So same, ditto, this part is same as even GST. Whereas electronic credit ledger what will come? Any refund that we are claiming or any incentives, there is something called as duty drawback or some incentives under foreign trade policy that will come into this electronic duty credit ledger. So there is no cash outflow to the government, that is the advantage. So we need to get the refund. So that refund they will put into duty credit ledger. Now what you will use the duty credit ledger for payment of customs duty. So which means that, so there is no cash outflow for the government. So this is an amazing creation of Chechi. Okay. So balance in the ledger can be used for payment of customs duties only. That too, you know which customs duty? Basic customs duty only we can use. And unutilized balance, so cannot be claimed as refund. Then what we can do? We can transfer it to any other person. Okay. So that is this electronic duty credit ledger, but so far it is not effective. So far it is not effective. Section is there, regulations are there, but not yet effective. They deferred till 30th November 2022. So therefore it is doubtful as to whether this concept will be tested in the exam or not. If at all they are testing, they will test up to this only. If at all they are testing, they will test up to this only. They will not be testing beyond this. But in your amendments material, they have given this electronic cash ledger regulations and electronic duty credit ledger regulations, because up to 30th April 2022, so it was made applicable from 30th April before itself, it was made applicable 30th April 2022. But at a later point of time, they gave a notification deferring these provisions. So that notification ICAI has missed. So logically, they should not be asking questions on this electronic cash ledger regulations and electronic duty credit ledger regulations. Okay, trust me. So it will never be asked. Suppose if it is asked, don't worry, I will definitely fight, ensuring that because of the notification, because there is a evidence that it has been deferred. When it is deferred, how this can be tested? Okay, but we cannot mess with ICAI. We will discuss, nothing wrong in that. Okay. So electronic cash ledger regulations, see this. So electronic cash ledger regulations 2022. So form ECL 1, electronic cash ledger. Form ECL 2, challan for deposit, where we had payment challan, na PMT 6, like that we had a payment challan. ECL 3, challan for payment of any sum, that is there is no electronic liability ledger. In the cash ledger itself, payment of liability is a part. So challan for payment of any sum under Customs Act, electronic duty payment ledger. So payment ledger is part of cash ledger itself, okay, in customs. Then application for refund of deposit under cash ledger, okay. So these are the forms, but these forms no need to remember. So just I have given you for clarity purpose, because this was not given in amendments material. Form numbers they have not given. Then this information is given. So deposit made in cash ledger shall not accrue any interest. Yes, there won't be any interest on that. You can keep it for 10 years, 20 years also, they will not pay any interest. Deposit challan is valid for a period of 15 days. This point is same in GST also. In GST also, this payment challan, once it is prepared, it will be valid for a period of 15 days. And what are the modes of deposit? There also net banking, NEFT, RTGS, over the counter up to 10,000 in a tax period, here in a day. Then OTC limit of 10,000 shall not be applicable to government department. They are also same. Or upon authorization of customs officer. Suppose if customs officer permits, then we can deposit. But like that we don't have provision in GST. Then commission or charges payable for deposit shall be borne by the person making deposit. That's true. So whenever we make a NEFT RTGS transfer, the person who is making the transfer only should bear the charges, na? That's normal. Upon successful payment of challan, a SIN shall be generated. That is, challan identification number is generated. And what is the purpose for which we can use the cash ledger balance? For duty, interest, penalty, fee, or any other amount payable under Customs Act or Customs Tariff Act. So balance can be claimed as refund. So there is no restriction we can get. Up to this, everything same except for this 10,000 in a day, and customs officer can permit for deposit of goods, the deposit of more than 10,000 rupees in a day. Except this, everything is same as GST. Then provisions of 51A is not applicable in the following cases. In case where there is a port or airport where the automated system is not in place, still not in place, so then manually only they are doing, then in that case this electronic cash ledger regulations not applicable. Accompanied baggage, that is a person who is bringing the baggage, you cannot ask him to log in into the portal and make the payment, he can directly make a deposit there. So therefore accompanied baggage. Making payment other than duties under customs, sir, you can use it for payment of customs duties or any other amount payable under Customs Act. Then what is this other than duties under customs means? That is, we have something called as demurrage charges, which is payable to port trust authorities, ship demurrage charges, So these charges and all, and then for custodian we need to pay some charges, custodian charges. All these charges are not under Customs Act, but payable by the importer. For payment of that charges, normally only it should be paid. We cannot use the cash ledger for payment of that. Then electronic duty credit ledger regulations, which says that a shipping bill or bill of entry presented and having a claim of duty credit shall be processed, and this once it is processed, so the amount will be credited into the credit ledger. So by way of e-script, the duty credit available in the e-script shall be used for payment of duties of customs specified in first schedule. Means, so the balance in this can be used only for payment of basic customs duty. Even social welfare surcharge we cannot use, IGST we cannot use. The duty credit ledger will be used only for payment of basic customs duty. And once we generate a e-script, that is, once the balance is there in the credit ledger, we need to prepare a scripts. Okay, so that e-script is valid for a period of 1 year from the date of its creation in the ledger, and any duty credit in the said script remain utilized at the end of the period shall be lapsed. So therefore, whatever benefit that is there in the credit ledger, directly we cannot debit. So we need to generate a credit script. That credit script needs to be entered at the time of filing bill of entry. So therefore, whatever credit script that is generated, just like coupons or vouchers, like that we need to generate, and that every credit script generated, one number will be there. At the time of filing bill of entry, against payment of duty, this number we need to put. The moment when we put that number, to that extent it will be debited. Still there is some unutilized balance, we can still use it, but for 1 year only. Within 1 year only it can be used. See how many restrictions. Further, duty credit in the e-script has lapsed shall not be regenerated, and the ledger including e-script and the transaction shall be visible in the customs automated system. Transfer of duty credit in e-script. Suppose I don't have customs duty payment at all, then I can generate the e-scripts and I can transfer that e-scripts to another person. Okay. So from the ledger of a person to ledger of another person who is a holder of IEC number, the duty credit available in the e-script shall be transferred at a time for the entire amount in the said e-script to another person, and transfer the duty credit in part shall not be permitted, which means once a e-script is generated for 1 lakh, see e-script means simple for example 20 lakhs is there, 20 lakhs is there means I can generate 20 e-scripts, or I can generate 4 e-scripts for 5 lakhs, you understood or not, it is up to me. Whenever I am generating a e-script, that amount fully can be transferred to another person, but not part transfer. But partly can we use it for payment of customs duty? Yes, in part we can use it for payment of customs duty. So complicated procedure na, that's why they have, many importers have requested, we did not understand what it is, please defer it for some time. Right now economy is not in a good position, so if we do all these things, then we will be smuggling, then we will not pay customs duty. Okay, wait, we will defer it and we will put it later, like that they deferred. Then look into the next area, import of goods at concessional rate of duty. It's over part, just this much only, 2 pages only, see this. Import of goods at concessional rate of duty rules. Listen, concentrate. Here there is a small correction that is required. First of all, we will see when it is applicable. It is applicable in a case where a person is eligible to import goods without payment of duty or at concessional rate of duty. For that purpose, these rules will be applicable. Okay. Now, what that importer should do? Say that importer is located in Coimbatore. He is eligible to manufacture some specified goods or eligible to provide some specified services. For that only he can import goods without payment of customs duty. And now what he need to do? Previously, he was required to submit information to his ACDC. Now that is replaced with ICE gate portal. So to the portal he need to submit the information. To portal he need to submit the information. This 2 copies is not applicable. This 2 copies is not applicable. Now he need to submit the information to the portal. ACDC not required. Now previously 1 copy was forwarded to the ACDC of customs, that is not required, but instead this portal will be giving him 1 number. Okay, 1 identification number. 1 number will be given. So the second step will be, so import identification number, 1 IIN will be provided. Import identification number. Import identification number. So this number IIN will be provided to the importer, remaining and all same. So therefore first, so he will be submitting the information plus bond with ICE gate. After submitting the information plus bond with ICE gate, that the ICE gate will be giving him import identification number IIN. Now what this importer has to do? This IIN he need to mention at the time of import. So say the import is happening in Chennai port. When he mention IIN in the bill of entry, so which means the goods will be cleared without payment of duty or at concessional rate of duty, he can bring it to his place. Clear or not? And then within that 2 days of 2 working days of receipt, he need to give a intimation. So that is also now relaxed. This is also not applicable. So therefore, just there are 3 steps. There are 3 steps now. What are the 3 steps now? So that is he need to submit a information. So in the portal, which portal? ICE gate portal. Once he submit the information in the portal, so 1 IIN will be generated. So that IIN should be mentioned in the bill of entry at the time of import, so that the goods can be brought to his place without payment of any customs duty or at concessional rate of duty. Now what he need to do with those goods? He need to use that goods for the specified purpose. For what purpose he is importing, for that purpose he need to use that. Any unutilized goods, that unutilized imported goods, unutilized or defective imported goods, either he need to export without payment of customs duty, brought it, send it back, no issue, or sell it in India and you need to pay customs duty along with interest. Means at the time of import, how much ever customs duty you were supposed to pay, that much customs duty you need to pay now along with interest. So interest is calculated at what rate? 15% per annum. From when it will be computed? From the date of import till the date you are making the payment. Why? Sir, this goods, when you imported, you did not import without payment, with payment of customs duty. You imported without payment of customs duty. You enjoyed the benefit. Now you pay back that benefit along with interest at the rate of 15% per annum. From the date of import till the date of payment. Okay. What are the information to be submitted? Name and address of the importer and his job worker, goods produced or process undertaken, nature and description of the imported goods used in above, nature of output service rendered using imported goods. So that details should be submitted. And what is the maximum period? So can they get the goods done on job work basis? Yes, but job work is not allowed in jewelry. But any other sector it is allowed, which means they can import the goods. They may not manufacture, they can get it done on a job work basis. But what is the time period for which maximum it can be sent on job work? 6 months. Can the capital goods also be imported under these rules? Yes, but there is no time limit of 6 months for capital goods. Capital goods they can import and they can use it for manufacture purposes. And whenever they are disposing of the capital goods in India, after import, as they imported without payment of customs duty, when they sell in India after import, then on depreciated value they need to pay customs duty. What is the depreciated value? Please see there. So this depreciation rates you need to remember: 4, 3, 2.5 to 4% for every quarter or part thereof in the first year, and 3 for every quarter or part thereof in the second and third year, and then 2.5 for every quarter or part thereof in the fourth and fifth year, and thereafter for every quarter or part thereof it will be 2%. So when it will become 0? When it will become 0? For example, first year 16%, correct? And second year it will be 12, third year 12, and fourth year it will be 10, fifth year it will be 10, and by the time by fifth year 60% over. So remaining 40%. So 1 year 8%. So then it will be 5 years. So 10 years. So literally 10 years. Suppose if you are importing the capital goods, using it for 10 years, and thereafter you are selling, are you required to pay any customs duty and interest? No. If you are selling for less than 10 years, this should be the depreciated value like this. That is original value minus this. This is reduction. This 4%, 3%, 2.5 and all is reduction. So on the remaining value, customs duty should be computed and interest should be computed. When the unutilized or defective goods should be exported or sold within 6 months from the date of import, but this is not applicable for capital goods. What are the other compliances? They need to file a quarterly return within 10th of the month following every quarter. And who is eligible for this? A manufacturer or service provider is eligible for import of goods without payment of duty or at concessional rate, and that can be used in manufacture of notified goods or rendering notified service, but not for after sale service. Such manufacture can be done by the importer or they can get it done on a job work basis. However, for some sector, job work not allowed, that is gold, jewelry, precious stones. Okay, so this import of goods at concessional rate of duty rules. So please revise it once definitely before exam. Very important. Mark it as important because these rules got amended multiple times in the recent past 1 year. So they have amended it multiple times. So and that to May 22 exam it was amended. From May 22 to November 22 again they have amended. So due to that reason, so this rules was not tested in May 22. So chances are there for November 22 exam. So we completed 5 segments, okay, and we'll take a break 15 minutes. Thereafter we have remaining, that is exemptions, duty drawback, baggage, warehousing, foreign trade policy. So that we will quickly complete, okay. And you will be receiving one handout. So already for online students, YouTube free, I have uploaded free. That is in download section, it is there, morning I said. And as you paid, so something I need to give you na. So therefore that 50 questions material you please collect, and that 50 questions today, once this customs portion is over, because today's class is up to 7 o'clock. I started at 10 o'clock, 7 o'clock, and suppose if I am not able to, definitely I will not be able to complete 50. In that 50 questions already 15 questions. So YouTube is there and I have given the QR code in that. Okay. So remaining 35 questions I will discuss. If I am not able to do that, don't worry. I will definitely do it tomorrow morning itself, because day after tomorrow only I am leaving. So tomorrow I will be in Chennai only. Tomorrow morning also I will put it in YouTube. You can watch that. But what I suggest is that you solve those questions and then watch the YouTube, so that you will be knowing as to what extent you are able to solve, what are the mistakes that you have done. Okay, please do that. So today whatever time available, some questions we will definitely do in the class. Okay, fine. Okay, we'll start. See this, exemptions under customs. As per section 25, like section 11 of CGST Act, section 25 of Customs Act, central government is having power to grant the exemption with respect to goods from payment of duty either unconditionally or subject to certain conditions. There could be unconditional exemptions, which means that those goods imported or exported will be exempted, that is unconditional exemption, or they can also give conditional exemption, that is only when certain conditions are satisfied that the goods are exempted. So like that section 25 gives power to central, like central government has power as per section 25 of Customs Act to grant the exemptions. Then apart from this, these are like specific exemptions with respect to specific goods and imported, exported they will give. Apart from that, there are some general exemptions. Those general exemptions are given in multiple sections. The first set of sections are section 13 to section 22. Section 13 says that if goods are pilfered, then no need to pay customs duty. What is the meaning of pilferage? That refers to petty theft. Whereas section 23 subsection 2 talks about relinquishment of title to the goods if the goods are not conforming to the specifications. Then section 23 subsection 1, remission of duty, that is if the imported goods are lost, destroyed or abandoned, so then in that case we will get the benefit of remission of duty. And if the imported goods are damaged or deteriorated, so then in that case we will get the benefit of abatement. So when the goods are pilfered, so no duty payable on pilfered goods, section 13 is applicable. Goods not conforming to the specifications, relinquishment of title, section 23 subsection 2. Goods lost or destroyed, remission of duty, section 23 subsection 1. Damage or deterioration with respect to the goods, section 22, abatement is applicable. Okay, so these are the 4 sections. Then what is the benefit in case of section 13 pilferage? No need to pay the duty, but what is the benefit in case of 13 is no duty payable, but 23 subsection 2, so also no duty payable, because when you relinquish the title to the goods, which means that you are not having the title over the goods, then no need to pay the customs duty. But what is the benefit in case of remission? First pay customs duty, then prove that the goods are destroyed or abandoned, then get the refund of the customs duty paid. Whereas in case of abatement, proportionate customs duty payable. What is this proportionate customs duty that is payable? Say for example, if the value of imported goods, is 1800 lakhs, the value of imported goods, and the customs duty payable on such goods, is say for example 485 lakhs. 485 lakhs is the customs duty payable. So now what we need to do is that we need to first see what is the value of imported goods before damage, 485 lakhs. So for 1800 lakhs we are paying 485. What is the value of the goods after damage? So the after damage the value of the goods is only 1200. Then what is the proportionate customs duty payable? So cross multiplication we need to do. So 1200 into 485 divided by 1800. So therefore 323.33 lakhs is what we need to pay. So therefore how much is the abatement in this case? So the abatement is, we were required to pay 485 but we are paying 323.33. So that difference will be called as abatement, that is 161.67 lakhs will be taken as the abatement. So we need to pay customs duty on the proportionate value after damage. So based on that we need to pay, that is this. Then so in case of pilferage, suppose if the goods are restored, whether the importer has to pay the customs duty? Yes. Until that point of time, who paid the customs duty? Custodian has paid the customs duty. Then in case of relinquishment, is relinquishment possible with respect to prohibited goods? No, not possible with respect to prohibited goods. Then we don't have any special points in case of this remission of duty, but abatement, already I told you how to calculate the abatement. Then whether it is applicable in case of warehoused goods, pilferage is applicable for warehoused goods? No. Whether relinquishment of title is applicable for warehoused goods? No. But we have a separate section for relinquishment of title for warehoused goods, that is given under warehousing provisions, proviso to section 68. But in case of 23 subsection 2, so this relinquishment of title is not applicable in case of warehoused goods. Then But the other two sections are applicable in case of warehoused goods, that is in case of remission of duty with respect to goods destroyed in warehouse possible, whereas abatement also possible in case of warehoused goods, but remember only on account of damage but not on account of deterioration. Suppose if it is on account of deterioration, then no, so that is not possible. So which means when there should be pilferage or relinquishment of title before order for clearance. So that connecting chart only I gave above. So first the goods are unloaded in the port or airport. Thereafter an order for clearance is made. Thereafter either it is taken for warehouse or for home consumption. If it is taken for warehouse, from warehouse it is cleared for home consumption at a later point of time. If we need to get the benefit of section 13, that should be before order for clearance. That is, pilferage should be before order for clearance. Relinquishment of title should be before order for clearance. But even the other two sections also applicable before order for clearance? Of course, yes, because the other two sections are applicable anytime before actual clearance, okay, which means that before order for clearance, all the four sections are applicable. After order for clearance and before actual clearance, means warehoused goods, only two sections are applicable, that is section 23 subsection 1 and section 22. That is what you need to remember. Then section 21 talks about derelict, jetsam, flotsam. Derelict refers to goods that got derailed, the ship got derailed and the goods were thrown into the water, that is derelict. Jetsam, so in order to save the ship from sinking, goods will be thrown into the water, that is jetsam. And flotsam, in whatever goods that are thrown into the water either because of derelict or because of jetsam, so that continue floating, that is known as flotsam. And wreck refers to the damaged parts of the ship. If these goods are brought into India, any person is bringing into India, they need to pay customs duty on these goods as if they are brought into India, imported into India, unless they are entitled to be admitted duty free, customs duty payable, that is section 21. And then section 20 talks about re-importation of goods and the benefits available in that case. So there are two notifications that we need to remember in this regard. Notification 45 2017 and notification 60 of 2018. So these are the two notifications, 45 2017 and 60 of 2018. What does 45 of 2017 says? First, the goods are imported originally. At the time of import, we would have paid customs duty, and these imported goods are exported. For what purpose it is exported? Any purpose it is exported. Now, upon export, are we claiming any incentive? Yes, we are claiming incentive. Then upon re-import, pay back that incentive. So we don't have to pay anything else. We don't have to pay customs duty. For example, so we imported some goods, raw material, and we exported because they are defectives or any reason we exported. When we exported, imported goods exported, there is something called as duty drawback. When imported goods are exported as such without use or after use, we will be getting duty drawback as an incentive. So again, at the time when you are bringing it back, whatever duty drawback we have claimed at the time of export, that much if you pay, that will be sufficient. Beyond that, we don't have to pay anything. We don't have to pay customs duty on the goods as if it was imported for the first time, because it is already imported and it was exported and again it is coming back. So if you have claimed any incentive, that incentive alone you need to pay. Whereas if you are importing a car and you are exporting it for repairs, and after export for repairs, after repairs when you are bringing it back, again no need to pay full customs duty on the car, but on the fair value of repairs plus freight and insurance, both ways we need to pay customs duty. What is this fair value of the repairs? Whatever is the material cost and the labor cost, even though we are not making payment of that, we need to take that as the value, because they use the word fair value. When the goods are covered under warranty, the repairs will be done free. So in that case, we need to ascertain what is the fair value of that repairs plus freight and insurance, both ways, that should be taken as a value. On that we need to pay customs duty at the time of re-import. Otherwise, like suppose if this concession is not there, what would have happened? We would have paid customs duty on the full value of the goods as if it is imported for the first time. So that's how section 20 says. So this concession reduces that customs duty payable upon re-importation. And in this case, when this benefit will be applicable, when this notification 45 2017 will be applicable, provided the goods are imported, re-imported from the date of export within 3 years, plus it can be extended for a further period of 2 years. By this time the goods should have been re-imported, then only this concession will be applicable. And whether IGST is also payable on fair value of repairs plus freight and insurance both ways, yes, fully. The total customs duty will be payable the same way. Suppose if export is subject to export duty, means at the time of export we are paying any export duty under section 26. It says that upon re-import, whatever duty you paid at the time of export, we will get it as a refund. Again I am repeating, this is the first point, that is you are exporting, you got an incentive. Upon re-import, pay back that incentive. Number 2, at the time of export, you are exporting for repairs. When you are exporting for repairs, you will not claim any kind of incentive. Reason being, exports for the purpose of sales only eligible for incentive. Exports for repairs means you are going to bring it back. You will not get any incentive. You did not claim any incentive, but it is sent for repairs. When you are bringing it back, just pay customs duty on fair value of repairs, freight and insurance both ways. Suppose at the time of export, you paid customs duty. You paid customs duty at the time of export. So then upon re-importation, whatever customs duty you paid on export, that you will get as a refund in terms of section 26. So there is a connecting point to refunds under section 26. Then if goods are exported under duty exemption scheme, that is advance authorization, DFIA, EPCG, like the different schemes, upon re-importation, IGST and compensation cess payable, and the time limit for re-import is only 1 year plus 1 year in that case. Suppose if we are exporting under normal duty drawback, at the time of re-import, payback duty drawback. Suppose we are exporting under duty exemption scheme. Duty exemption scheme means what? So that is we are importing goods without payment of customs duty. We exported it back, again re-importing. Then in that case, IGST and GST compensation cess is only payable at the time of re-import. If goods are exported and are not subject to any incentive or exemption and not exported for repairs, then upon re-import, customs duty not payable. Neither you claimed any incentive nor it is for repairs, means we don't have any provision. So at the time of re-importation, no need to pay. Exported and imported goods must be same, and the ownership also should not have been changed. That is another condition. So tell me what are the 3 conditions for the purpose of getting this benefit. Number 1, so the exported and imported goods should be same, and the owner at the time of export and import should be same, and the re-import should be within the prescribed time limit. What is it prescribed time limit? 3 years plus 2 years. But if the goods are exported under advance authorization or any duty exemption scheme, 1 year plus 1 year. And concessions under this notification is not applicable to EOU or unit in free trade zone, public or private warehouse, tobacco and petroleum products. In that case, these concessions are not applicable. Means whenever it is re-imported, so normally whatever is the import treatment, that will only be applicable. Next, if the goods are taken outside for exhibition, upon bringing back within 6 months from the date of export, customs duty not payable. Okay, beyond 6 months, if it is brought back already at the time of export, that is after expiry of 6 months, it was considered as sale. As it was considered as sale, now this is a connection between GST and customs. In GST there is a connection which says that section 31 subsection 7, if the goods are exported for exhibition and if it is not returned within 6 months, section 31 subsection 7 says that it is deemed to be supplied. So which means it is treated as export. Now when you are bringing it back after 6 months, so this section 20 concessions will be applicable. Within 6 months when you are bringing back, first of all it was not considered as export, so therefore it will never be treated as re-import. Okay, that is the connection here. Then next, notification 60/2018 is reverse. First we are exporting the goods and thereafter we are importing it back, and again we are re-exporting. Upon import, no need to pay customs duty. Okay, upon import, no need to pay customs duty. That is, goods manufactured in India are sent abroad and we are bringing it back. For what purpose we are bringing it back? Either for doing reprocessing, refining or remaking, or repairs or reconditioning. If you are bringing back for repairs, remaking or reconditioning, first, so reprocessing, refining or remaking, you should have brought back within 1 year. This reprocessing, refining, remaking arises on account of manufacturing defects. Manufacturing defects are noticeable within 1 year. So bring it back to rectify the defects. Once you rectify the defects, within 6 months plus extended time limit, you re-export it back. so that at the time of import no need to pay customs duty. Suppose for repairs or reconditioning is not manufacturing defects, so these are arising out of usage, so that's why you have to give reasonable time to use it. So therefore when you need to bring it back within 7 years, and in case of notified goods it will be 7 years, other than notified goods 3 years. Okay, that is the time limit which is given to bring it back for repairs, and for Nepal and Bhutan all cases it will be 10 years. So this is the time limit they can bring it to India for the purpose of doing repairs. Once the repair is done, it should be sent back within 6 months or plus extended time limit of 6 months. And here the imported goods and the exported goods should be same, and importer at the time of import executes a bond that these goods will be exported within 6 months or further extended time limit of 6 months. Otherwise whatever benefit they got, that is they did not pay duty at the time of import, that they need to pay along with interest. Okay. Now customs duty not payable at the time of import provided goods are re-exported within the stipulated time as above and conditions are fulfilled. And what are these notified goods? Certain machineries, computers and color TV. Now, so in case of this export to import, if there is any reduced quantity, we exported 10,000 kgs, we brought 9,500 kgs, we exported 10,000 kgs and we brought back 9,500 kgs. In that case also concession available? Yes. 9,500 kgs we imported and we have done the process. So we have exported 9,200 kgs. Then also concession is there? Yes. If any loss of imported goods is noticed during such operation, such loss shall be exempted from whole of the customs duty. The exemption is available even if the quantity re-imported is short or low in quantity, as long as the nature and variety of the goods is same. Okay, so this process loss is there, that process loss and all will be allowed. Then section 21 already we saw derelict jetsam. Section 24. So section 20 concession with respect to re-importation, 21 derelict jetsam etc. So 22 abatement, 23 remission of duty and relinquishment of title, 24 is denaturing or mutilation of goods. At the time of import of the goods, so those goods will be possible for different usages. Depending upon the usages we need to pay customs duty. For example, sulfuric acid imported, that can be used for laboratory, then it will be zero customs duty. Then if it is used for manufacture, then the customs duty is payable at 10%. So now depending upon the usage there is a change in customs duty. Now you imported sulfuric acid for laboratory, then you make it unfit for manufacture by diluting it so that you don't have to pay customs duty. That is known as denaturing of goods. And mutilation of goods, if you are importing a second hand car, you need to pay high customs duty, which is around 150% customs duty we need to pay if you are importing a second hand car. But I am importing a second hand, that is used second hand, like used cars. I am importing a used car for what purpose? Not to use that car, but I want the parts in that car. Then you don't need the car? Yes. Then in that case break the car, take the parts, remaining and all, body and all you scrap it. So only parts of that car you take, so that you will pay whatever is the rate of duty applicable for parts of the car, which is just 15% only. Whereas if you import the car as such, you need to pay 150%, whereas only parts of the car you don't have to pay that much. That is known as mutilation of goods. And central government may make rules regarding the same. Duty is payable as if the goods are imported in denatured or mutilated form. Then, so this section 25A, this is not insured, inward processing of goods. Inward processing of goods. This 25A and 25B are two sections which are given, but yet the notifications are required to be issued in this regard. So 25A is like 45 2017 and 60 2018. Two notifications we saw now, that is import, export, re-import, export, import, re-export. For that only. Inward processing of goods means what? First we exported and we are importing it for repairs or further processing or manufacture, and thereafter you need to re-export within 1 year, and imported and exported are same. Already we had a notification. In future those two notifications will change. So they will be giving new set of notifications. For that they made this section. So far those 2 notifications are given under 20. So now these 2 notifications they will scrap and they will be coming out with new notifications in future. For that only these 2 sections are notified. Then 25B, outward processing of goods. This outward processing of goods, customs duty not payable fully or partly on the goods re-imported. So if such goods are exported for repairs, so import, export, and again it is coming back, then customs duty payable only partly or not at all payable. Goods should be re-imported within 1 year and export and re-imported goods should be same. But again, I have already given this. Notifications are yet to be released by CBIC in this regard. Suppose if at all you were asked about this section 25A and 25B, just this much information only they can ask. So usually they will not be touching this. Trust me, it will not be touched. But those 2 notifications they can check, that is notification 45 2017 and notification 60 2018. That is about these exemptions. Look into segment 27, assessment and audit under customs. There are 2 sections in this, section 17 and section 18. Section 16, 15 already we discussed. 15 talks about relevant rate for determination of rate of duty in case of import, relevant rate for determination of rate of duty in case of export. Whereas this section 17 is applicable in case of self-assessment, section 18 is provisional assessment, section 19 also already we completed. 19 is import of goods as a package that contains articles liable to different rate of customs duty. Section 17 self-assessment says that, so whenever you are filing bill of entry or shipping bill, you are an importer filing bill of entry, you are an exporter filing shipping bill, you can compute how much duty you need to pay, and that is known as self-assessed bill of entry or self-assessed shipping bill. Now that bill of entry or shipping bill will be taken up for verification by the customs officer, and if everything is proper, then it will be left, okay, that is it will be processed. Suppose if there is any issue, so they will be doing they will reject the value and they will determine the value in terms of that customs valuation rules 2017, rule 4, 5, 6 we have now. So transaction value of identical goods, similar goods, like that they will determine the value, that is known as reassessment. That reassessment will be done by the customs officer. Now either accept that reassessment duty and pay, or you don't want, then within 15 days they will be passing a reassessment order. On that order you can go for appeals under customs, that is this. So duty to be self-assessed by the importer or exporter, verification by the proper officer, reassessment of duty if the proper officer, if self-assessment not done correctly, importer may agree they pay the same by amending bill of entry or shipping bill, or either if they can pay or within 15 days, so the order will be passed. On that order we can go for appeal. So these are the 5 steps that you need to remember. First, self-assessed bill of entry or shipping bill. Number 2, it will be taken up for verification by proper officer. Number 3, so reassessment if it is not self-assessed properly. Number 4, accept and pay. Number 5, within 15 days order will be passed, on that you can go for appeals. Then provisional assessment. What are the cases when provisional assessment is possible under GST? Only one case, when importer when the registered person is unable to determine the value or rate of GST, he will make application to the officer in GST. Whereas in case of customs, 4 cases, very important, mark that as important for short note. When importer or exporter is unable to determine the value or rate of duty, that is number 1. Number 2, when the customs officer is of the opinion that so that goods are requiring any chemical test or examination. Number 3, when importer or exporter required to furnish the documents but not yet furnished. Number 4, he furnished the documents but those documents are not sufficient. In these 4 cases, there will be provisional assessment. Importer or exporter unable to do self-assessment and they wanted to do chemical examination or test, necessary documents not produced or produced, but customs officer want to carry out the further inquiry in these 4 cases. And what are the regulations in this regard? So first they will be passing a provisional assessment order, and so they will intimate within 15 days for the documents. If the documents, that is in this second and third, first case upon application they will pass provisional assessment order, and second case they will immediately pass provisional assessment order for testing. Okay, third case and fourth case, first they will be intimating to the person to file the documents within 15 days, and that person could not file the documents, okay, documents to be submitted within 1 month plus 3 months by customs officer. It can be extended for a further period of 3 months by ACDC plus unlimited time by commissioner. Okay, and they have passed an order for provisional assessment and they are asking that person to submit the documents within this time, and finalization of provisional assessment, whether the documents are submitted or not submitted. Documents are submitted, then within 2 months from the date of receipt of documents complete the final assessment. Documents not submitted, then within 1 month from the date of provisional assessment you complete the final assessment. Now upon final assessment, can this final assessment be extended? Yes, it can be extended for a further period of 2 months, 3 months. Now upon final assessment, 3 things could happen, that is final assessment greater than provisional assessment. Now we need to pay the differential duty along with interest. What rate of interest? In customs always 15% per annum. 15% per annum from when? From the first day of the month in which the provisional assessment order has been passed. What is the date on which provisional assessment order has been passed? So say 28th March, then from 1st March. If it is from June, 15 June, 1st June. So like that, whenever it is passed in that month. So first day of that month in which provisional assessment order is passed till the date of payment of differential duty. Suppose both are equal. Provisional assessment equals to final assessment. No need to pay anything, you will not get anything. Suppose if final assessment is less than provisional assessment, within 3 months from the date of final assessment they need to pay. Within 3 months from the date of final assessment they need to pay. Otherwise they need to give an interest at the rate of 6% per annum. From when? After expiry of 3 months from the date of final assessment. Now for the sake of this provisional assessment, importer shall execute a bond and furnish security in the form of bank guarantee, and refund of differential amount upon final assessment is subject to unjust enrichment. So we need to prove that. So there is no burden transferred. For example, provisionally we paid 20,000. The 20,000 we recovered from our buyer. Then we will not get the refund. So refund is subject to unjust enrichment. Otherwise it will be transferred to consumer welfare fund. Provisional assessment is applicable for both imports and exports. Suppose if you are not following any of the procedure as an importer or exporter as per this provisional assessment regulations, what will be the penalty? The penalty will be up to 50,000. Then audit under customs. So this audit under customs is post clearance audit. Post clearance audit means once the imported goods are cleared, so thereafter, so customs officer can come to our premises or can ask the importer or exporter to bring the documents to his premises and he can complete the audit. And this audit can be conducted by the customs officer only, and they will take CRCMA for assistance. So therefore CRCMA will not conduct this audit. This audit will be done by the customs department. And so every person who is importer or exporter or custodian or any person engaged with import or export, he is required to maintain the documents, books of accounts for a period of 5 years. In case of GST, 6 years, here for a period of 5 years, and there 6 years from the date of due date of furnishing annual return. Here 5 years from the end of the financial year. And selection of auditor documents is based on risk parameter basis. They are also same. And audit can be conducted either at auditee premises or proper officer's place. And they need to give a notice. What is that notice? 15 days notice. But in GST, 15 working days notice. Here it is 15 days notice. And any contravention of the audit provisions, what will be the penalty? Penalty will be up to 50,000 rupees. Then interest on account of delay in payment of customs duty. So whenever an importer is filing a bill of entry for clearance of imported goods, he has two options: immediate payment option or deferred payment option. But deferred payment option is given to some notified exporters, notified class of exporters. From time to time, that is customs department will notify certain exporters eligible for this deferred payment option with respect to their import. Okay, so this immediate payment means today we file bill of entry, today itself we need to pay customs duty, otherwise from tomorrow there will be interest. And remember, always for computing interest, that from date also to be included and till date also to be included, both dates to be included while computing the interest. Okay, so 15% per annum for every day delay. Deferred payment option. Deferred payment option means if the bill is returned from 1st to 15th of a month, then the 16th working day of that month. So which means between 1 to 15, how many holidays and Sundays are there, we need to count. and we need to extend it. So that will be taken as the 16th working day. Then suppose if the bill is returned from 16th to 30th or 31st of that month, so don't see any holidays in that. So see the next month first working day. See the next month first working day. If the bill is returned between 1st to 15, then the 16th working day. If the bill is returned from 16 to end of that month, next month first working day. And suppose if it is the month of March, it is 31st March. Beyond that time, if you are paying under deferred payment option, interest will be at the rate of 15% per annum payable. Then duty payable on account of reassessment or provisional assessment. Under self-assessment, they are doing reassessment order. So that reassessment order amount or provisional assessment order amount should be paid within 1 working day. If you are paying it beyond this 1 working day, interest will be payable at the rate of 15%. So today they gave a provisional assessment order. So for asking us to pay 20,000, that 20,000 we need to pay within 1 working day by tomorrow. Otherwise interest will be calculated from day after tomorrow. Same way today they passed a reassessment order. By tomorrow we need to pay, otherwise from day after tomorrow interest will be payable. Whereas finalization of provisional assessment, this is for provisional assessment amount. This is differential amount payable on account of finalization. That already we discussed. 15% per annum from the first day of the month in which provisional assessment is made till the actual date of payment. So this one page gives you all the interest under customs for purpose of delay in payment of customs duty. Then segment 28, duty drawback and refund. So first we will see duty drawback. There are 3 sections here: 74 subsection 1, 74 subsection 2 and 75. When imported goods are exported as such without use, then we will get duty drawback under 74 subsection 1. When imported goods are exported as such after use, then we will get duty drawback under 74 subsection 2. This is without use, this is after use. When imported goods are exported after manufacture or any process, then it will be section 75. Now, this is about duty drawback. Duty drawback means we will get refund of duty, customs duty, and how it will work. So input tax credit versus duty drawback. That is, whenever we are claiming duty drawback under section 74, that is these 2 sections, 74.1 and 74.2, not only the customs duty, but even IGST paid on import also we will get as a refund. Due to that reason, we should not claim ITC with respect to that. So duty drawback under section 74 covers IGST and GST compensation cess. Therefore, ITC cannot be availed with respect to the same. Whereas in 75 duty drawback, the refund is covering only the customs duties, so not IGST and compensation cess. So can that IGST and compensation cess be taken as ITC? Yes. And upon export, you will get the refund of that ITC. Okay. So therefore, GST it will be covered. Again, I am repeating. So in case of, there are total 2 sections broadly for the purpose of duty drawback. 74 says that when imported goods are exported, either as such or that is as such with use or without use, then in that case, how much customs duty you paid at the time of import, a percentage of that customs duty you will get as a refund. How much refund we will get? In case of 74 subsection 1, 98% of customs duty paid at the time of import we will get as refund. In case of 74 subsection 2, we have duty drawback at reduced rates. So 95, 85 like that. So this reduced rates of duty drawback we will get. But all these percentages we need to compute on what? We need to compute on the total customs duty including the IGST and GST compensation cess. So now in that case, can we claim the ITC with respect to that? At the time of import, I paid basic customs duty 10,000, I paid social welfare surcharge 1,000 and I paid IGST, that is, so 1,11,000 into 18%, so 19,980. 19,980 IGST say at the rate of 18%. Now this much what I have paid. So total customs duty that I have paid will be 30,980 I paid. How much will be the duty drawback I will get? 30,980 into 98% I will get. So into 98% means, so 30,000 360.40 I will get as duty drawback, which means even this IGST component also I am getting as duty drawback. Therefore, how much is the ITC that I can avail? 0. I should not avail any ITC. Whereas this is in case of section 74 subsection 1. This is how it will work. 74 subsection 2 also the same way, but instead of 98% there will be some other percentage. Then in case of section 75, what will happen in case of section 75? We will pay basic customs duty 10,000 and social welfare surcharge 1,000 and thereafter IGST, so 19,980. So total we will be paying 30,980. Now we are using this for the purpose of export. What is the FOB value of export? The FOB value of export will be, say, using this we exported for some 1 lakh. 1 lakh is the FOB value of export, and in this 1 lakh, so we get a duty drawback at a notified rate. What is the duty drawback notified rate? The duty drawback notified rate is, so 6% of FOB value. 6% of FOB value means how much I will get as duty drawback? How much I will get as duty drawback? 6,000 only I will get as duty drawback. But this duty drawback is to cover what? Basic customs duty and social welfare surcharge only, but not IGST. Then how much ITC they can take? ITC I can take 19,980. There is no restriction. Are you understanding this? So that is this part. So that is this. Very, very important. So you need to have this clarity. Then next 74 is applicable whenever imported goods are exported as such with use or without use. But what is the time limit within which it should be exported? So within 2 years from the date of payment of import duty. Super point. It is not from the date of import, but within 2 years from the date of payment of import duty. Suppose if we imported it, kept it in the warehouse for 2 years, thereafter we cleared from warehouse after 2 years. So now the 2 years will be, say 3 years, we kept it in warehouse. Thereafter we cleared. Now the 2 years will be computed from the date of clearance from the warehouse, because from the date of payment of import duty till the time of export. Export means let export order, that period only should be taken, and it can be extended for a further period approved by CBIC. Then what is the rates of duty drawback? 74 subsection 1, 98% of the customs duty paid on import, whereas 74 subsection 2, duty drawback at reduced rates. What is that reduced rates? That is there in page number 179. So we need to check whether it is motor vehicle imported by any person or any other goods imported by individual for personal use. Yes, then in that case, so we have like a depreciation model, means whatever is the customs duty paid, from that, so for every quarter or part thereof, 4, 3.3, 2.52, this 4, 3, 2.52 already we learned in depreciation. Import of goods at concessional rate of duty rules, capital goods when we are selling. But here it is first year, second year, third year, fourth year. There first year, second and third, fourth and fifth, thereafter. But here it is only 4 years. First year, second year, third year, fourth year. Thereafter, if you are exporting, you will not get any duty drawback. For example, we are using it for 2 years, 3 months. 2 years, 3 months. Then how much will be available for duty drawback? Take 100 minus. First year we used. So 4 into 4, 16%. So fine. So 16% should be taken. Is there any way it can be removed? So 100%. So for 2 years, so first year 16%. What will be for second year, pa? So second year it will be 3. So therefore 12%. Then thereafter 3 months. 3 months means 1 quarter. So 2.5%. So which means 100 minus 16 minus 12 minus 2.5. 30. 69.5% we will get as duty drawback, like that. So therefore we are using it for 4 years. 4 years means 16, 12, 10 and 8. So that much will be reduced. So remaining we will get as duty drawback. Thereafter we will not get anything as duty drawback. Already we crossed the time limit permitted 2 years. Thereafter for further 2 years we need to get the permission, then only it is possible. Whereas in other cases means what? First, this is applicable in which case? So far whatever we discussed, this depreciation model is applicable in which case? Motor vehicle imported by any person or any other goods imported by individual for personal purpose. In other cases, for example, I am importing a laptop for my business purpose and I am exporting. Now which one will be applicable? First branch or second branch? Second branch, because it is not individual for personal purpose. So therefore for business purpose, then it will be second branch. What we need to do? We need to first check the period of usage. For counting the period of usage, from the date of payment of customs duty on import till the date of export should be taken. That period should be taken. Suppose if it is 0 to 3, you need to increase it by every 3 months. 0 to 3, 3 to 6, 6 to 9, 9 to 12, 12 to 15, 15 to 18 and more than 18. More than 18, 0. You will not get any duty drawback. It starts with 95, comes down by 10% up to 75. So 95, 85, 75. So first 3 will be 10-10 reduction. First 3 numbers. Next 3 numbers will be 5%. So 70%, 65%, 60%. So this will be the duty drawback rate. So at this duty drawback rates, we will be getting the amount of duty drawback. So that is about duty drawback at reduced rates, 74 subsection 2. But this 74 subsection 2 is applicable when imported goods are exported as such after use. Then is there any prohibitions with respect to this? Yes. Duty drawback less than 50, you will not get duty drawback. Export price of the exported goods is less than duty drawback, then also you will not get. What is this export price of export goods less than duty drawback? We imported an article for 1 lakh. Customs duty paid on that article 30,000, exported after 18 months. Because of 18 months, the market value of that goods have come down to 20,000 and the duty drawback will be exported as such without use after 18 months. So what is the customs duty paid? 30,000. 30,000 into 98%. So 29,400. But its market value now is only 20,000. So you will not get duty drawback. So if the market value of the exported goods is less than the amount of duty drawback, we will not get duty drawback. And also, duty drawback under 74 subsection 2 means imported goods exported after use is not applicable in case of wearing apparel, T-chest, wearing apparel, that is imported garments, used it and then exported. You will not get duty drawback. Imported garments not used and it is exported without use, then we will get duty drawback 98%, because this restriction is only for 74 subsection 2. Then exposed T-chest is referring to T boxes. Then exposed cinematograph films, that is the film reels, we are importing and we are exporting it after use, we will not get any duty drawback. And unexposed photographic plates, that is X-ray films, X-ray plates and all, so we will be importing and thereafter we are exporting, we will not get duty drawback if you are using it. Okay. Then suppose if you are not using it and exporting, you will get duty drawback under 74 subsection 1. Discretionary prohibition. Central government may notify that no duty drawback shall be admissible if any goods which post import are likely to be smuggled back to India. We imported from Germany, we are sending it to Pakistan and we are claiming duty drawback 98%. Again from Pakistan it will easily enter into India and we are selling in India. So literally we did not pay any customs duty. Okay. So therefore it is like imported goods exported. So as per records, imported goods are exported, but from Pakistan easily through land route it will enter into India. No customs duty paid. Means literally with 2% payment of customs duty, so you enjoyed the goods. So that's why they will be not giving the duty drawback. Identity satisfaction. Yes, the exported goods, that is the imported goods and the exported goods should be same. And application duty drawback claim can be made. So that is with respect to this. 74. Then 75 parallelly you see. 75 is applicable when? 75 is if imported goods are exported, imported goods are used in manufacture and then exported, then 75 is applicable. For 75 there is no time limit, which means the goods can be exported after manufacture after 10 years, 20 years also. And how the duty drawback will be given? the duty drawback is without recourse to customs duty paid on import, which means in case of 74, we saw how much customs duty paid on import, a percentage we got as duty drawback, but in 75 it is not like that. 75 we have three different rates: all industry rate, brand rate and special brand rate. All industry rate means notified rates, and brand rate when a product exported, for example green tea exported, there is no all industry rate, so we have to request for brand rate. They will specify how much is the percentage duty drawback we will get. And suppose if the all industry rate notified and the duty drawback amount is less than 80% of the customs duty payable, for example in this case you can see, so we have imported goods, we paid this much, and FOB value of export 1 lakh, duty drawback 6% of FOB value, duty drawback is only 6,000. Now what is this 6,000 as a percentage of 11,000? 6,000 divided by 11,000, how much is the custom duty paid on import except IGST? So 6,000 divided by 11,000, that is 54.54. Is it less than 80%? Yes. So we can make a request for special brand rate. When the duty drawback as per all industry rate is less than 80% of the customs duty paid on import, we can make a request for special brand rate. Now whenever we are going for special brand rate, we need to ensure that we are not going for all industry rate and then going for special brand rate. Means this computation we need to make first and then we need to go for special brand rate directly. If already all industry rate duty drawback claimed, again we cannot go for special brand rate. Exporter shall apply for fixation of brand rate, and until fixation of brand rate, exporter may request for duty drawback on provisional basis. That is in case of brand rate. In case of special brand rate, you can see next page footnote. Exporter shall apply for fixation of special brand rate. He is not entitled to claim AIR and then apply for SBR. Till fixation of SBR, exporter may request for grant of duty drawback on provisional basis. Now whatever duty drawback that they are giving, can they reduce it? Yes, they can revise it. As per rule 4, central government may revise the amount or rates of duty drawback. Then, so in case of 75, what are the prohibitions? Mandatory prohibition. First 2 points same. Duty drawback, duty drawback less than 50, we will not get. And market price of the exported goods less than duty drawback, we will not get. For example, value of exported goods 3 lakhs. FOB value declared, we inflated like anything, 4 lakhs. 4 lakhs into 10%, 40,000. Duty drawback will not be given because the market value of that exported goods only 30,000. Then minimum duty drawback is 1/3 of the market price. So that is when the market price is more than the duty drawback, we will get duty drawback. If the market price is less than duty drawback, we will not get. When the market price is more than duty drawback, we will get duty drawback, but the duty drawback is restricted to 1/3 of the market value. So 1/3 of the market price will be the duty drawback restricted to. Export price 1 lakh, Indian market price 50,000 and duty drawback rate 30%, 30,000. Market price is more than duty drawback. So we will get duty drawback, but how much? 1/3 of market price. 1/3 of market price is 16,667. That much only we will get. Then rule 8. Suppose under foreign trade policy, anywhere for a person there is a value addition as an obligation. That is, so suppose if I am a AIA holder, advance authorization holder, I need to achieve 15% value addition, which means my import to export value, there should be a value addition for 15%. Import value 1 lakh, export value should be 1,50,000. Then in that case, so I have not achieved that 15%. So then I will not be eligible for this duty drawback. No duty drawback allowed if value of export goods not more than the notified percentage of value of imported materials used therein. Same way, suppose if there is no value addition, but I need to ensure there is a positive value addition. What is that positive value addition? The export value should be definitely more than the import value. Otherwise, I will not get duty drawback. No duty drawback allowed if value of export is less than the value of imported material used therein. Identity satisfaction not required. Why not required? Definitely imported goods and exported goods are not same. Application, there is no separate application. Shipping bill itself is treated as application. Then what is the interest for the purpose of payment? Suppose if duty drawback not paid to the claimant within 1 month from the claim date, he shall be paid interest at the rate of 6% per annum from the expiry of 1 month. That is, I am making application for duty drawback. Means I need to get the duty drawback. if I am not getting duty drawback from the government within 1 month from the date I made application, they need to give me interest at the rate of 6% per annum on expiry of 1 month. This is the interest payable by government or payable to government? Payable by government. Now, second, suppose I got the duty drawback. I am not supposed to get the duty drawback, but I got the duty drawback. Means erroneous duty drawback. In that case, it will be recovered from me. When they are recovering from me, they will recover from me along with interest at the rate of 15% per annum. From when? From the date I got the duty drawback till the time they are recovering the duty drawback from me. Okay. So, from the date of payment of duty drawback till the date of recovery of duty drawback. Understood these two interest provisions? Then, next we have refund under customs. Section 26 already I discussed with you. What is that I told you? At the time of export, I paid export duty, customs duty on export. Now the same goods are coming back to India as sales returns. Now whatever customs duty I paid at the time of export, I will get as a refund. What is the time limit within which the sales return should happen? Within 1 year. Within 1 year. If exported goods are imported within 1 year, and once it is imported back, sales returns happen, within 6 months from the date when it is brought to India, I need to make application for refund and I will be getting refund of customs duty paid on export. Then another section 26A. This 26A is when imported goods are defective or not conforming to specifications, but I cleared on payment of customs duty. If I could identify that before itself, then before clearance itself, I will be getting benefit, section 13, 22 or those benefits I will be getting, but I cleared upon payment of customs duty, I cleared. So now in that case, the goods are defective or not conforming to specifications. Now either I can export it back or I can destroy or I can abandon within 30 days plus 3 months from the order for home consumption, and customs officer may permit me to export it back or destroy or abandon. Now how much customs duty I will get as refund? 100% customs duty I will get it as a refund. Now this always should be connected with 74 subsection 1, because in 74 also imported goods exported as such we get 98%, but in this case we get 100%. Compared to 74 subsection 1, 26A is best. Always when you are applying 74 subsection 1, apply 26A also. So connect these two, and in regular batch, in fast track batch also, I have connected this multiple cases. I gave the differences between 26A and 74 subsection 1 because that's an untapped area. Definitely questions can be asked from that. So wherever they are referring to 74 subsection 1, try to write about 26A, because in 26A we get 100% of customs duty paid as refund. Then 27 is normal, that is refund of excess payment of customs duty. By mistake I paid excess customs duty, I can get it as a refund, and the application for refund should be made within 1 year from relevant date. In case of GST, 2 years from relevant date, here it is 1 year from relevant date, and this 1 year is not applicable in case of duty under protest. There 2 years is not applicable in case of refund of cash ledger. So here 1 year time limit is not applicable in case of duty paid under protest. Suppose if you made an application, they did not give refund within 3 months from the time of application. In GST 60 days, here 3 months, then interest will be payable at the rate of 6% per annum after that period. So this is about duty drawback. So this time in duty drawback, I have added lot of points compared to the old book. So lot of points I have added in that, because these are all untapped areas. I thought maybe more questions could be asked on that. Okay. See, I will also be upgrading attempt after attempt. So reason being, so it's not that I will not be giving and then I will be adding. So I will see these areas are not touched. Maybe there are chances, because every paper as a faculty, for you 8 subjects, for me only 1 subject. So therefore I have to analyze that, and when I am analyzing it, I feel like these are all not asked. So there are chances. That's why those points and all I have given. Then next segment, segment 29, baggage. What is baggage? Baggage refers to passenger's luggage, and whenever a person is bringing his baggage, he need to pay customs duty. What is the rate of customs duty payable by him? 38.5%. So BCD on baggage. What is the BCD on baggage pa? BCD on baggage 35%. And what is the social welfare surcharge on baggage? Social welfare surcharge on baggage is 10%. So therefore, what is the effective rate? The effective rate of baggage is 38.5%. Sir, what about IGST? There is no IGST on baggage. There is no IGST on baggage. Okay. There is no IGST on baggage. Then next, there are 3 goods. On 3 goods, always the baggage duty will be 110%. There are 3 goods on which the baggage duty will be 110%. First, you need to remember the baggage duty is BCD 35, social welfare surcharge 10, effective 38.5, IGST on baggage not there. Then next, there are 3 goods. There are 3 goods on which the rate will be 110%. What are those 3 goods? That is firearms. That is firearms. Number 2, cartridges of firearms. Cartridges of firearms exceeding 50. And number 3, cigarettes exceeding 100. Cigars exceeding 25. And these two sum 125. Tobacco exceeding 125 grams. Okay. So, in case of these 3 goods, what is the rate? What is the rate? 110% is the baggage duty. So, 3 goods, firearms, cartridges of firearms exceeding 50, cigarettes exceeding 100, cigars exceeding 25, tobacco exceeding 125 grams, the rate is 110%. What if it is within this? Suppose cartridges of firearms up to 50, 38.5, and cigarettes up to 100, 38.5, cigars up to 25, 38.5, tobacco up to 125 grams, 38.5. Only when it exceeds this limit, the rate will be 110%. In case of all other goods, the rate will be 38.5. This you don't forget. For these 3 goods only 110%, all other cases it will be 38.5%. Okay. Then next, what is the concessions with respect to baggage? So there is a general free allowance. There is a general free allowance. How to remember this general free allowance? Easily you can remember pa. Say this, GFA, general free allowance. First you divide into 2. That is, he is coming from Nepal or Bhutan or Myanmar. Okay, Nepal, Bhutan and Myanmar or other countries. He is coming from Nepal, Bhutan or Myanmar or other countries. If he is coming from Nepal, Bhutan or Myanmar and he is coming by land route, he is coming by land route, no GFA to him, no GFA to him. Whereas other cases means he is coming by airlines or he is coming by train, etc. and all. So then it will be how much? 15,000 GFA. 15,000 will be GFA. Suppose if he is coming from other countries, now you see who he is. Tourist of foreign origin. Tourist of foreign origin. Tourist of foreign origin. Tourist of foreign origin 15,000. Whereas others 50,000. Others 50,000. So this is the simple way we can remember. So GFA divided into 2. GFA divided into 2. Nepal, Bhutan, Myanmar, land route, no GFA. Other cases 15,000. Other countries, tourist of foreign origin 15,000. Others 50,000. And this general free allowance is applicable for dutiable baggage. What is dutiable baggage? Other than personal effects, used personal effects, travel souvenir and laptop over 18 years age. Other than that, remaining are dutiable. So what are exempted? Used personal effects are exempted. What is used personal effects? Whatever is necessities for their daily life. So that will be called as used personal effects. But used personal effects excludes jewelry. So therefore, used personal effects we need to take and used personal effects will be exempted. Whatever may be the value. Then travel souvenirs. Whenever they visit a particular country, as a memory of that visit of that particular country, they will be bringing something. That is known as travel souvenir. So then only people will know that they have visited that country. So they will be bringing that and they will be doing overaction by showing that. So that will be called as travel souvenirs, which is exempted. And laptop computer more than 18 years of age. So then one laptop will be exempted. So these are the three exemptions that we have. What are the three exemptions that we have? Come on. Used personal effects. Used personal effects excludes jewelry, travel souvenirs and laptop for a passenger more than 18 years of age. Okay. So that is this. You can see below, used personal effects, travel souvenirs, irrespective of the value, is freely allowed. Personal effects means things required to satisfy daily necessities but does not include jewelry. And then the free allowance of one passenger shall not be clubbed with the free allowance of another passenger. For example, two people are coming. Okay. So Mr. A and Mrs. A are coming from UK. Okay. From UK they are coming and they have brought three laptops of so 55,000 each. 55,000 each. Now actually two laptops exempted. Why two laptops exempted? Mr. A and Mrs. A means they were married, definitely more than 18 years. So therefore two laptops exempted and one laptop will be dutiable. But how much is the general fee allowance? Only 50,000. Extra 5,000 only na sir. It's okay. My wife only clubbed together. No, there is no clubbing provision and all here. So therefore what we need to do, that laptop will be dutiable in anyone's baggage, which means 55,000 minus 50,000. The balance 5,000 will be dutiable. So that is this. One allowance of one passenger cannot be pooled with the allowance of another passenger. Okay. Then next part. So the free allowance, sir, this general fee allowance is not applicable for certain goods. What are those goods for which GFA not available? Already we saw three goods for which 110% is applicable. Those goods plus extra three goods you need to remember. What are those three goods? Firearms, cartridges of firearms exceeding 50, cigarettes exceeding 50, cigars exceeding 25, tobacco exceeding 125. Cigarettes exceeding 100, cigars exceeding 25, tobacco exceeding 125. These three plus alcoholic liquor or wine in excess of 2 liters. That is also GFA not allowed. Means can we bring? Yes, we can bring. How much duty we need to pay? 38.5% we need to pay. GFA not available. Gold or silver in any form other than ornaments, which means gold bars, gold coins, etc. other than ornaments. Then LED, LCD and plasma TV. So these are the next three. For this next three, what is the GST? What is the baggage rate? 38.5%. But GFA available? GFA not available. So there are 6 goods for which GFA not available. That is this good, general free allowance. Then, sir, what about infants? For infants not more than 2 years of age, anything is available as general free allowance? Nothing. Only used personal effects. That diapers, then milk bottle, etc., feeding bottle, that much only allowed. Okay. Then there is something called as jewelry allowance. So far what we have seen, rule 3 and rule 4 is duty free allowance or general free allowance. That is for passenger coming from other than Nepal, Bhutan, Myanmar and Nepal, Bhutan, Myanmar. The 3 and 4 we completed. Whereas rule 5 is jewelry allowance. Jewelry allowance is applicable to a person who is staying in abroad for a minimum period of 1 year. And what is that jewelry allowance? Jewelry allowance will be, for a male passenger 20 grams with a value cap of 50,000. For female passenger 40 grams with a value cap of 1 lakh. For example, Mrs. D coming to India from Singapore, okay, and she is bringing 45 grams of value 1,25,000. Okay. So now what we need to do? Simple. First, how much is allowed? Weight wise, you see. How much is allowed weight wise? 40 grams. 40 grams is how much? So if 45 grams is 1,25,000, 40 into 1,25,000 divided by 45, which means that 1,11,111. But how much is allowed? Only 1 lakh is allowed. Okay. So therefore allowed is how much? Allowed is 1 lakh. Therefore dutiable. What is dutiable? Dutiable will be 25,000. Total minus allowed. That will be total minus allowed. The balance is dutiable 25,000. Suppose in another example, 45 grams. 45 grams is exactly 1,10,000. Then how much will be 40 grams? How much will be 40 grams? 40 grams into 1,10,000 divided by 45 grams, that is 97,777. How much is allowed? 97,777. Whichever is lower, 1 lakh or this weight based, whichever is lower is only allowed. So remaining will be dutiable. So how much will be dutiable? Dutiable will be 1,10,000 minus 97,000. So that is 12,223. That will be dutiable. You understood or not? So either value or the weight based, whichever is lower is only allowed. So remaining we need to pay. That is this. In case of male passenger, 20 grams with a value cap of 50,000. Female passenger 40 grams with a value cap of 1 lakh. Then customs duty leviable already we discussed. For annexure 1 items beyond the limits, customs duty rate is 110% plus 110%, which case that also we saw. And in the last page you can see baggage last, that is next to next page. So I have given the rates. Firearms, there is no GFA, and what is the rate? 110%. Cartridges of firearms up to 50, what is the rate? 38.5. Whether we are eligible for GFA? Yes. Then beyond 50, whether GFA available? No, but the rate will be 110%. Cigarettes up to 100, GFA? Yes, GFA available, rate 38.5. Beyond that, GFA not available, 110%. Cigars up to 25, GFA? Yes, rate 38.5. Means after GFA on the remaining 38.5%, that is the meaning. Then on beyond the 25, GFA not available, 110%. Tobacco same, up to 125, GFA available, 38.5% rate. Beyond 125 grams, GFA not available, 110%. And then alcoholic liquor for human consumption, next three, the rate is always 38.5, no change. The rate is always 38.5, but only thing what it changes is the GFA available or not. So up to 2 liters, GFA available. Beyond 2 liters, GFA not available. Gold or silver, ornaments, GFA available. Other than ornament, GFA not available, but the rate is same, 38.5. LED, LCD, plasma TV, GFA not available, rate is 38.5. So this you can revise easily. So that's where I told you 3 goods, 110%, 6 goods, GFA not available. This is like cumulatively combining everything. Then next, what are the entitlements to a passenger who is transferring his residence to India? So there is one query. If freight is 20% of revised FOB, do we need to have deduct ship demurrage charges, light rate charges and bar charges from it? So because it is not incurred at the load port, yes. So we don't have to deduct that. That is when you take 20% of revised FOB, in the 20% itself all these are already included. So again don't add it. Simple. Okay. And then these are all payable in India, not at the load airport. So it is not part of FOB, but only thing when you take 20%, these are all already considered in the 20%. Then whether the situation of reducing the actual freight from 20% of revised FOB will arise only if freight is unascertainable, not necessary unascertainable. When and all we will take 20% of FOB, actual or 20% FOB, whichever is lower. So in air freight also we will take, sea freight also we will be taking when it is not ascertainable. In case of gold, are we supposed to declare that gold are taken out of India while going outside? Yes, we need to declare. Then at the time of coming back, no need to pay baggage duty. Otherwise we need to pay baggage duty. The 20 grams and 40 grams is without declarations, right? No, that is not for declared gold. That is for other than declared gold. New set of gold which you are buying and bringing, for that only the 20 grams and 40 grams. Whatever you are taking from India, you declare that. The same you are bringing. This 20 grams, 40 grams and all limit is not applicable in that case. Then, so what are the entitlements to a passenger who is transferring the residence to India? 3 to 6 months, aggregate value of 60,000. So 6 months to 1 year. That is, this is for what? Household articles. Sir, anyhow used personal effects is allowed. This is for household articles like mixie, grinder, etc. Whatever they are using there, they can bring. But to what extent they can bring? So 3 to 6 months. What is the last number? 6. 6 for 60,000. Then 6 months to 1 year. What is the last number? 1. 1 lakh. And 1 month, like 1 year in the preceding 2 years. What is the last number? 2. 2 lakhs. And beyond 2 years, it will be 5 lakhs. So that will be taken as the values up to which they can be bringing. And what are the ineligible articles? Annexure 1 and Annexure 2 articles they cannot bring. Annexure 1 6 articles already we know. And Annexure 2 color TV they cannot bring under this allowance. Video home theater system, dishwasher, refrigerator above 300 liters, up to 300 liters they can bring under this allowance. Deep freezer, video camera, cinematograph film of 35 mm and above. These are the ineligible articles along with Annexure 1, Annexure 2. Means these are the ineligible articles for these allowances. If you are bringing these articles, you need to pay normal customs duty 38.5%. Then other points, all the points are equally applicable for unaccompanied baggage. What is unaccompanied baggage? Baggage which comes within 1 month after arrival and 2 months before arrival. That is called as unaccompanied baggage. For that also it will be applicable. A for after, B for before, 1 month after and 2 months before. And member of crew who is in service can bring petty gifts up to 1,500 for personal or family use, because they are working in the ship or they are working in the aircraft. So every time if 50,000 allowance is given, then almost all iPhones in India will be brought by them only. So due to that reason, so we cannot allow them to for bringing general fare allowance, but only 1,500 chocolates or any cosmetics, petty gift items they can bring. And passenger carrying non-dutiable good and non-prohibited good should come through green channel, and if they are carrying dutiable and or prohibited goods, they should walk through red channel. Passenger has to make a true and full declaration regarding the contents of the baggage. And there is a concept called as temporary detention of baggage. That is, you are bringing some dutiable articles. You don't want to pay the duty. Super. You can keep the goods there. Again, when you are returning, you can take those goods. But remember, only those goods you declared, you can do that. You are bringing some cocaine, weed, etc. and all. And thereafter, customs officer identified. Temporary detention, you keep it, sir. When I am going, I will take. No. For prohibited goods and all, temporary detention not possible if you are not declaring that. Okay. Then, so with this, baggage is over, and we have 2 more areas: warehousing under customs and FTP. Okay. So a small relaxation for me, pa. 2 minutes, pa. Okay. 5 minutes I can take. Thanks, sir. Okay, coming back to this segment 30, warehousing under customs. Imported goods can be deposited in warehouse with payment of duty or without payment of duty. Without payment of duty. Whether the warehouse is licensed by customs or owned by customs. Licensed by customs. How many types of warehouses do we have? 3. Public, private, special. What is public warehouse? Any person's goods can be imported and kept in that warehouse. That is public warehouse. What is a private warehouse? Only the owner of that warehouse goods can be imported and kept in that warehouse. That is private warehouse. What is a special warehouse? In special warehouse only notified goods needs to be kept. What are those notified goods? You don't have to remember. Not there in study material. You don't have to remember those notified goods, not required. Clearly in study material they have removed those notified goods, which means that some notified goods as per government you need to deposit in the special warehouse. Okay. So types of warehouse: public, private, special warehouse. In public warehouse, goods belonging to any person can be deposited. In private, only goods belonging to licensee. Only notified goods can be deposited in special warehouse on which customs lock will be there, which means public warehouse and private warehouse will be under that is records based control, but in case of special warehouse it will be under the physical control, means customs lock will be there. Then if warehouse license is cancelled on account of breach of conditions by the license holder, goods deposited in such warehouse should be transferred to another warehouse or cleared for home consumption within 7 days from the date on which cancellation order is served. Generally license will be given, he breached the condition, now license is cancelled. What is the grace days given? 7 days. Within that 7 days we need to take out the goods from that warehouse or we need to move to another warehouse. Then there is a warehousing bond that will be executed. There are two types of warehousing bond: consignment bond and general bond. Consignment bond means every consignment we will be giving that bond. So that is every time we import we will execute this bond, and that bond is for what value? 3 times the duty payable at the time of deposit. Whereas there is something called as general bond. That general bond is as specified by the officer, that is for a period 6 months I will import any goods and I will keep it in the warehouse, so this much is the bond value. So that is called as general bond as specified by the officer. Consignment bond will be 3 times the duty payable at the time of deposit. Upon execution of bond, so warehousing order will be passed by the officer, and that warehousing order, once it is passed, from that period only, that time only, we need to count the warehousing period. What is the warehousing period? Maximum 1 year. That is the warehousing period. But in case of perishable goods, it can be reduced. That 1 year can be reduced, and suppose on necessary reasons, necessary grounds, it can be extended beyond 1 year also. And this period is not applicable in case of EOU, EHTP, STP and warehouse where manufacturing operations are permitted. What is a warehouse where manufacturing operations are permitted? Usually private warehouse, that is in our own warehouse we can do the manufacturing operations. So we can import it, do the manufacturing operations, and we can export also without payment of customs duty. So then in that case this time limit of 1 year is not applicable. And what is the interest free period? As we deposited the goods in the warehouse, there is a deferment of customs duty payable. So what is the interest free period? 90 days, and interest will be computed from 91st day. Already this is tested for May 22 exam. I don't think so, definitely it will be tested again. So it will not be asked, leave it. So 91st day, so it will be computed. So this 90 days should be counted from when? From the date of deposit or date of order. Date of order. Everything should be counted from the date of order, not from the date of deposit. Then manufacturing and other operations. So this is important. This can be tested this time. Manufacturing and other operations are permitted inside the warehouse, and so whenever manufacturing and other operations are permitted, so we can export it from there itself without payment of customs duty, or we can clear it to the home consumption upon payment of customs duty, the processed goods. Okay. So manufacturing and other operations are permitted and duty not payable on such warehouse goods if processed goods are exported. However, customs duty payable on the waste and scrap at the applicable rate to waste and scrap. So we exported some goods. When we exported some goods, that imported goods exported, there is some waste and scrap. That waste and scrap pertains to imported goods. For example, we imported steel and that steel imported, we made some products out of steel, we exported, but there will be some waste and scrap. 1000 kgs of steel imported, exported 960 kgs, 40 kgs is waste and scrap. That 40 kgs, when we are selling in domestic tariff area, that is after clearing from warehouse, we need to pay customs duty on that 40 kgs as if what is imported? Steel is imported or waste and scrap is imported? Waste and scrap is imported at the rate applicable to waste and scrap arising out of manufacture, and if such waste and scrap is not destroyed within the warehouse, or alternatively you don't want to pay duty on that 40 kgs, you can destroy that waste and scrap, you can dig and you can bury it there, so that no need to pay customs duty on that waste and scrap. Is it clear or not? So this point I am thinking that this can be tested, because already they tested interest point, so this point can be tested. In case of volatile goods, customs duty not payable on the quantity lost on account of evaporation and other natural causes. Say for example, a person has imported whiskey in one barrel, and what happened? So because of the heat, so the whiskey got evaporated. He imported 1000 liters in one barrel, and whereas the actual quantity is only 980 liters, 20 liters got evaporated. In that case, customs duty payable on 1000 liters or 980 liters? Only on 980 liters customs duty payable. Okay. Then, so see the next one. So this is a summary related to that, whatever we discussed in this. So this is a summary related to that. So first, goods will be imported, and that goods will be imported where? Either port or airport, and it will be under whose control? Custodian, and for a period of 30 days. Thereafter it should be either cleared within 30 days for home consumption or for warehousing, or else what will happen? That will be disposed of, or they will keep it in the warehouse. Now suppose if you are clearing it to warehouse, which warehouse you can clear? Public, private, special. For notified goods, public and private, what control? Record based. Special warehouse, lot based control. All these three are licensed by commissioner. Commissioner or principal commissioner will be giving the license to this. Okay. And thereafter, so for what period you can keep it? For EOU, EHTP and private warehouse, etc., no time limit, they can keep. Interest free period also not applicable to them. Whereas for others, what is the period for which they need to keep? 1 year, and that is maximum 1 year. And what is the interest free period? 90 days. And thereafter the goods can be cleared for what purpose? From there, either we can take it to another warehouse, or we can clear it for home consumption, or we can export. Now listen, this is something which is important. What are the three things that we can do with respect to this warehouse? What are the three things? So clear it to another warehouse. When you clear it to another warehouse, what happens is that, so we don't have to pay any customs duty. Why? Because still the goods are under the control of customs. So whether customs duty payable? No. Customs duty not payable. Whether warehousing interest is applicable? Yes. But till the time we actually clear from the another warehouse, we need to actually clear from another warehouse na. Till that time the warehousing interest will be applicable. No customs duty payable for clearing it to another warehouse. What about the bond? Whether we need to execute a new bond? No. Bond will be continued. Bond continues. Bond continues. And what is the overall period? 1 year. That overall period 1 year is applicable for all warehouses put together, or again for the new warehouse 1 year? No. So all warehouses put together, that 1 year period is applicable. So that is this another warehouse. Got the clarity pa? Or else another thing can be done. Or else what we can do? Clear for home consumption. Clear for home consumption. When you clear for home consumption, whether you need to pay duty? Yes. Customs duty payable. And whether we need to pay interest also? Yes. Interest payable. So interest payable from when? From 91st day till the date of actual clearance. We need to pay, that is actual payment of customs duty. And then what about the bond? Bond released. Why bond is released? So because we paid the customs duty now, so the bond will be released. Now there is one case law which you can see. Kesoram Rayan case and SBEC Sugars case. So these two cases of Supreme Court gives the same principle. If goods are not cleared within the warehousing period, then the goods are deemed to have been cleared. So that date on which warehousing period is expired, that should be taken as the relevant date for determination of rate of duty. Generally, in case of warehouse goods, which rate we will take? The rate prevailing at the time of ex-bond bill of entry, actual clearance, correct or not? Ex-bond bill of entry. But in this case, that is SBEC Sugars and Kesoram Rayon case, when the goods are deposited in warehouse and the warehouse period is expired, upon expiry of warehousing period, the goods are said to be improperly removed, which means that that date is taken as the relevant date for determination of rate of duty. That is that. Understood or not? Then next part, suppose if you are exporting from where? From the warehouse, whether you need to pay any customs duty? No, because there is no import. Why there is no import? It did not cross the customs barrier, na? No need to pay any customs duty. And what about the warehousing interest? Interest also not payable. If duty is 0, then interest also will be 0. No need to pay the interest. And we need to execute a shipping bill. Shipping bill or bill of export we need to file. And what will happen to the bond? The bond will be released. Clear pa? Then what are the rights of the owner with respect to warehoused goods? He can touch and feel those goods. He can inspect the goods. He can sort the goods and he can show, see, this is my goods only, like that he can show. But he need to exercise care and caution. Why? If the goods got damaged, then customs duty payable will come down. Na? Due to that reason, he need to exercise the care and caution. That is with respect to warehousing provisions. Then look into foreign trade policy. So FTP contains set of guidelines or instructions issued by the central government. So FTP is the mind of import or export. International trade, the body is customs law, whereas the mind is FTP. FTP talks about what to import and what to export. So they will be regulating imports and encouraging exports. But what customs law will do? Customs law will be giving the procedure, valuation, and how to pay the customs duty or how to import and export. What to import and export is FTP, and how to import and export is customs law. That's the connection between FTP and customs. FTP is a foreign trade policy, the mindset of the government. So for a period of 5 years, it's like a 5-year plan. And this 5-year plan, so because of COVID, they extended and they made it a 7-year plan. So therefore, from 2015, it got extended till 39/2022. Okay. So up to 39/2022, it got extended. And it's a 5-year plan with annual updation. So what does it contain and why are we referring to this FTP? This FTP is not coming under Ministry of Finance. This Ministry of Finance, because Ministry of Finance will have a conflict of interest. How they can regulate import? If they regulate import, customs duty will come down, so they will not. So that's why this function has been given to Ministry of Commerce and Industry. Under Foreign Trade Regulation and Development Act, we have an act for this purpose, that is Foreign Trade Regulation and Development Act 1992. So that is delegated to Ministry of Commerce and Industry. That Ministry of Commerce and Industry so has further delegated this to DGFT, Directorate General of Foreign Trade. The DGFT operates through their regional authorities in India. Okay, this is the hierarchy of foreign trade policy. What is there in FTP? Set of guidelines or instructions. So then the contents of FTP, basic policy plus export incentives, that is how the goods are categorized and what is the treatment for second hand goods or samples, gifts, etc. That is basic policy. Export incentive, when you are exporting, what are the various incentives that is available, and handbook of procedures, forms, standard input output norms, harmonized system of coding. These are all not for our syllabus. So what we have in syllabus is only basic policy plus export incentives. Others and all we don't have, but these are all the contents of FTP. Now basic policy or basic aspects of FTP we will see. Usually imports and exports are categorized into 4. That is prohibited. You are not supposed to import, you are not supposed to export. Restricted. You can import or export only with a license or authorization. Then reserved for STE, state trading enterprises, only they can import. For example, all food items can be imported or exported through Food Corporation of India. All petrochemicals can be imported or exported only through IOC or ONGC, like that. That is known as reserved for STE. Then we have freely importable, freely exportable. Freely importable does not mean no need to pay customs duty. We need to pay. This is no way connected to that. This is without any authorization you can import, without any authorization you can export. So that is known as freely importable, freely exportable. Then authorization means what? For restricted goods we need a license to import or export. That license will be given by the regional authorities, that is DGFT, and the regional authorities will specify the conditions. So that is known as authorization. Authorization is not a right. Suppose you are making application to import and they are not giving the license. You cannot say how you cannot give me license. Same way they may not renew the license. It is up to their discretion whether to grant the license or to renew the existing license. And restricted goods is imported subject to actual user condition, which means only the one who got the license should use it. He cannot resell it to any other person, and every person who is importing and exporting should obtain a IEC. IEC is import export code, not given by customs department, but this will be given by DGFT. So it is nothing but our 10-digit permanent account number. As they wanted to streamline everything, they are connecting everything to permanent account number. So previously IEC was a different number, but now IEC is nothing but a permanent account number. And these are the principles for keeping some imports and exports as prohibited or restricted. Why they will prohibit or restrict the goods? What are the principles behind it? Either in order to safeguard India's external financial position, that is, if they allow these goods, because of it there will be too much of foreign exchange outflow. Too much of foreign exchange outflow means forex reserves gets depleted. For that reason they may prohibit or restrict. Then on export of foodstuff or other essential products, because these goods, if it is exported, then in India there will be a shortage, and because of that, so the drought could arise. Due to that reason they may prohibit or restrict. For preventing serious injury to domestic industry, if those goods are imported, then that will cause injury to domestic industry, so they may prohibit or restrict. Then on import or exports, for application of standards or regulations, that is, there are some goods, so if it is coming into India, then so that glut of cheap products should not come. So for the purpose of standardization also they may restrict or they may prohibit. Or import of fisheries, so because fisheries, already lot of marine reserves we are exporting from India, then what's the point in import of fisheries? So that's why they may prohibit or restrict. Then on imports to promote establishment of a particular industry, so to develop a domestic industry they may do that. And for protection of human or animal life or planet, so then also they may not allow that goods to be imported. So lot of animals, live animals, pets and all are not allowed to be imported into India. Okay, so for the safety of human beings in India, there are a lot of breeds of dogs which are banned, so which are not allowed to be imported into India. So like that, restricted or prohibited will be given. Then import of gold or silver, they can do restriction or prohibition. And then for conservation of exhaustive natural resources, they may not allow goods to be exported. And then for India's obligation under UN Charter, so under UN Charter India will say, okay, we will not import these goods or we will not export these goods. So those goods should not be imported or exported. Or for protection of countries' essential security interests, weapons and all, so that is for countries' essential security, so they were not allowed to import it, prohibit. So these are the principles. Now definitely these and all you don't have to write, but they may give a question, because it was an amendment for May 22, not asked in May 22, so there is a chance of asking a theory question. What are the principles that should be kept in mind for the purpose of restricting or prohibiting import goods or exported goods? Answer any 5. Like that they will ask any 5 points you need to write. So you tell me any 5 points, so easily we can recollect out of this. To safeguard the India's external financial reserves, or for the safety and security of the country, or to relieve the food shortages, like that, some points which you could recollect. You just revise it once again, so easily you can recollect some 5-6 points that you can write. Okay, then next, provisions relating to import and export of goods. Import of second hand goods, if it is capital goods, so again we need to divide it into two. So there are, that is second hand goods, second hand goods. Second hand goods always we have restriction, okay. Now it's first hand may be freely importable, but if you are importing it in a second hand form, that will be restricted. What are those 5 goods? Computers, laptops, air conditioners, diesel generator sets, and then photocopiers. These will emit lot of chlorofluorocarbons. Due to that reason it is restricted when it is imported in second hand, but its first hand is not restricted, but imported in second hand, that is restricted. Then other capital goods including refurbished spares, no restriction, means freely it can be importable. These 5 only restricted if it is second hand. Then suppose other than capital goods, any other goods imported in second hand, definitely restricted. How raw material and all you cannot bring it as second hand. So this is restricted, means requires authorization. Then, so India follows a restrictive policy with respect to waste and scrap, because in the name of waste and scrap some other goods should not be coming into India. So for that reason, and this waste and scrap will always be restricted. However, waste and scrap generated in SEZ sold to DTA. Whenever there is a sale from SEZ to DTA, that is treated as deemed import and chargeable to customs duty. So when waste and scrap is generated from SEZ and sold to DTA, then in that case, even though it is deemed import, even though waste and scrap requires license, but this do not require any license, just customs duty payment will be sufficient. So waste and scrap, which is usually restricted and requires authorization, can be cleared from SEZ to DTA without any authorization, but subject to payment of customs duty. And import of goods including capital goods which are used in abroad for at least 1 year without an authorization. Suppose if computers and laptops are used in a project abroad for a minimum, like at least for 1 year, so in a project they were used, can that be coming into India? Yes, that do not require authorization, even though these otherwise requires authorization. Are you getting this connection? Now you will get a question. So if a person is importing laptops, so ND is of the opinion that he does not require authorization. Comment. What you need to write? Import of laptops in second hand form requires authorization. However, if it is used in projects abroad for a period of 1 year, it do not require authorization, like that. Then import or export of gifts. In case of import of gifts, say for example, so one person in India who started chatting with one girl outside India, and that girl is sending some gift. So definitely he will not know what gift is being sent. So therefore that gift may contain an article which may be restricted, but this idiot don't know what is that article. So how he can get the authorization? He cannot get the authorization. So due to that reason, customs clearance permit is required. For example, one watch is being sent. Watch is restricted goods, and that restricted good generally requires authorization. But here in this case, as it is a gift article that do not require authorization, so just a customs clearance permit is sufficient. So in one form we need to fill in the details and give our ID proof, they will be clearing the goods. So that is this gift consignment. Suppose if it is other goods, for example, one letter or one card etc. is being sent, that is not restricted. So customs clearance permit not required. Suppose if he is sending any goods there, so that is export of gifts. If it is restricted goods, he know now which product he is sending. So then if that requires authorization, so then he need to get that authorization if it is restricted goods. Other goods, that is unrestricted goods, he can send. But to what value? So up to 5 lakhs in a year he can send. Beyond 5 lakhs in a year he cannot send. Why he cannot send? Without license or without authorization? Is he playboy or what? So in a year how he can send? More than 5 lakhs. So government wanted to know who is that playboy who is exporting more than 5 lakhs. So for that reason authorization is required. Then import of samples, vegetable seeds, bees and new drugs, authorization required. This is actually dangerous. Vegetable seeds, bees and new drugs, this and all when it is coming into India, so it came now already, COVID and all. So like that some other diseases will come into India, that's why authorization always required. Then any tea you are importing, up to 2000 rupees CAF value, authorization not required. Otherwise it is required. Why they will import tea? In order to know what kind of tea that they consume. So here these tea manufacturers will import, and accordingly these people will make the tea and they will export. For that they will import samples. So then samples up to 3 lakh rupees can be imported by all exporters without payment of customs duty. Then export of samples. Suppose if it is samples of freely exportable goods, no need of authorization. Suppose if it is samples of restricted goods, just an application is required to DGFT and can be exported as a part of passenger baggage also without any authorization, just application to DGFT sufficient. Re-import of goods repaired abroad. So generally if goods are imported that requires authorization, we exported for repairs, again we are re-importing, whether again we need authorization, no need of any authorization. Import of goods under lease financing, that is we are importing capital goods under lease model, so then we will pay lot of lease rentals, that's why authorization not required, but the RBI's permission is required because there will be lot of foreign exchange outflow. Then goods already imported against authorization. There are some goods that requires authorization, we don't know that, we have imported it, it is present in the customs port, we can clear it from the customs port, so without authorization prior, but at a later point of time we can obtain the authorization, means let the goods be there in customs, we can get the authorization on post import basis and submit the authorization and clear the goods, that is this. But this is not possible for items reserved for STE, because items reserved for STE they only should import, you should not import, so that is not possible. Execution of bank guarantee, LUT or bond with customs authority for import without payment of customs duty and with regional authority for local purchases. For example, in case of advance authorization, that is one license, a person can import goods without payment of customs duty, but they need to execute a bank guarantee, etc. That they need to execute with what? With whom? With customs authorities. With customs authorities. Suppose locally they can procure without payment of GST, because deemed exports visa supply to a AA holder is deemed export. In that case, they need to execute bond or LUT with whom? With the regional authority. Warranty spares other than restricted may be exported along with main equipment. So we are exporting one machinery and its warranty spares also will be sent at a later point of time. But we will not receive 1 rupee also for that warranty spare. Why? Because it is covered under free warranty we will be sending. Then RBI permission is definitely required. So subject to approval of RBI, because we will not get any money for that, and that too within the contracted warranty period. So because beyond warranty period if you are giving free, then country will not get anything as inflow. So for that reason, in case of third party exports, shipping bill shall indicate the name of both manufacturer and third party exporter. For example, I am manufacturing goods, you are exporting the goods, and I will import, you will export. I am importing raw material, you are exporting the finished goods. So which means if I need to get any incentive, you need to mention my name in the shipping bill. Simple. I am importing raw material, making finished goods, but that finished goods you are exporting. You are different person, I am different person. If I need to get any incentive, actually I only require incentive, you don't need any incentive, because you are not importing any goods, you are not manufacturing any goods, just you are selling those goods, but I am only importing the goods. So I will get any incentive provided in the shipping bill which you file, because you are only exporting, you need to file the shipping bill, in that you need to mention my name, that is this point. In case of third party exports, shipping bill shall indicate the name of both manufacturer exporter and third party exporter. Other documents, that is invoice, export order and bank realization certificate, should be in the name of the third party exporter. Then what are the various export promotion schemes? So we have number 1, advance authorization. So we completed the basic policy. Now the next part, that is what are the various export incentives that are available. You can see advance authorization versus duty free import authorization. So this question has already been asked for May 22 exams. Okay, last question number 6, they have asked for 5 marks. So this advance authorization, duty free import authorization are the two licenses which are available for an importer who is importing the goods without payment of customs duty. In turn, he is having an obligation. What is that obligation? He need to export. So now these two licenses are for the same purpose, for import without payment of customs duty. And advance authorization, can I transfer it to any other person? No, it is subject to actual user condition which cannot be transferred, but DFIA can be transferred. And how much should be my export value? I need to achieve minimum 15% in case of other than T, and in case of T I need to achieve 50%. Means my FOB value of export should be 50% more than the CIF value of import. So always compare between CIF value of import versus FOB value of export. For example, value addition is 15% and CIF value of import, CIF of import is 1,25,000. Then what should be FOB of export? What should be FOB of export? FOB of export is 1,25,000 plus 15%, that equals to 1,25,000 plus 15%, that will be 1,43,750. Like this a question could be asked, or another way, value addition is 15%. FOB value of export, FOB value of export is 1,85,000. What should be CIF value of import? What should be CIF of import? What should be CIF of import? Simple. Let X be the CIF of import plus 15%, that will be equals to 1,85,000. Then 1.15 X equals to 1,85,000. Then what will be X? 1,85,000 divided by 1.15. So that will be equals to 1,60,869. So 870 rupees. This much can be the CIF value of import. So like this a question can be tested. Definitely theory already asked. Maybe a question on value addition could be tested. Whereas in case of duty free import authorization, value addition is 20%. What is the period of fulfillment of export obligation? What is the time limit by which we need to export? 18 months from the date of issue of authorization, 12 months from the date of filing application in these two cases. Whether AA is applicable for gem and jewelry sector, yes, but DFIA is not applicable. Then fixation of standard input output norms for advance authorization not required, but in case of duty free import authorization it should be fixed. Duties that are exempted, in case of advance authorization all customs duties are exempted, no need to pay anything, including IGST and GST compensation cess up to 30th June 2022, already over. So therefore now we are importing, we need to pay after 30th June, we are importing, we need to pay customs duty, we don't have to pay social welfare surcharge, we don't have to pay, but we need to pay IGST and compensation cess. Whereas before 36 anything is imported, we don't have to pay anything including IGST and compensation cess. Whereas in case of DFIA only basic customs duty is exempted, but remaining and all. So anyhow even before 36 also we were paying IGST and GST compensation cess. Now what is the difference between AA and DFIA? In AA all customs duties except IGST, GST compensation cess are exempted, whereas in DFIA only basic customs duty is exempted. Then when basic customs duty is exempted, social welfare surcharge also exempted. When available, in case of advance authorization, it can be pre-export basis, that is before export we can import. We can import without making export, which is in the sense imported goods used in export, then we can import it without payment of customs duty. Or using the local material, we can export using the local material in the inventory, in our inventory. We can use the inventory and we can export, and to replenish that inventory. So to restock that inventory, I can import without payment of customs duty. But when I am restocking that inventory, for that purpose CS certificate is required. On post-export basis with an entitlement, usually CS certificate is required. In that case, he need to certify how much of the local material is used in the exported goods. So then only that much quantity we can import. But DFIA is always post-export basis. Means first use the local material, that is whatever is there along with whatever you have already purchased locally, use that and you can replenish that. And for that purpose you can import without payment of basic customs duty. So this is either pre-export or post-export, but this will be always on post-export basis. How to compute the value addition? Value addition will be A minus B by B into 100. What is A? FOB value of export. What is B? CIF value of import. FOB value of export minus CIF value of import divided by CIF value of import into 100. That's how we need to calculate. But whenever you are importing goods under duty drawback, on that imports also you need to achieve value addition. Got it? See there, see the B point. So not only on the imports under advance authorization, even on imports on which duty drawback is claimed, on that also we need to achieve the value addition. For example, imports under AA, imports under AA advance authorization 1,50,000. Import under duty drawback, imports under duty drawback. In both cases you are getting benefit na. Here you are not paying customs duty. In this case, you paid customs duty, you got the refund. Both cases you got the benefit. Now what should be the FOB value of export? What should be FOB of export? FOB of export in case of DFIA. In case of DFIA, what should be FOB value of export? Simple. So we need to take 2,50,000. We should not take only 1 lakh. Sorry, what should be the, in case of AA? So what should be the FOB value of export in case of advance authorization? 1,50,000 alone don't take. 1,50,000 plus 1 lakh. 2,50,000 you take plus 15%. 2,50,000 plus 15%, that will be taken. Why sir we need to take even under duty drawback? That's how it is given pa. So 2,87,500. Even on duty drawback whatever claimed also, on that also we need to achieve value addition. And in case of free of cost material supplied by foreign buyer, that is whenever free of cost material is supplied by the foreign buyer, we are using it for export, and that free of cost means we did not pay. So now include that free of cost material both in FOB value of export and CAF value of import. Suppose if free of cost material that we are bringing, the notional value is 1 lakh. The notional value is 1 lakh. So imports under AA, imports under advance authorization, imports under advance authorization 1,50,000, and notional cost of free material is 1 lakh. Then what should be FOB value of export? FOB value of export under advance authorization, what should be taken? Simple. So first imports under advance authorization 1,50,000 and plus notional cost of material 1 lakh, okay, 1 lakh into 1.15 equals to FOB of export plus 1 lakh. FOB of export plus 1 lakh. This 1 lakh should be added on both sides, okay, LHS and RHS. So 1 lakh plus 1 lakh 50 plus 1 lakh 2 lakh 50. 2 lakh 50 into 1.15, that is 2,87,500 minus 1 lakh, that equals to 1,87,500 will be the FOB value of exports. Got it? So that notional cost of import should be included both in CAF value of import and FOB value of export, that is this, okay. Then export promotion capital goods scheme. So this much detail I am telling pa. So reason being, these are all the illustrations that are possible, can be tested, okay. I am telling this because this will be the last attempt for FTP. Thereafter new FTP is coming, that's why, okay. May 22 anyhow nothing is applicable, all these things are not applicable. So new FTP will come because already FTP deadline is over, this month end only. Already they have made steps for the purpose of changing the FTP. So therefore for May 23 this is nothing will be applicable. So look into this EPCG scheme, export promotion capital goods scheme. EPCG scheme is like how advance authorization is for import without payment of customs duty. EPCG is for import of capital goods at zero customs duty, okay. And how it works as zero customs duty. So previously, that is up to 36/2022 it is zero, but with effect from 36/2022 we need to pay IGST and GST compensations because this exemption is only up to 36/2022. In 3 places IGST and GST compensation cess is exempted up to 36/2022. What are they? Number 1 AA, number 2 EPCG, number 3 EOU. For these 3 places IGST and GST compensation cess is exempted on import up to 36/2022. Then sir, capital goods can be imported for pre-production, production or post-production, and export obligation, that is important. How much export obligation we need to achieve? We need to achieve export obligation which is 6 times the duty saved. For example, the duty saved is 100 crores. Then how much we need to achieve as export obligation? 600 crores. That 600 crores, 6 times the duty saved. And this 6 times the duty saved, we need to achieve over a period of 6 years. 6 licensing years. Means the time when we got the EPCG, from there within 6 years we need to achieve this. And when this we are achieving, so we need to achieve it in 2 blocks. In the first block of 4 years, we need to achieve 50%, means 300 crores we need to achieve in the first block of 4 years, and in the next block of 2 years, we need to achieve remaining 50%. Then plus we need to also ensure that there is an average export obligation. Average export obligation means every year export should be at least average of the 3 preceding licensing years, which means so we need to maintain the consistency also. So for that reason they have given this average export obligation. We achieved specific export obligation, not achieved average export obligation. As good as we have not achieved export obligation, so whatever benefit we got, we need to pay. What is the validity of this license? This license means under this license we can import the capital goods for a period of 18 months from the date of issue of authorization. Any other condition, that is import of capital goods, is subject to actual user condition till export obligation is completed. Until that point of time, whatever capital goods we brought under EPCG should not be sold in India. Then second hand capital goods are ineligible, and either we can make exports physically or deemed exports will also be counted for fulfillment of export obligation. Suppose if he has fulfilled 75% of the specific export obligation and 100% of export obligation till date, if any, in 3 years, remaining export obligation shall be condoned and authorization will be redeemed. For example, you take year 1, 2, 3, 4, 5, 6, and what is the export obligation? Export, that is exports. What is the exports achieved? Exports achieved, that is obligation is 600 crores. He need to achieve 600 crores, that is the export obligation. Exports is 200, then 250, then 300, then 400, so 250 and 350, like that we have exports. Now what is the average export obligation? So what is the average exports? So first year 0. Why? Previous year. For first year we need to take preceding 3 years. What is the preceding 3 years? Nothing. This is the first year. For first year there is no preceding year, so 0. For second year, what is the preceding year? 200. Only one number. Average of one number is that. Okay. Summation x by n. When there is only one number, that only. Okay. 200. What to do? Somewhere in last Janma you studied, no? So 300, 250 plus 200 divided by 2, 225. Then 3, 200 plus 250 plus 300 divided by 3, 200 plus 250 plus 300 divided by 3, that is 250. Now, so how much? 600 crores. What is 75% of 600? 600 into 75%, 450. So 200, 250 we achieved in less than 3 years. We achieved it in less than 3 years, and we maintained average also, correct or not? Which means by second year itself, over this and all we don't have to do. By second year itself it is completed. Export obligation completed, means remaining 25% we don't have to achieve. That is this. Then under this scheme, capital goods are imported on full payment of applicable duties. Later the customs duties are remitted. Then indigenous sourcing of capital goods and benefits to domestic supplier as deemed export. That is, so whatever capital goods that are there, that is locally also we can buy. That's the reason why under GST sale to exporter, sale to export is considered as deemed export. Then, but this area is not there in syllabus, you can remove. I only gave this thinking that this will be there for amendments, but no, in the amendments material they did not give this. Composition fee or late fee for extension of time limits, it is there, really it is there, but for your exam it is not there. Okay, so this portion is omitted for your exam, so therefore you don't have to, because it is not given in the amendments material. Then we have previously MEIS scheme. That MEIS scheme is omitted. In this name of MEIS scheme we have RODTEP scheme, rebate of taxes and duties on exported products scheme. So what is this RODTEP? That is, whenever we are exporting a product, so then we will be having some local taxes. We will get the benefit of GST, we will get the benefit of customs, but there will be some local taxes on those goods. So those local taxes and all, there is no law which gives the refund. So to give the benefit of those local taxes, a percentage of your export FOB value like duty drawback, they will be giving. But this will not be given as a cash. This will be given as a scrip. What you can do with that scrip? You can use it for payment of customs duty, or you can transfer it to any other person. That is this. So refund to exporters with respect to local duties and taxes that were so far not being rebated or refunded. And this refund will be credited to electronic duty credit ledger through e-script, which can be used for payment of customs duty or can be transferred to other importers. And this will not be available in respect of duties or taxes that are already exempted or credited or remitted. That is, already they got a benefit, that will not be covered. So some local taxes, because like mandi tax, local body tax, like that, lot of municipal taxes are there, for that they are giving. Under this scheme, a rebate would be granted to the eligible exports at a notified percentage. So this is like a notified percentage of FOB value. Then, so here there is a condition that, so they have to realize the proceeds within the time allowed under FEMA, 9 months. Then otherwise they will not be getting this rebate. So they will get this rebate only after realization of the export proceeds within the time prescribed under FEMA, that is 9 months. What are the ineligible items? Easily you can remember, prohibited items, restricted items, not covered. Prohibited items, restricted items, not covered. Then export of imported goods. First of all, it is not local taxes. There is no local taxes on these goods. We are importing from one country, exporting to another country where there is local taxes on this. So that's why there is no benefit. Exports through transshipment, again imported from one country and taken to another country through transshipment. On that also nothing. Minimum export price or export duty. So whenever the government tells that this is the price at which you need to export, so then they are not levying any taxes on that. So therefore there is no local taxes. Deemed exports, the goods did not cross India, it is within India only, so that's why we will not get any benefit. Goods manufactured by DTA to SCZ, so again within India only, so no benefit. Product manufactured by 100% EOU, EHTP, BTP or customs bonded warehouse. So here first of all, there is no local taxes, there is no customs duty also in this place. When the goods are imported and manufactured in this place, there is no customs duty in a 100% EOU, EHTP, etc. That's why. Then products manufactured or exported in discharge of export obligation. Already on that we are getting the benefit, so that's why again we will not get benefit here. So this you mark as important. If at all they wanted to test, they can test this. What are the ineligible supplies under this scheme? Then service export from India scheme. Service export from India scheme is applicable. So in case when the notified services are provided to recipient in any other country. But what are the conditions? 3 conditions. Service provider should be in India, they should have an active IEC, and they should have a minimum NFE in the current year during the financial year of $10,000 in case of individual or sole proprietorship, others $15,000. What is considered as NFE? Net foreign exchange earnings means income in forex minus expenditure in forex, that is known as NFE, net foreign exchange earnings. And how much will be incentive? Depending upon a percentage, that percentage will be given in the question itself, that percentage will be multiplied on that annual NFE. Frequency, yearly benefit can be claimed. And what is the procedure and time limit? So there is that it's not at the time of export of service. For the year whatever we made, for that only we can go for SCIS. And we need to file one form ANF 3B within 12 months from the end of the relevant financial year. And special points, supply of services to tourist who is coming from outside India to India. Not necessary that we need to export the services. We can supply services to the service consumers or foreign country in India, then also it is eligible. And provided we need to receive the currency, that is through credit cards. Foreign currency means international credit cards, the payment should be received, then it will be counted for NFE. And what is the ineligible sector? Telecom sector is ineligible, and investments and capital receipts are ineligible. And foreign exchange turnover by healthcare institutions, educational institutions like equity participation donation, how these and all your income here, that is telecom sector okay, investment and capital receipts is not your income, and even equity participation and donation is also not your income. Foreign exchange earnings from services provided by airlines, shipping lines, flying from a foreign country to another foreign country without touching India at all, but that company is in India, Indian Airlines, they are running a flight from outside India to outside India, that will be not considered as income in forex. Then payments for services received from EFC account. So these are all ineligible category. Again mark this SAIS as very important. So last 2 attempts they did not touch. So there is a chance of asking. One 5 marks question will be guaranteed on FTP. Every attempt they are asking one 5 marks question on FTP in the 2 question number 6. So somewhere like 6C, 6B or 6C, mostly 6C, FTP question only. And status holders under FTP. So status holder means an exporter who achieved a particular export performance is called as a status holder. What is that export performance? If they achieve, so $3 million, they will be called as 1 star, $25 million, 2 star, and $100 million, 3 star, $500 million, 4 star, and then $2,000 million, they will be called as 5 star. So can you tell me what is that limit? 3, 25, 100, 500, 2000. How many phone numbers you will remember? This number can't you remember? You can remember. So this is 1 star, 2 star, 3 star, 4 star and 5 star. And this should be counted for 1 year. Is it for 1 year? No. This is export performance based on, current year and the previous 3 years. That is the export performance for this year. So current year export performance is current year exports plus previous 3 years. So that you have to achieve in at least 2 out of 4 years, then you will get the status. Once you will get the status, that status you will be getting some benefits. What are that benefits? Authorization and customs clearance on self-declaration basis. No need of any certificate from the officer. And fixation of standard output norms on priority within 60 days. No need to furnish any bank guarantee for import and export. And 2-star export house and above means except 1 star can establish the export warehouses, means private warehouses. They can have their own private warehouses. Then green channel clearance facility. What is green channel clearance facility? There is no physical examination of goods, but only based on documents the imports will be completed. Self-declaration has to made in India. Then all status holders can export on free of cost basis for export promotion subject to 2% of the average annual export realization during preceding 3 licensing years. And for gem and jewelry sector, it is 1 crore or 2% average of the current and previous year. This you mark as important. Then how to compute the export performance? So that is depending upon, that is status recognition is depending upon export performance, current and previous 3 years, and 2 out of 4 years they need to maintain. Once they achieve that star status, it will not be removed. That will be there. Then export promotion zone scheme. So what are export promotion zones? EOU, EHTP, STP and BTP are called as export promotion zones. And what are the units covered under this scheme? They can do any business except trading, and they should achieve a positive NFE over a period of 5 years. And that 5 years, if they could not achieve, it will be extended for a period of 1 year. And what are the tax implications? Any import by EOU, EHTP, STP, import of goods is fully exempted. Import of service, no exemption, they need to pay GST under RCM. However, that GST what they paid under RCM, they can avail as ITC and they can get it as a refund at the time of export. Refund of ITC they will get. Now, what about the local purchases? Local purchases will be called as deemed exports. So, the supplier is having 2 options. Supplier may not charge GST at all to the EOU, or EOU may pay GST, take it as ITC and get the refund. And whenever EOU is making sale to the recipient, that will be treated like a normal sale. So whenever they are exporting, no need to pay customs duty. These are the various incentives available. And here also on import, they are not required to pay IGST and GST compensation cess up to 36/2022, and thereafter they need to pay IGST, GST compensation cess. Then conversion of DTA into EOU. Already I have a factory in domestic tariff area that I want to convert into EOU. Is it possible? Yes. For that I should have a minimum investment of 50 crores and above in plant and machinery, and I should be exporting 50 crores and above annually. Then only I can achieve that status. Who can establish EOU? So any person who is having a minimum investment of 1 crore. What is the difference between these two? This is for a new EOU. This is for converting existing DTA into EOU. And only for EOU this minimum investment of 1 crores, but for other units there is no limit, and this 1 crore limit also can be relaxed by board of approval. And clearance to DTA. So there are certain relaxations. Whatever goods exported, they can clear it to DTA, and beyond that they cannot clear. So exit from EOU scheme with the approval of development commissioner, they may opt out of the scheme. Such exit shall be subject to payment of applicable GST and compensation cess. Then we have deemed export. Deemed export, there are few exports, there are few supplies treated as deemed export, in that the first three is already deemed export under GST. What are they? Supply to AA, supply to EOU, EHTP, STP, supply to EPCG holder. These three are already treated as deemed exports under GST. It is also deemed exports under FTP. Apart from that, there are supplies to some projects. What are those projects? ICB, International Competitive Bidding Project. Just remember, that is sufficient. International Competitive Bidding Project, and projects financed by UN or international organizations, and nuclear power projects. So these are the 6 cases where it is treated as deemed export. Then one more point is there, so that is not relevant. So EOU selling containers to one exporter who takes the containers outside India within 6 months, that is one point, but don't remember just these 6 points. So these are the 6 cases where it is called as deemed exports. Now what will happen? I can import the goods, without payment of customs duty and sell to these people. So under advance authorization, that is the first benefit. Or number 2, I can import the goods, pay customs duty and sell to these people, and whatever customs duty I paid at the time of import, I will get duty drawback, refund, duty drawback. So these are the 2 benefits available in case of deemed exports, either advance authorization or deemed export duty drawback they will be getting. Okay, and penalties. So whatever breach of any foreign trade policy, there is an export obligation, you did not fulfill export obligation, then whatever benefit you got under FTP, that will be taken back along with interest. With this, we completed customs and FTP. Okay. Now, one last area is there, that is meaning of various turnovers. So actually we have come across different turnovers in GST. So this is the meaning of various turnovers. You need to have a little bit clarity in this. That is, what is the meaning of aggregate turnover for determining the eligibility for registration? When a person is required to get registered, regular aggregate turnover. In that regular aggregate turnover will take taxable supplies, exempted supplies, non-taxable, inward supply under RCM will not come, GST also, all GSTs will not come, old indirect taxes, we will be taking it, and then interest on loans advance also will be taken, interest on account of delay in receipt of consideration also will be taken, and aggregate turnover always computed on a all India basis. And for the period, which period we will take? Current year for determining the registration. Current year we will take for determining registration. Interstate supplies also will be taken. Pre-registration turnover not applicable, because we are determining this turnover only for the purpose of getting registered. So this is the regular aggregate turnover. Then we have another aggregate turnover for determining the eligibility to opt for composition scheme. 3 special points. This we will take for previous year. This we will take for previous year. And then interest on loans advances deposits will not be taken into this, and also inward supplies and RCM, all these are same. And another difference is that pre-registration turnover will be included. These are the 3 special points that you need to remember. And then, so what is the turnover for computing 10% limit? That 10% limit turnover will be taken on state wise. So remaining is same as aggregate turnover, already we discussed. Then turnover for payment of GST under composition scheme, it can be turnover or taxable turnover. So in that case, non-taxable supplies and interstate supplies if you are having, you are not eligible for composition scheme, and this should be calculated for current year, and state wise only it should be computed, and the pre-registration turnover will be excluded. Then 2 more turnovers. Turnover for computing the reversal of ITC and ITC by ISD. In these 2 cases, what should be taken as turnover? Same aggregate turnover only, but only difference is that we should not be taking old indirect taxes. Old indirect taxes will not be coming. Remaining and all is same as aggregate turnover only. Okay. Then next, pre-registration turnover not applicable and all in that. Then turnover for computing refund of unutilized ITC. Refund, adjusted total turnover. In that, exempted supplies should not come. Exempted supplies should not come, non-taxable supplies should not come. What about old indirect taxes? That will be taken. So this chart definitely you need to revise that one day before the exam. In this book, what are all the things that you need to revise one day before the exam for sure? Number 1, place of supply. Number 2, exemptions under GST. Number 3, search, seizure, offences, penalties. Number 4, this chart, turnover chart. This turnover chart. So these are the 4 things that definitely you need to revise one day before the exam and go for exam, okay, because these points will be there. Apart from this, the time limits and monetary limits also. So if you make a note of that, what are all the various time limits under GST and customs, what are the various monetary limits under GST and customs, that will help you a lot, so that you can register that in your mind, and for MCQ purpose it will be helping you, okay. So that's it, pa. Here I gave some section reference so that you can constantly revise these sections, so that wherever answer it is possible to quote those section numbers. If you are quoting that section numbers, you will be definitely getting some impression, pa, so that some extra marks, let it come. So therefore, what's there, if it is extra, it's okay, no, we can adjust it for others, or any extra marks, let it be, nothing wrong in that, okay, we can keep it. And with this, the entire theory discussion, the rocket revision is completed, okay. Actually I planned for 18 hours and it went to 22 hours. I planned for some 18 hours, 16, 18 hours only, but it went for 22 hours. It's because of covering all those things. I think 7 hours only per day it took, 7 hours only. So it didn't go for more than that. Effectively 7 hours only I got. So 7 3s are 21. In that also, if you cut out unnecessary things and all, 20 hours. So therefore, if you want to revise any particular day, that this particular things and all, what you can do is that, so in 1.5x speed, if you keep already 1.5, and then 1.8, 2, like that speed also you can keep, and you can watch this, so that you can complete it if you want to revise it again, okay. That one day before the exam you can make use of it, okay, fine. And tomorrow the agenda is that tomorrow morning, is at 7, 7 o'clock we will meet, and for YouTube students we will share the link with you, and for you can come here, optional only, not mandatory. By today it is over, so tomorrow it's as you wish. Anyhow I need to do the recording, I will do the recording of those 15 questions. So if you are coming, come. If you are not coming also, no issue, but I will be coming, I have to come, no other go, okay. So I will be taking that 50 questions tomorrow. Thank you, we will meet tomorrow.
You